geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws while promoting local community development, and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed. Hi, I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
Well, hello everyone. My name is Art Lindo, and I am a Deputy Director in the Board of Governors Division of Supervision and Regulation and the head of the policy group within that division. It is my pleasure to welcome you to the second annual Financial Inclusion Conference hosted by the Board of Governors. Can I get an applause? So as you can see, I'm thrilled to be here today. And to kick off the conference, as anyone knows me, knows that financial inclusion is near and dear to my heart. So financial inclusion means a lot of things to a lot of people. But to me, the importance of this topic is embedded in the belief that the financial system should be able to meet the needs of all Americans. The financial system has made a lot of strides in this area, but as we look to the future, I'm excited to see where we can go from here. So, just to make sure everyone is on the same page as we kick off this conference, I wanted to spend a quick moment to let you know why we are here at the Federal Reserve today. So, the Federal Reserve's mission of fostering optimal macroeconomic performance, financial stability, payment system efficiency, and financial institution integrity are each broadly aligned with efforts to address financial inclusion. In general, the financial capacity and capabilities of individuals, households, and small businesses are improved by broadening fair and affordable access to financial services. Providing access to financial services, however, is a means, but certainly not an end. Efforts to measure and understand the implications of financial service access, including through financial health metrics, can help to continue the momentum to a more financially inclusive America. Now, from the Fed's point of view, addressing inclusivity in our financial system requires a cross-cutting approach, one that touches our supervisory, regulatory, and consumer oversight capacity, as well as our role in facilitating safe payments functioning. This conference gave us an opportunity last year to learn more about the state of financial inclusion, but this year we are looking forward to what the future can hold. Now, to guide us, we will hear from two of our oversight governors, along with a range of thought leaders, academics, practitioners, and others to help shed light on how financial inclusion can or should evolve to best help individuals, households, and businesses meet their goals. We will also spend time expanding our understanding of how the financial system and our regulatory tools can support a more financially inclusive future. I also want to say a particular hello to everyone joining us from across the Federal Reserve System and on the board's public website and YouTube page. Hopefully, we can all work together to push the boundaries of how our financial system can best meet the needs of all Americans. Now, you're probably wondering where I'm going on, because my main job this morning is to introduce our Vice Chair for Supervision, Mickey Bowman. So, Mickey Bowman was sworn in as the Vice Chair for Supervision in June of 2025 and has served on the Federal Reserve Board of Governors since 2018. With a deep background in community banking and regulatory affairs, she brings significant empathy and expertise about the role of financial institutions in supporting local economies. Vice Chair Bowman has been a staunch advocate for financial inclusion throughout her time at the Federal Reserve, including through highlighting the need to expand access to financial services as an essential tool for broad-based economic growth. Her leadership, which I can attest to, continues to help us to push the boundaries on this topic. Now, she couldn't be here in person with us today, but she did send remarks. So with that, I'm going to turn it over to hear her remarks. If you would cue the remarks, please.
Good morning. I'm very pleased to welcome you to the second annual Financial Inclusion Conference hosted by the Federal Reserve Board. Last year, at our inaugural event, I underscored that financial inclusion is essential for creating an economy that works for everyone, with innovation in the financial sector playing an important role. This year's conference builds upon increased engagement across both the public and private sectors, with a collective effort to leverage technology to broaden financial services access and improve the financial well-being of consumers and small businesses. The Federal Reserve will continue to play an important role in these efforts through its research, community engagement, and regulatory approach. This work supports our ability to understand and communicate the state of financial inclusion, how banks support access to affordable financial services, and the role that our policies and practices play in promoting inclusion. Banks of all sizes are working to improve access to financial services for all Americans. As I've noted in the past, the U.S. banking system is well positioned to bring consumers and small businesses into the financial mainstream by providing access to safe, fair, and responsive financial products and services. These efforts greatly benefit from our continued focus on broader access and innovation, including understanding how our supervisory and regulatory framework either supports or impairs a bank's ability to provide affordable financial services that are consistent with safety and soundness. Innovation comes in many forms. One example is through the bank's use of alternative data, which can enable banks to provide services like affordable small dollar loans or to provide access to credit invisibles who may not have access to loans and other financial services from traditional lenders. This growing area of focus also helps align financial service offerings with a customer's financial goals. A well-functioning financial system provides a foundation for strong consumer financial health. To further this, the federal banking agencies recently published a request for information on check and payments fraud to help address the impact of this growing problem on banks and their customers. I am committed to working together with a wide range of state and federal partners, including law enforcement, to address this issue. Although there has been significant progress in providing access to financial services, there is more work left to be done. We know that financial institutions, both small and large, are working to build innovative approaches to meet their customers' needs while maintaining the safety and soundness of the banking system. The theme of this year's conference is Unleashing a Financially Inclusive Future. Today we will hear from a number of experts that will help to explore what the future might hold for financial inclusion. Our next presenter, Joanne Barefoot from the Alliance for Innovative Regulation, will discuss the role of the banking industry and its innovation and policies in support of financial inclusion. Later in the day, we will hear from 3 panels focused on topics including evolving products and practices, the role of mission-driven organizations, and how cross-border payment innovations can facilitate the movement of money around the world. I'd like to thank you all for joining us today, and I'll turn it over to Art Lindo, our Deputy Director and Head of Policy in the Board's Division of Supervision and Regulation, to introduce Joanne. Thank you again for the opportunity to join you virtually today and for your ongoing commitment to support a financially inclusive future.
So those were great opening remarks, and we're going to kick this thing off properly with another keynote speaker, all right? So it's my pleasure to introduce our keynote speaker, Joanne Barefoot. Joanne is the CEO and co-founder of Alliance for Inclusive Innovation, or AIR, which is a global not-for-profit focused on accelerating regulation innovation to make the financial systems safer, fairer, more resilient, and tech-forward. In a previous life, Joanne was the Deputy Comptroller of the Currency, becoming the first woman in that position. In this role, she established the OCC's original Consumer Protection and Community Reinvestment Unit. Joanne is a consummate champion of financial inclusion. In her various roles, she has built frameworks to advance community reinvestment, highlighted the potential financially inclusive benefits and pitfalls of emerging financial products, and continues to shed light on the role that regulation plays in building more financially inclusive futures. So Joanne has too many accolades to name here, but a few I want to highlight includes being nominated the FinTech Hall of Fame. So one day when I grow up, I want to be in that category, all right? But I'm going to start small. But being named the FinTech Woman of the Year and hosting the popular Barefoot Innovation podcast. Joanne, thank you for joining us today, and we look forward to hearing your remarks. Thank you.
Thank you, Art. And thank you to the Board of Governors for inviting me to be here. I'm really thrilled to be able to join this group. I love to speak to regulatory groups. I actually spoke to a group at the Fed, a different group not long ago. And as Art said, I'm a former regulator. I think regulators have such a critical role to play in the ecosystem that is working on these challenges today. And so I'm going to try to be a little bit provocative and at least thought-provoking as we talk about the moment that we're standing in. I think my main message to you today is that I would encourage us all to think bigger. First of all, I think we should think about financial inclusion more in terms, and Governor Bowman, Vice Chair Bowman touched on it, in terms of financial health, consumer financial health. Inclusion is necessary but not sufficient to enable consumers to thrive in their financial lives. I think globally we've had a drive for financial inclusion for maybe 15 years or so, and it's been mostly about having people get a bank account or a payment account so that they can attach to the financial system. I think in the US we sometimes use the term a little more broadly, but you can be included in the sense that you can access products and services and still be struggling. So I'd like to think about that more expansive goal of what is it that we're trying to accomplish. And if we ask ourselves what people need, they need access, they need affordability, they need to be able to afford financial services, they need to be able to qualify for credit if they can repay the loan, right? If they've got the ability to repay that loan, they should be able to get the loan. And currently in the United States, we think we have tens of millions of people who actually could repay a loan but have trouble getting access to credit. They need the ability to save and invest and actually build wealth. I think we have seen an increasing focus on the problem of the difficulty of building wealth for people who don't already have it, the racial wealth gap, which is stunning in the United States, and also the burdens borne by people who don't have intergenerational wealth and are therefore behind over a history in the generations in their families. That's a problem that we need to work on. We also know that people need to be safe in their financial lives, and I'm going to talk more about this in a few minutes, but the epidemic that we are having of financial fraud and scams and the harm being done to individuals as well as other players in the space is absolutely stunning, and its problem is getting worse instead of better. And I think people need to be able to know that if they're transacting or doing anything in their financial life, they're okay. And then last but not least, people benefit from having some help in making good decisions, good choices. Market economics being what they are, the theory is that in a pure, well-performing market, buyers and sellers are on an even ground with each other, and they can both make the choices that are in their best interest. In finance, we almost never have that. We have an asymmetrical market where the provider has much more information and often much more power, so to speak, than the consumer does. And so we have a lot of problems in our financial system with just people choosing the right product, getting the thing that they really need, and also just managing the complexity of their own life so that they do save enough rather than spend or borrow more than they should, and so on. These are perennial problems. So I think we should think bigger in terms of the scope of what we're trying to accomplish. And then secondly, and I think even more in need of our thought, is I think we should think bigger in terms of how we focus on the technology moment that we are in and how momentous it is. We have entered into an era of profound technology change, which is going to change people's financial lives and everything else, and we all are aware of it on some level, but I think we're underestimating it. The tech changes that we've seen in recent years with digitization and mobile access to finance and so on are revolutionary. And now we're on the cusp of having a lot of changes brought to us by blockchain technology, which I'll circle back to later on. But blockchains, tokenization, digital assets, crypto, Web3, DeFi, that whole cluster of activity is extremely significant. And then most significant of all is the arrival of generative AI. AI has been around for more than a half a century, 70 years, something like that. It didn't used to have enough data to work on to actually change our lives that much. That has been changing over the last decade or so. But then a couple of years ago, we had generative AI burst into our lives. I don't think we've ever seen a technology that hit us all at the same time the way this one did. If you think about blockchain and crypto, that kind of sneaked up on people after gestating for years and decades, years anyway. Generative AI, when they released ChatGPT, all of a sudden, within a few months, every business executive, every member of Congress, every agency head, everyone said, what's this going to do? I'm going to get my hands on it, see what it's like, and all of a sudden, everything is starting to happen differently, and the pace of the change is incredible. So Gen AI is the fastest adopted technology in the history of the world. It's massively expanding every day, and it is what is called a general technology, not to be confused with general artificial intelligence. That's a different and scary thing. But a general technology is one that is so useful that it is going to change how everybody does practically everything. It's like electricity or the internet. It's just fundamentally transforming all the things around us for good and for bad. And as regulators, maybe, again, I'm a former regulator, a lot of us tend to think about the bad first, and because that's the job, deal with the risks. But the opportunities, the upside opportunities here for financial inclusion and financial health are absolutely profound. So I'm going to talk a little bit about what I see as the risks arising for consumers from particularly generative AI, and then what some of the upside opportunities are. On the risk side, again, crime is skyrocketing. If global financial crime was a country, it would be in the G7. It is enormous. It's trillions of dollars a year. And our methods, despite the fact that for banks it's the most expensive compliance function that they perform, worldwide, tens and tens and tens of billions of dollars spent on complying with our rules. And yet the UN says we catch less than 1% of it. I saw a Basel study not long ago that said maybe we catch 0.1% of financial crime, broadly defined. And it's all getting worse. And it's getting, for consumers, a diabolically difficult form in terms of people being able to defend ourselves against it. Let me ask you, how many of you have yourselves or had someone close to you who has been victimized by a sophisticated financial scam? Yeah, a lot of people. I took a Uber ride not long ago and was talking on the phone to my own office about something we were doing on it. And when I got out of the car, the driver said, "Thank you for working on that because it ruined my life." You know, I was victimized by a scam. The sophistication of it, the fact that these technologies are democratizing the process of creating crime. And we have, as you know, on the dark web, we've got the emergence of crime as a service, as an actual term that people use. So people are selling the techniques to do these things. And the ability to defend yourself against voice cloning and deep fakes and sophisticated attacks that know a lot about you and know a lot about who you might actually be dealing with and can impersonate it or trick you into something is unlike anything we've ever seen before. And we're going to have new techniques. We're going to have new techniques to equip people to protect themselves against it. Something that I'm going to suggest as I go through my conversation is the need to use technology to protect from technology risk. The other thing that's threatening consumers from Gen AI is job loss. I brought a quote that I saw recently that really caught my eye. This was from a CEO to his own employees. He said, "What was once considered easy tasks will no longer exist. What was considered hard tasks will be the new easy, and what was considered impossible tasks will be the new hard." And with that happening, we are looking at consumers who are going to be increasingly vulnerable to problems in their overall lives, including their financial lives. But if we, on the good side, if we ask ourselves what the upside can be and what do we need to do, and if we sort of sift this big trend down to the essence, the first thing, so to speak, part of what these technologies are doing is they're making expensive things less expensive, massively so, massively so. So it's going to change financial infrastructure. It's going to make financial infrastructure less expensive. There's a whole school of thought that stable coins are going to become a new infrastructure layer that's going to be much less expensive. This is the Federal Reserve. I'm sure there's plenty of opinions on that in the room. But there is a possibility of taking a lot of the friction and cost out of just running financial activities through blockchain. And of course, the stablecoin legislation is, I hear, likely to be signed this week in the United States. So that's going to be interesting. The technology is also making difficult things easy. So if you're a financial company, it's going to get easier to evaluate credit risk. You'll have more data that you can crunch with more sophistication in an easier way. It's going to be easier if you're in the securities field, if you're a broker-dealer, for example, to give better investment advice because you'll have more information at hand and more ability to model it and understand risks. It's probably going to get easier to identify who people are, to move toward a system of more digital identity. And if we have that, we can solve problems for consumers as well as combating other problems, including fraud. Because right now, as we know, many people are excluded from the financial system. by failing KYC tests, just having it be too hard to figure out exactly who they are and be confident in it. If you're a consumer, it's going to get easier to run your financial life, to pay your bills, do your budgeting, do your planning, manage your life. I was at the farewell event yesterday for the outgoing acting controller of the currency, Rodney Hood, and spoke to a person there who's gone to work for, I won't name the company, but for an agent, an agentic AI tool to help consumers run their financial lives. And he was giving examples of what it's doing for him as he's using it, the ease with which, and the engagement with which it's making it possible for him to understand what he's been doing wrong, think about it, get motivated to do things differently. And then in addition, broadly moving toward more use of agentic methods of all kinds. It's going to get easier for people to just, you know, I always sound like an optimist on these things, and I'm not trying to underplay the risks. I mean, everything I'm saying is unbelievably difficult, but it does seem likely to me that we're going to a system where people will be able to have an AI agent that will run their financial life for them if they wanted to, or at least coach them and advise them and help them to get things right, and affordably so. And last but not least, it is making opaque things transparent. If you think about the role that financial regulators play, or financial supervisors in particular, it's mostly a function of trying to see into complex systems that are very hard to understand with the tools we have and figure out what is happening in them. What are the risk trends? Where's the non-compliance? Where's the subtle fair lending mistakes? What are the, where's the crime? Where's the money laundering going on? These tools are going to bring massive, massive, massive transparency to all of these complicated systems. Some of that will be dangerous. There are hard things to figure out in terms of privacy and how we're going to keep information secure. Everybody here is going to be very busy for a long time working on the, you know, what are the governing structures and methods and principles that we need and so on. But the basic thing is it's going to become harder to hide both risk and misbehavior. I'll say also that these tech changes are coming amidst a larger disruptive environment in which we have a great deal of cultural and political polarization and argument in the country and in the world. And that backdrop is creating a moment where there's a lot of both risk and opportunity around change and disruption. And I think it's worth bearing in mind that things are changing, certainly in the regulatory community, a lot of things are changing. And there's a moment here where we can stand and say the system that has been slowly evolving over the years is potentially taking some sharp breaks and looking at doing some things differently. And that can be a bad thing, but it also can be turned to something good because there's an opportunity sometimes opening up to do things in new and better ways as well. My thinking to you, and I hope we'll have time for a few questions, but my suggestion for this community, which I know we have regulators here, especially in the room and online, and then we have other community advocates and activists and advisors and consumer organizations of all kinds, really, listening as well. We have to work as an ecosystem. We have to keep our appropriate boundaries between us, obviously, But these are problems that can't be solved through just regulatory protections. I've spent my whole career trying to advance consumer financial inclusion and protection through law and regulation. Before I was at the OCC, I worked for the Senate Banking Committee. I've spent decades working on trying to craft the right legal and regulatory environment to protect people and enable them to be included. And what we know is that's, again, necessary, but not sufficient. We also need to enable these new technologies and the demographic shifts underway and all of that to take us in a good direction. I'm going to end with a little story, and I think I might have told it when I spoke recently to another Fed group. So if any of you heard it before, I'll apologize for that. But I recently watched the TV show 1925, which is a spinoff of Yellowstone. And it's set in Montana, there you go, in 1925, at a time when new technology was just arriving in the West. So automobiles and electricity and refrigeration and so on had just shown up, indoor heat, indoor plumbing. And the people there were living in a mix of those two tech worlds. There were people who were living in wood cabins and getting water from a stream, and there were people living in fancy houses and flipping light switches and refrigerating their food. And there's a scene in it where Harrison Ford rides into town on his horse, and the city street is a mix of cars and horses and wagons. And he gets off his horse and he takes the reins in his hands and walks up to the curb, and he says, "Where are the hitching posts?" And they say, "We took them out to make room for the car parking spaces." And it's a moment that seems like a transition that may take a long time. That didn't take a long time. Once you had a better technology available to people, it got adopted fast. And a few years later, there would be a few people still on horses, but not very many. And this is the moment we're in now. We're living in a hybrid of old tech and new tech. And as regulators and other leaders in this space, we need to embrace new tech and deploy it, guard against the harm it can do, but also enable the good it can do. Vice Chair Bowman talked about innovation being necessary in financial services, and I agree with that. I think we need responsible and robust innovation. So do I have time to take a question or two?
Absolutely.
Great.
Open it up in the room, and then we'll go live.
Thank you.
Anybody in the room? Raise your hand, and we'll recognize you.
If no one has a question, I might call on my friends. Oh, there we go.
Thank you. So I'll take the privilege. So Joanne, you've sort of spent a lot of time in various camps. You know, you've the regulatory camp, the thought leader camp, you've engaged with practitioners all the time. What are some of the things that you think from an empathy standpoint that should be more leaned into to help people understand where, from a financial inclusion standpoint, we can sort of best align to help sort of unlock some of the value of some of these innovations or other aspects of like what's being built today to help us sort of make sure that we're building a future that's, you know, inclusive for people, but also being done in a safe and sound way.
Yeah. I love that you frame it as empathy, because I do think that's what we need. And I think the biggest, I would almost argue the biggest mistake we make is to stay inside our silos. And regulators are doing what regulators do, and lawmakers are writing the laws, and advocates are, fighting for consumers and so on. And you cannot solve problems like this inside any one silo. You have to have holistic approaches, and that does require empathy. And simple as it seems, one of the keys to it is things like this. We have to bring people together outside their silos and get them to understand each other. Some of you know my organization puts on a lot of like hackathons, regulatory tech sprints, and the magic in them, more than anything else, is that we enable regulators to sit down at the same table and work on solving a problem with technology people. And they don't normally get that opportunity, you know, and suddenly you can picture things that the other party knows of solutions that you don't have in your own tool set because you haven't had enough exposure to them. So I say just within the bounds of what's appropriate as regulators, take every opportunity you can to just meet and work with and learn from people who are doing adjacent but different work from yours.
It's very easy to be proscriptive, to say, hey, you can't have a deposit advance product. How do you think regulators should be thinking about being permissive in their regulation? Like saying, this is what an ideal principle for a small dollar lending program should look like, and yet not be able to see the kind of positive adaptation rather than everybody stops producing something you don't want produced?
This is a very, very important question. If I were in charge of the whole thing, I would actually change the missions of most of the regulatory agencies to include more of, I wouldn't point to the medical regulatory area as a model that does everything right by any means. But if you look at the mandate of the FDA, they are expected to try to make medical products and devices safe and effective. In the regulatory world, we mostly have the mandate to keep things safe. And if something isn't going to, if there's an innovation that could be unsafe, but could be a tremendous breakthrough, it's not usually within the remit of the regulator to put much emphasis on the second half of that. And I wish that we had that. It makes the job harder. I don't think any of you people should worry about AI taking your job, because I think you're going to have a lot of work to do. But I think that there should be an affirmative culture, at least, of trying to enable promising innovation to proceed. And then I think regulators should be trying to map out what does the pathway look like? What do you expect in terms of testing? What do you expect in terms of track record or running parallel systems before you can take your hand off something, that type of thing? And I do think regulators need to do that. Something I learned after leaving the OCC was how scared the industry was of me. I thought I had, good conversations with people, but I didn't know that, how intimidating it is to have especially your field examiners, in your bank. So if you just frown at people, they're afraid to do things. That's the reality of it. Did I see another mic? Guess not. All right. Well, I so appreciate you inviting me today. Again, just congratulations on a wonderful conference, and thank you.
Okay, that gets us started. Now, what we're going to do right now is a little unusual. We had a great 2 series of speakers. So although it's only early in the morning, I actually need to take a break. So we're going to take a 15-minute coffee break. We got coffee outside. Those of you online, please join us back here at 10:15, and then we'll set up our next panel. So thank you very much. Thanks again, Joanne. Great. Back from the break, so we're going to get started with our first panel. I told you we were going to talk with some thought leaders. This is what a thought leader looks like. In case you hadn't seen them out there, they're all over the place. So the idea of today's panel, which we're going to be talking about the tools of financial inclusion's ecosystem. We're going to be doing a little bit of that in some detail on this panel. So what we're going to talk about are products that and practices within the financial inclusion ecosystem, focusing on their evolution and the ways that they can further financial inclusion going forward. So the panel will discuss the role of regulation and what has happened in terms of helping banks meet their financial inclusion goals. So as Vice Chair Bowman started us out in her opening remarks, a focus on innovation and the tools that power them has and will continue to play a critical role in banks' ability to reach those currently underserved by the financial system. So we brought together some heavy hitters. So I said this is what a thought leader looks like. So please feast your eyes on thought leadership, because when they come at you and blow your let me just spend a few moments introducing looking like thought leaders they are. So Kelly Cochran. Kelly is the Deputy Director and Chief Program Officer at FinReg Lab, a nonprofit that conducts research on new technologies and data to promote a responsible and inclusive marketplace. So let me just say she's to my right, so welcome, Kelly. Next to Kelly's right, we have Kelvin Chen. He is a Senior Executive Vice President and Head of Policy at the Consumer Bankers Association, where he leads the organization's policy research teams. Kelvin has been a thought leader on a variety of topics at the intersection of financial inclusion and innovation, including financial health and consumer protection. Now, a little bit of a plug here. Notably, Kelvin is an alum of the policy group within the board's Division of Supervision and Regulation. He also has extensive experience, at the intersection of innovation and regulation at the CFPB and Barclays and Capital One. Last but not least, we have Alex Johnson. Alex is the founder of FinTech Takes, which explores trends on financial technology and the future of financial services through newsletters, podcasts, and an online platform for the fintech community. Over the past few years, Alex has written extensively on financial inclusion topics, including the power of using alt data to power credit underwriting. Okay, so this session is structured whereby each panelist will spend a few minutes discussing their points of view on a variety of topics at the intersection of financial inclusion and regulation. This will then be followed by a little bit of a moderated discussion, which I will lead, and then we'll end with Q&A from anybody here in the room. So with that, I'm going to start with Kelly first, and then we will go to Kelvin, and Alex will wrap us up. So Kelly, welcome, and you have the floor.
Thank you. Thank you again for the invitation to speak. I'm really looking forward to this today. I'll talk just a little bit about the work that we at FinReg Lab have been doing on data and technology for financial services with a particular eye on financial inclusion. Much of our work has been focused on the use of alternative data and machine learning in credit underwriting, which we know is a particularly important use case for helping households and small businesses both bridge kind of short-term cash flow gaps and make long-term investments in kind of a more stable and healthy kind of long-term financial life. We have been looking at things like cash flow data for credit underwriting in both the consumer and small business context, starting with a 2019 paper where we were looking at data from several fintech and CDFI lenders. And more recently, this spring and summer, we've put out new papers on both small business and consumer credit underwriting. We're also looking at the use of machine learning techniques, which are deriving kind of more subtle relationships in the data, potentially, than more traditional logistic regression and scorecard methods, to, again, be able to score and underwrite and identify additional consumers and small businesses that are able to handle credit and where it could be productive for them. So our results have been really positive. We're seeing substantial lifts, and particularly most recently with the paper we put out just on July 1st, focusing on both the machine learning and the small business, machine learning and cash flow data. For consumer underwriting, we were finding substantial increases in predictiveness, about 2% for machine learning, and that led to increases in credit approvals as well. We did simulations at different levels for different types of lenders, and for mainstream bank lenders, we found that it would increase, projected that it would increase approvals by as much as 4%, so a really substantial number. We also found that the cash flow data potentially helped increase approvals and predictiveness as well, although we had some limitations on our sample as to seeing people without credit files and thin files who are the most likely to benefit from that kind of data. But even with those limitations, we were seeing improvements. And the two combined had the strongest effect at all. So we're continuing to see a lot of impact on this, both from our research and from the marketplace, as we're seeing more and more vendors and different parties come in and potentially help lenders through the process of deciding what works for their particular, market niche and programs in ways that can both improve the predictiveness overall and improve credit inclusion and reaching some of the consumers and small businesses that struggle. We think this is particularly important for smaller loans, whether it's microloans on the small business side or smaller loans on the consumer side. We know the economics are most difficult there because of the size of the loans. And so making sure that the predictiveness is as strong as possible, that we're both identifying more applicants who can manage the credit and would benefit from it, and we're doing a better job of identifying which applicants might actually struggle with the loans. It's really important to the long-term health of the system. It benefits both the lenders and the applicants potentially. So we're seeing a lot of growth in those areas. Beyond that, and we can talk more about this later, we're seeing a lot of interest in supporting technologies that potentially help with underwriting, but also other types of financial services. So things like large language models and generative AI, which a couple of the previous speakers have spoken with, and also agentic AI systems, which are often combining either things like LLMs or kind of more traditional supervised machine learning models, but also with agents that can go out and take action on behalf of a financial services provider or on behalf of a consumer, potentially open a whole new range of options to really improve the effectiveness, the efficiency of financial services providers' operations, and at the same time potentially help households and small businesses manage their finances on an ongoing basis. So I think we're seeing tremendous innovation and interest. It is very hard still, especially for smaller institutions, to figure out how to manage these technologies, these new data sources. And so I think that's one of the critical questions that we face going forward is to see the kind of entire ecosystem migrate. How do we help some of the smaller institutions, which often really do a good job of focusing on underserved populations, but often have limited technology and resources to work with. So I know there's a later panel on this, but I'll just say briefly, one of the papers we put out in June was a paper focusing on the use of data and technology by mission-based organizations, CDFIs, minority depository institutions, smaller lenders who are really focused on underserved small business microlending and some of the ways that they're using the technologies and the challenges they're facing. And I think there's a much broader range, even than the people we were focusing on in that paper, more broadly, that we have a lot of smaller institutions, lenders or other types of financial services providers who want to see the growth and the potential, but potentially have challenges in kind of figuring their way through the process of managing vendors and managing the technology. I'll stop there.
Thanks, Kelly. Calvin, some opening remarks.
Sure. And I should start by saying thank you. I mean, thank you for having the conference. Thank you for having banks at the conference. Thank you, Art. I mean, I'm almost sheepish because in my typical bio, I've got, like, Kelvin created the innovation policy team in SNR at the board, and I didn't. You did. And I wrote a memo. Like, I wrote a memo that you approved, like, after a lot of cajoling and pleading and begging. So Art, thank you.
We're good.
Yes, sir. So, to start with, I really like the way that you started out to continue me being a sycophant, where you said, look, financial inclusion means a lot of different things to a lot of different people, right? Because when you look at the numbers to start out with, objectively from pure financial inclusion measures, and Joanne kind of mentioned this, we're doing okay, right? Like the FDIC survey of the unbanked said only 4% of consumers are unbanked. The CFPB new leadership finally released the long-awaited correction to this credit invisibility report showing that only 3% of Americans are actually truly credit invisible. And so, by all measures, we're in a world in which you've got tail end folks that we got to take care of, but the tools there may be different, right? Because like if you look at things like the people that have a crippling fear of flying, that's like 4%, right? People that have like no teeth are like 2%, right? So there may be like particular tools that we may need to get at those populations. That isn't to say that everyone's doing okay, right? And so For folks that are online, and everyone here, I'm sure, is a Shed super fan like me, but for folks that are online, there's the Fed's Survey of Household Economic Decision Making, and if you're watching this, you should be reading that, because that is kind of ground truth as to how Americans are doing. And when I read that, you see a lot of kind of pain and a lot of struggles that people are bearing with, but what I would note is that it seems like a lot of that is happening outside of the regulated financial space, and there's a question as to, okay, how do we help them with those issues? I represent banks, and so maybe it's not a surprise that you will hear me say, when you regulate and you over-regulate, you may make it harder to offer services to people that will give them shock absorbers in that space. Other people, I know, view that differently. One thing I think we can agree on, and this is where the Shed is extremely helpful, is at least realizing, kind of separating out what's big and what's small. So, I'm going to go through what I think of as sort of like the 4 horsemen of the apocalypse that I see in the Shed. And the thing I would note there is, as I go through this, there's a question as to, one, whether banking products are the things, like if you could wave a magic wand and change anything you could change about a bank, could you still fix that issue? And then 2, like, what is the scope that we're dealing with, right? So Rohit Chopra, that was at the CFPB, waved his magic wand, and one of his things was overdraft. And so he set prices on overdraft that would have drastically reshaped the market. But even by their best measures, it would have only saved consumers $250 a consumer that overdrafted, right? And so, like, holding that $250 in mind, like, I'm just going to quickly kind of run through the 4 horsemen, right? One is housing, right? So the Shed shows that annual housing costs for Americans were reported to be $1,200 a month, but importantly, we're raising 10% a year. If you look at census data, that 10% is rising much more fastly than incomes for white Americans, which was at best rising at 6%, and for African Americans and Hispanics and Asians rising at 0%, right? And so when you're talking about increases of $120 every month over an annual cycle, again, like, how does that overdraft stack up? So it's kind of the point where, Pew says that like 30% or half of renting households are rent burdened, and it's kind of no surprise that people have kind of given up owning a home these days. Childcare would be the next cost. And so for people that pay for childcare, they pay for about half as much as they pay for housing. And the thing I would note is that some people pay a lot for childcare, some people pay nothing for childcare because they have grandparents that live nearby. But it's just very weird that we have this very random element to our society that kind of by proxy of where you live or whether your parents are alive, that you have this kind of huge, I wouldn't even say it's an income shock because it's something you've got to deal with, but this huge expense that you've got to then navigate. In terms of true shocks, medical expenses. So the Shed found that nearly 30% of adults skip medical care due to cost, and that includes 14% of people making over $100,000 a year, right? So this isn't just a low-income issue. This is ordinary Americans. 1 out of 5 Americans had a major unexpected medical bill over the last year, and that bill had a median cost of $1,000 to $2,000, right? So again, let's hold that number in context of kind of the purported savings from some of the regulation that we saw. And then finally, student debt. Right, so federal loans are kind of foisted upon students. They're handed out like candy at Halloween without any consideration of ability to pay, and it shows. Right, so 1 out of 5 consumers were delinquent or in collections on federal debt. 1 in 4 people who didn't complete a degree still carry debt, right? And they don't have the presumed income boost from finishing school to kind of justify that debt. And the thing that kind of shocked me is that from the Shed, 1 out of 20 adults hold student loans for someone else. Right, so you hold a loan for a child or a grandchild that you've underwritten, and oh, by the way, that debt is not dischargeable in bankruptcy for the kid or for you. So, the thing I would note is that these are long-term issues, right? I think the banking system is really good. Like, I'm a huge fan of credit cards, but credit cards are meant to be shock absorbers for short-term debt, and they're really great at that. But these are long-term issues where, my argument is that banks can't fix that alone. Like, you can't loan people out of these situations, right? This is an income issue. This is a bigger issue. And so my concern is that, just working with regulators to try to come to solutions towards new tools, because too often in the past, regulators have reached kind of within, and this harkens back to Joanne, they look at their silo and say, okay, what can I do within my silo? And usually it kind of comes to kind of 2 things, right? Like usually price setting, right? But when you price set, my argument is that restricts access and services, right? And we saw this with debit interchange. So when the Fed set interchange rates in 2010, we saw the availability of free checking accounts fall by 30%. And this isn't our data. This is Natasha Sarin, who worked in the Biden Treasury. We saw monthly checking account maintenance fees rise by 50%, and we saw min balances rise by 20%, right? And so so the question is, right, like, let's talk about the tools and let's think about like how we truly unleash that financial future. And I'm really excited about the opportunity to have these conversations and to kind of work with regulators to try to collaboratively unleash that future.
Thanks for that, Calvin. Moving to Alex for your opening remarks.
I'm very upset I had to follow Kelly and Calvin. That doesn't seem fair to me. He has notes, he's got facts and figures. This is not fair. I was not told this was going to happen. No, I mean, I totally agree. I think that the thing that strikes me about financial inclusion in the U.S., building on your point about the rate of unbanked households, we're doing really good on that number, right? That's going in a really good direction. We're making significant progress, right, over the last, 10, 15 years on getting that number down. It's probably never going to be at zero, unfortunately. We can continue to chip away at it. But when I look at financial inclusion in the US, it doesn't seem like a problem of scale. It doesn't seem like a problem of motivation, right? A lot of times when I look around at problems in the financial services ecosystem, the thing that strikes me is, you can tell the company they should do that, but they're never going to do that because it doesn't line up with their business model. It's not aligned with their incentives. They don't have the motivation to solve that problem. Financial inclusion is not one of those things, right? We have a very competitive ecosystem in the US between banks, credit unions, fintech companies, other non-bank participants. It's incredibly competitive. There's no company I've talked to in the financial services ecosystem who says, oh yeah, that group of customers over there who you say is profitable and be great to work with, yeah, we don't want to work with them. Like, that doesn't really happen. Everyone is in a knife fight trying to get as many customers as they can and grow as quickly as they can. So I don't think it's a problem of motivation. The things that occur to me when I think about financial inclusion in the US are structural problems, right? So what are the structural barriers that exist that makes serving that population, even though we know they should be using more mainstream financial services products than they are, why aren't they? How do we get to them? What is the gap in our understanding of them, our ability to evaluate them, our ability to work productively with them? There's some structural barrier there that's stopping us. What is that structural barrier? And then the other aspect, and I think it's related to the structural barriers because everything exists in a sort of ecosystem and they feed off of each other, is the psychological element of financial inclusion, right? And I've spent a lot of time writing about and doing research into what I kind of call financial nihilism, right? Which is this growing idea, I think, on the part of consumers, particularly younger consumers, that they don't have any chance to build wealth or to build strong financial health and habits, that they can't get money to turn into the things that they want, right? And that nihilism drives a set of really negative downward spiral type effects, whether it's speculation, gambling, excessive spending, not a focus on long-term outcomes, whatever you want to describe it as. All of that, I think, stems from this kind of nihilism. And to be frank, there are companies in this ecosystem, both banks and non-banks, that profit off of and encourage financial nihilism, right? If someone is, and I think Joanne mentioned this before, if someone is included in the system, but that inclusion has this sort of dark nihilistic feel to it, that's not what we mean, I don't think, when we are getting together and talking about how we advance financial inclusion. So I'm very focused on the structural components that go into preventing more inclusion or preventing people from climbing up that ladder, and the psychological impacts on consumers of not being able to climb up that ladder and make the progress that they want to make. And I'm sure we'll get into a lot more of that.
Okay, thank you all for your opening remarks. I want to jump right into this comparison of our current financial ecosystem, the landscape, so to speak, and these longer-term solutions. So each one of you have posed giving comments or posed a question, like where we are today as opposed to where we need to be. Some of it's been structural, some of it is actually other data that we have, some of it is actually the utilization of alternate approaches. So from your perspectives, what are the things we need to get to those longer-term solutions that can be done through financial institutions. So I'm going to open up for each one of you to comment on that. You've all had a slightly different perspective, so I'm going to start in a weird order here. I'm going to start with Kelvin, and then I'll hit Kelly, and then I'm going to hit Alex. Well, I'm going to do this a little different. I'm going to start with Kelvin. Alex is not feeling a whole lot of love, so I'm going to go to him
don't make
second.
me go last
And
again.
then,
That wasn't fair.
we'll mix that up. And Kelly,
Okay.
it's okay with you. We're
Yeah.
going to do that. So Kelvin, why don't you start us off, then we'll go to Alex.
All right, so when we did the prep on this, Art added a prepositional phrase, being what are the solutions that could be done within financial institutions, which that's not fair, because I think
open it up.
because
We
I
can
think
open
the
it up.
argument here, right, is that it's that the tools are really they're very. And I think that's the issue, right? Is just trying to kind of focus on right-sizing the tool for the right problem. And I like the title of the conference today, Unleashing a Financially Inclusive Future. I think part of this is like how can you help unleash like businesses and markets so they can help address these issues, and it's not quite saying like, hey, like let us cook. But it's almost like saying, well, let us at least compete to address these issues. Because when it comes to a lot of these shock absorbers that we need to offer consumers, I think it's really important that we allow businesses in a safe and sound and consumer protective manner to be able to be there to be those shocks for folks, but to recognize that we are going to need a different set of tools for those longer term solutions. And for those, I'd argue that those are kind of outside of the financial system. And so, I would point to Jamie Dimon in a shareholder letter 2023 closed it in kind of a really interesting way, because he so as I'm putting out reading lists for people on the internet, so read The Shed first, but then go read Jamie Dimon's shareholder letter. It's this, typically it's a wonderful kind of one-stop shop as to the world of financial services and what's going on. But in 2023, he closed with two recommendations that were that were outside of the financial system, right? And one, he said, gosh, we got to start grading schools, high schools and colleges by how well their students do and how they earn, including students that don't graduate. Right, we got to hold them accountable for that. That's a pretty remarkable change, right? Because when you think about how we've done federal student loans, we just kind of give you this student loan, you can borrow up to a maximum amount, and so of course the colleges and trade schools will raise their tuition, so they'll take as much money as they can, without much accountability for kind of how you fare afterwards, or even if you finish. But the other thing that Dimon recommended is he said, hey, we should increase the earned income tax credit and untether it to whether you have kids or not, right? And convert it so it pays out monthly. So it's like basically a monthly set-off for other, basically a negative tax. And that I think is kind of remarkable, because there you're talking about addressing poverty by giving money to people that need money. And I think that it's a cleaner solution. And importantly, one of the things that we saw during the pandemic, there's this, here I'm spitting out reading lists. There's another book. Scott Fulford, an economist at the CFPB, wrote a book called The Pandemic Paradox. And so Scott runs this really interesting survey that's almost as good as The Shed. It's called the Making Ends Meet survey, where they take anecdotal data from survey data from consumers, but also they have data access to their finances and their credit reports, and they actually look to see how they do. And what Scott found is, surprisingly, the pandemic actually but low-income consumers came out of the pandemic better off than they did going into it. And it's because a lot of the stimulus programs put money in their pockets, and also consumption went down. But particularly when you've got lower income consumers that have very low savings, it doesn't take a lot to give them that buffer zone where they can start kind of participating in ways that Alex mentioned, having that kind of ability to engage, to participate, that motivation, that comfort level, the safety that Joanne mentioned. And so, I'm sorry to kind of do the classic, I'm going to answer the question I want to answer, but I think the answers lie outside of financial regulation, and I think that's sort of the tricky part of the answer.
Well, you covered both, by the way. You did repeatedly mention Jamie Dimon several times, so I don't know if you noticed that, but basically...
They are a member.
They are a member. Okay, that's financial institution. Alex, what are your thoughts?
So you opened the door on Chase. I'm going to come back to that later. But before we get there, I mean, I think to answer the question, this is an analogy.
You can modify it a bit.
I apologize because I'm just going to go off script for a tiny bit. But when Warren Buffett was describing Disney's business model, the thing he really liked about Disney's business model was you'd make a movie like Snow White and every 7-year-old in the country would see it. And then next year, a whole new generation of people would turn 7 and they would see it. And he described it as an oil well that continually fills back up with oil, right? So it's this sort of ongoing thing. I find it really fascinating in financial services how little time we spend talking about on-ramps, right? Because the reality is, if you think about what's the group of consumers that are always outside the financial services system and are coming into the financial services system every single year, it's people turning 18, right? It's people going to college, it's people graduating from college. Like, there are these life stages where you are getting introduced to financial services products for the first time. And maybe you had the benefit of parents or others in your life who sort of gave you a little bit of an education on that. I certainly did. Maybe you didn't, but the reality is the products you interact with first really shape how you think about the ecosystem, your behaviors, and just like your attitudes about financial services, your psychology for financial services. And so when I think about different areas, right, I think about investing. Is investing supposed to be fun or boring? Well, depending on when you turn 18, you'll get a very different answer to that question, right? Fidelity's answer is it should be boring. Robinhood's answer is it should be really freaking fun. Those are two different things. And the long-term effects of those on-ramps being provided by different companies with different incentives are going to shape an entire generation of people and how they think about these things, right? I was noticing that we just launched, as part of the Big Beautiful Bill, investment accounts for babies, right? Fantastic. I love this. This is amazing. However, I got a little scared when I saw that Robinhood had already built a pilot for that, because now the $1,000 that these babies are getting is going to go into a Robinhood account, and when they're 18, they're going to get introduced to meme stocks. Wow, look how fun this is. So, like, there are problems with that. If you think about home ownership, right? You mentioned that as like a critical lever in American society and in our economy. I got to tell you, there's really not great on-ramps out there for, well, what do I have to do to own a home, right? Saving up for a down payment, especially given the cost of housing, that's going to take a long time. Now, it doesn't mean it's impossible. People shouldn't be nihilistic about it, but you should be realistic about it. I don't know of that many apps or products out there that aren't a mortgage and aren't a mortgage broker. It's the thing that you need 5 years before you talk to a mortgage broker. I don't know where that product is, right? The third example that occurs to me is, you mentioned your love of credit cards. I think BNPL is fascinating, right? And I have a love-hate relationship with BNPL. I've written about it as therapy for myself multiple times in the newsletter. But the thing I always come back to with BNPL is 18-year-olds are using this product, and it's their first exposure to credit, payments, e-commerce. Like, it is educating them on the way in which credit and filling these short-term liquidity gaps, how that works. What are the incentives of BNPL providers? What are the structural incentives created by that pay-in-for product structure? Again, it's too early to say, but I think we don't spend nearly enough time thinking about the effect that on-ramps will have on the long-term trajectory of all of these new generations of consumers who are entering the market.
Wow. I want to come back to the accounts for babies. I'm going to possibly talk a little bit about myself during that period of time. But the idea of what you just pulled together, like when we do that, I do want to come back to that. We start much later than other societies, and or we don't explain that as a condition to being an adult.
Yep.
But I don't want to steal the thunder, because I know you're going to bring it, Kelly. So let's go ahead and see what you got to say.
I mean, obviously, given our focus, data and technology is the first place that my brain goes. But I actually want to talk about something different, which is trust. And I think it relates to some of the things that Alex is saying, but I think I have a little bit of a different take on it than you do. I agree there is, and I think the kind of the generations of people who are aging into the financial system right now are potentially quite different than 10, 15, 25 years ago and have a different experience. And so I totally think what you're saying is an interesting question. But I do think, particularly when it comes to low to moderate income households and families and smaller businesses, there is also a question of Does the system really work for them? Is it designed for them? And if not, how does that perpetuate and cause disconnects that are much broader? And I think a great example of this was the PPP program during the pandemic. Like, we saw who got the first set of loans and who didn't, and it was small businesses that didn't have super strong relationships with, depository institutions, and we spent a lot of time over the next 18 months trying to figure out ways to get beyond that problem. And so I think data and technology are probably the biggest single lever we have, but they do not solve everything. And if we aren't thinking about the relationships, the trust, the tailoring, you're right, there is a lot of competition in some areas, but I think low to moderate income families have particular needs, and some of the things that we're seeing designed are really not meeting their needs. And if we're going to do a good job of it, we need to think about not just what financial kind of banking system data are we thinking about, but how are we thinking about government benefits data, workforce benefits data, all of those other questions, because the information is growing, the infrastructure is growing, but if we're not using it effectively to meet the needs of different groups of people, then we're still going to have pockets where we are really not maximizing opportunity for households, for small businesses, and for the broader economy, and frankly for financial services providers too. So I think there's some things that, while there is a lot of competition in some ways, I think there's some things that are getting overlooked and are really important to think through here.
So each of you, I'm sorry, Kevin.
Actually, can I just jump in on on-ramps?
Go ahead.
Alex's point about on-ramps, I think and buy now, pay later is just a really good framing, I think, to kind of, as we think about the inclusion issue. So I go into these financial inclusion conversations, and I was in one a couple months ago where you're kind of supposed to go around and talk about the thing you're most excited about. And so, someone said AI, someone said nanotechnology, someone said, straight 1995.
Yeah, conference were you at, man?
Yeah. And I pounded the table and I said, I'm just so excited about credit cards. And people were like, okay, that's the banking shill. But when we talk about financial inclusion, right, when we talk about credit and visibility, I just want to talk a little bit about what credit cards have done, right? And this isn't, I'm making a point here, this isn't just me shilling for credit cards. We went from what was likely a kind of 10% credit visibility number down to a 3% credit invisibility number. And one of the things that the CFPB did in 2017 is they said, okay, how do people become credit visible, right? So like, what are the tools there? How can we replicate that, what worked? And so Ken Brevoort and that crack team looked at the tools that brought people kind of visible onto credit rolls, and they found three things. Credit cards by far were the primary way that people became credit visible and started building their credit histories. The other, kind of the second and third things were student loans, which from my earlier comments, you can kind of guess how I feel about that. And then third, collection on non-financial debt, right? So collection on like your cell phone and things like that, which I think we could all agree isn't the best way to become credit visible. The other thing I would note is that the CFPB Card Act report, I asked my 14-year-old to watch, and so she's got like a 5-item reading list now. So the CFPB Card Act report, the most recent one, showed that not only were credit cards able to kind of bring people in by underwriting more deeply into subprime over the last decade or so, but they were able to do so in a way that made people better off than they were before, right? So if you look at now versus even kind of pre-pandemic, more consumers are paying total balances on their credit cards each month, and so you've got more people that are transactors, and of the people that are revolving, that are carrying balances each month, more of them are paying higher rates on their monthly bills than they have before, in large part because the private sector has increased the minimum annual payment requirements, kind of voluntarily having people pay more into their balances. So whether you believe me or not, my argument is that credit cards are like at least a tool for getting people in these on-ramps. The thing I would note is we have buy now, pay later. And buy now, pay later, I think everyone that follows the space knows that they start with the young ones, right? They kind of make a killing with like mall kids that are, and this is in many cases their first exposure. And that's because credit card companies can't market to these kids, right? So my boss is right now is testifying on the Hill about the 15-year anniversary of Dodd-Frank. One of the first kind of financial regulatory reform packages that went through before Dodd-Frank was the CARD Act. And the CARD Act was this big reform of the credit card market that said, among other things, we're going to make it really, really hard for someone under the age of 21 to get a credit card. You basically have to kind of have a job or you have your parents sign on for you. And so it's prohibitively difficult for a kid to get a credit card. Which is now why BNPL, whether you like it or not, right? We have kind of this morality story as to whether BNPL is the right on-ramp or not. But it's because we've kind of kept credit cards from reaching that population that you have this new thing that may be good or bad, right? And so this kind of goes back to this, notion I said before. It's not quite like let us cook, but at least when we think about regulation, like let us compete in this space to serve consumers.
I know both Kelly and Alex want to get in on that. That's a good intro to all data, but when he was going on the credit card path, I know you'd eat that up and say, is that the right measure, right? Credit visible by getting a credit card, or there's an all data alternative? And Alex,
Sure, there's lots, but do you want to go first?
Well, so I will just say, because it drives me crazy, BNPL companies don't furnish data to the credit bureaus, so that is not playing nicely with the rest of the ecosystem. That is not treating your product as an on-ramp for younger consumers.
It's not growing the consumer.
It's not. It's trying to trap them in that BNPL ecosystem and never let them out, right? So I think that is an indication of, and this kind of goes back to your point about where do you apply regulation in a thoughtful way. I would be very much in favor of regulation that required furnishing under certain circumstances, right? Right now, there is no mechanism to force companies to furnish data, and we're seeing that if you're a company that was founded in the age of the internet, you understand how valuable your data is, and you don't just want to give it away to your competitors for free, right? And so there are, I think, updates from a regulatory perspective that are important. The other point, though, to your point about like wanting to compete is, I actually do think we've seen a positive impact from BNPL on credit card as well, because one of the other things that's come out of the CFPB's research on the credit card market is the surprising adoption of the installment lending feature that's being added to a lot of credit cards. And that is entirely a function of the credit card issuers being scared enough of BNPL to pivot their product in a way. And I think they just kind of added it on just to say, look, we're paying attention to BNPL. We know it's coming. It turns out consumers really like the ability, to your point, to mostly be a transactor, to not revolve, and when they have a big purchase, to finance that purchase and to know what the costs are. And so I think credit cards have actually gotten better as a product because of that competition.
I'm just excited to hear your comment on that. So have I baited you enough on the alt data and credit card usage?
Sure. Well, I mean, I think alt data is a really broad topic that bridges across multiple things that we've talked about. So I'm not sure I'm going to frame it solely in terms of credit cards. What we've been focusing on in particular is the use of electronic bank account data. But we've also done some work in looking at rent, utility, telecom data, which it can overlap. You can get it from the bank account information, but there are other ways that you can have it furnished directly. Buy now, pay later data is obviously a potential source of information, both about credit repayment, but also debt load, right? And I think that's the other reason why we are starting to see credit scoring systems build it into their models as best they can with the data they have. But the bigger problem is there's not much data there yet, and that raises two sets of questions, I think, for lenders, potentially. So, this is one of those places where I think the existing system, just has a lot of gaps, and we see people fall into those gaps. We know that cash flow data is something that people have used for generations, for a long time, kind of predating credit scores, as part of their underwriting practice. But people in many markets, particularly credit cards, have gotten so focused on quick underwriting, quick access to data that they've kind of narrowed their focus to particular sources and maybe aren't looking more broadly. A lot of our research is focusing on the potential advantages of doing that. And for instance, in the most recent report that we studied, we did build some cash flow only data models. They were pretty predictive. They're not as strong as cash flow plus credit bureau data when both are available, but they are a way to start underwriting people potentially. And, you know, particularly in small business as well, people have used cash flow data forever. This isn't really alternative in any sort of normal sense. What's alternative is how you're accessing the information. Is it coming from spreadsheets that the borrower is providing to you, or is it something you're pulling kind of automatically from the bank? And is it an electronic form where you can do a much more sophisticated form of analysis with it, potentially, than kind of the traditional sources? So I think both in terms of the spectrum of information that's available about the borrower and the speed at which you can access that information, digest that information, both of those things have really important implications for inclusion. Turn back to small business just for a second. Like I said, people have been using cash flow data forever, but if it takes you weeks or months to collect all the information from the borrower before you can decide whether you're going to make them a loan, that has an incredible impact on small businesses and whether they get the the funds they need to manage cash flows and everything else. And so I think there are inclusion plays both in getting data that is more accurate and tells you information, fills in those gaps, allows you to have a more holistic picture of the applicant, and also being able to do it in a way that's less burdensome, both on the applicant and on the provider, so that, you know, we can get assistance to, especially in kind of the short term, you know, kind of bridging cash flow sense to those kinds of loans more quickly when it makes sense to grant them. So.
Before you move away from that, though, you alluded to a little while ago about not using the system effectively. I wanted to pursue that. You mentioned gaps, and then you were pulling that together. So tell us a little bit about the things that you think we're not doing to utilize that.
Well, I mean, the traditional system of credit bureau data has grown up over time, and it is a powerful tool when the information is available, but it does have some gaps, like we've talked about. Some people aren't in the system. We know that the number of consumers who are completely invisible to the big credit bureaus has actually been dropping. The CFPB just released a report pretty recently that shows that that's dropped fairly substantially over the last 10 to 15 years. At the same time, the number of consumers who are still probably struggling to access kind of mainstream credit because they either have thin files, so they might be scorable, but it's less confidence around that scoring, or because they have damaged credit records, is still probably north of 50% of the population. So we've still got a big population of consumers who are going to struggle to access credit when they maybe most need it at affordable prices that can kind of really help their long-term financials health. The other question is kind of tailoring for the particular lender, and you know, lots of people are relying on kind of traditional mainstream third-party scores, but machine learning, there are other ways to potentially develop, you know, systems that are more tailored to the individual lender and more tailored to the individual population. And then the last thing we know is that traditional data is really focused on past use of credit and to some extent collections activity. So if a consumer is not paying a bill and it goes into collections, it may show up, but traditional just bread and butter month after month rent payment, utility payments, telecom payments are not usually captured. So we're not even capturing the full spectrum of the consumer's recurring obligations, let alone other aspects of their income, their reserves, and those kinds of questions. And those are some of the reasons that people are really interested in cash flow data. It can also show you things like buy now, pay later payments, which are hard to get through the credit bureau system right now. So there's a range of other things that we could be using here to get a broader perspective on the consumer's finances, on small businesses' finances, and then, you know, underwrite with more nuance, like I said, to both identify the credit-worthy folks who are slipping through the system right now because the lender isn't confident enough to underwrite them or even to market to them, as well as making sure that we're doing a better job of identifying applicants who might actually really struggle with the credit and maybe this isn't the appropriate product or the appropriate time for them. So.
Okay. Alex, you intrigued me when you mentioned that psychological component. We don't get an update on it, so I'm not sure how we would go about it, but you seem to have got some thoughts there on how we could be measuring that and how do we compare not just those who are currently in the financial ecosystem, but those who are coming in. hit a little bit on the psychological component there. I said from a child I was intrigued by this, but now I'm not a child. So I need you to lay that out for me a little bit more. What are we missing on that part? Longer term, we need to fix.
Yeah, I mean, the challenge is we only tend to ask consumers the questions that we selfishly want to know the answer to, and we don't ask them the questions that they want to answer, I think, sometimes. And so, like, to give you an example, a while ago I fielded a consumer survey. I think we had about 1,200, 1,500 responses, so it was statistically significant enough to give us some directional feedback. And the instruction I had for the company that created the survey was, you're not allowed to ask about any bank products. You don't get to ask about bank products. Ask them about money, but don't ask them about bank products. And so they had to come up with all these other ideas for questions, right? And so we asked them, what is preventing you from developing a strong relationship between money and your personal happiness? What causes the most stress or anxiety for you as it relates to money? What's something about money that you don't understand? So we asked them all these kind of open-ended questions, right? So again, not as quantitative, more qualitative. We did interviews, we did surveys, and what we found was that consumers have an entire hidden universe of what I would call financial adjacent problems that don't fit neatly into the boxes that we've built, right? And if banks and, to be candid, fintech companies have a weakness, it's that we all tend to sort of like to innovate within the boxes that we understand, right? And regulation tends to solidify the edges of those boxes, right? You are only allowed to offer a credit product if it fits into these three categories. We don't understand anything else. We see this with earned wage access. We see this with BNPL. These things that don't fit into categories, we tend to whack them with a hammer until they fit into a category. But consumers don't think about financial services or money that way. They think about it in terms of the impact it has on their lives, right? So when we asked them, what is standing in the way of a better relationship between money and happiness, some of the things that they talked about. One was, when I compare myself to other people, I feel like I'm behind, right? So what is that really getting at? It's getting at the fact that today, unlike previous generations, we all have devices in our pockets that allow us to instantly compare our lives that we understand every aspect of to the very best aspects of other people's lives who we may know or not know that they're broadcasting to us continuously. What is the psychological effect of that in terms of how you make spending decisions, saving decisions, investment decisions? I haven't seen good research on that, but that's a question I would like to know the answer to, because I do know that consumers say it makes them miserable, right? Another one that came up that I thought was just fascinating was, I want to figure out how to use debt more productively. I thought that was really interesting, because what they were getting at was this idea that they know there's certain types of debt that they can use to advance their financial goals. And then there are other types of debt that are like toxic traps that they don't want to fall into. But the problem is, absent direct experience or significant knowledge, they have no ability to discern those two different types of debt, right? Debt all looks the same. If you listen to Dave Ramsey, all debt is evil. They didn't really think that, but they knew that they needed a better way to parse out how to use debt productively. I was thinking about it when I saw the reaction to that and those survey results. Is there any product or tool in the financial services ecosystem that explains to consumers when and how to use different types of debt in an optimal fashion? Not really, right? Because the problem is, whether you're a credit card issuer or a BNPL provider or an installment lender or an auto lender, you're saying, well, my debt product is the one that you need. That's the one that's going to solve all your problems. Overdraft fees work. Overdraft protection works great in some circumstances, right? When it's used intentionally, it's amazing. When it's used unintentionally, it's horrifically bad. And so the question is, how do you guide consumers to use the right products, and how do you guide the market to develop new products that sit outside these categories that address some of these lingering kind of psychological challenges? Because I think there's a whole universe of those problems that exist that we're kind of blind to because we tend to think just in terms of the products we have.
Can I throw something out there that's kind of off my notes, but kind of riffing off of Alex?
Related to the psychological element?
Yes,
Go
sir.
ahead and try.
You know, only because we have like captive here a bunch of PhD economists and analysts that write on interesting things. One of the things that we've been struggling with over at Consumer Bankers Association is trying to understand how consumers learn about financial health and financial habits and financial products via social media places like Reddit and TikTok. So, I mean, one, I'm an avid fan of like the subreddit, the debt subreddit, as well as the credit card subreddit, because it always kind of helps keep me focused on like what at least ordinary Redditors are dealing with in their daily lives. I query whether that's a good sample size as the general population. But we ran a TikTok and Instagram campaign last year. Part of this was because the administration at the time was saying that the credit card industry wasn't competitive and consumers didn't understand their choices, and they were foisting kind of regulations like price caps and setting prices on the notion that people didn't compete. And we were like, golly, people compete, right? Like there's 4,000 banks that are out there competing for your business. There were $53 billion in balance transfers just in the credit card market alone, where most of which were 95% of which were for 0% APRs with fees of like 1.3%. But why do people not know this? How are they talking about this? And so we partnered with about a half dozen influencers on TikTok and Instagram and had them kind of run advertisements to see like what would work. And so we had this young woman I'd never learned this format. There's a get ready with me thing where she's like putting on makeup and like talking about credit cards.
I love this. You like learning social media.
Oh my
This
gosh,
is fantastic.
And this is again, like I keep shouting at my 14-year-old that hopefully she's probably tuned off at this point if she was ever on, but like she was like kind of like my spirit guide through this. But then it was also a good lesson in sort of branding, because like where we kind of settled in is like there's this one fella, Bo, who was a wonderful guy, and he's a dad/granddad that gives kind of life advice. And I was like, oh, that's kind of our branding, right? The guy in pleated pants, like on the farm, trying to give life advice. But the thing I would note is that he did this one video on balance transfers where he's like literally making seasoned bacon while he pours orange juice from a 28%, 30% pitcher into a 0% pitcher, and then tops it off with a little bit more orange juice because you got to pay the fees for the 1.3. Reading the comments on that was remarkable, because I mean you had like I'm going to butcher the numbers, but like thousands of comments. And he already has like a pre-existing and very active subscriber base, but people that were saying like I always thought balance transfers were a scam, but now I get it, and I can see how this could be helpful, right? And then other people that were talking very candidly about their experiences with debt, and then responding. I mean, you would have like message thread, because you had the ability to reply, so you can kind of nest it in, that were like messages that were like 20 messages deep, as well as like plus all the emojis that go on top, where people seemed really earnest and eager to learn. The downside to that is that, I mean, we wanted to write a white paper based on what we found, just like a qualitative white paper, but you can't scrape the comments because of IP and AI stuff, although you might be able to, Fed. So I would just note, I mean, it's fascinating because like there seems to be something there, because banks spend zillions of dollars trying to market to consumers, literally giving them 0% benefits, 0% APRs, but it takes this dude in pleated pants making bacon to like have that switch go on, and I don't know what the there is, but there's something there.
Jump in?
Go ahead, Cal.
So I think this is one of the areas where, as we look ahead to artificial intelligence, there are some really interesting questions ahead about how this potentially can be used. And does it promote trust or does it undermine trust?
Yeah.
We've talked a little bit about large language models and agentic AI and ways that they could potentially provide a greater assistance. I think it's not all about the automatic systems. Like we've been talking about trust. I think it's also human relationships, and how do you marry the best of the humans with the best of the technology. But there's really interesting research about how consumers are interacting, for instance, with chatbots, and when they have different preferences in different situations. So there's some really interesting research that says sometimes people are really terrified of the technology. They don't want to have anything to do with it. They don't trust it at all. There are other times where they may be more willing to share personal or embarrassing information with a chatbot than they would be with a human, because they're not worried about being judged. And I think that has really interesting implications for things like financial management. And how do we do the best of both? You think about a really good large language model that is reliable enough for this purpose, which is a big asterisk. But, it's available 24/7. It can help as many people as log on at any given time. There are ways in which it could be an important tool, maybe in combination with human advice and other things, but there are ways where it could be tremendously powerful. And if you look at agentic AI, where it can help consumers, not just in getting the answers or monitoring the information and figuring out when they need to make a decision, but also help with the nitty-gritty follow-up of I've got to go through the account opening process or do whatever, or transfer the money, and those kinds of questions. Both of these systems, we have to really learn how to manage them the right way to make sure that they're fit for purpose, that we've got the questions answered about how they serve consumers' interests best. But there is tremendous potential to help with some of these questions, I think, if we can get to that place and manage it the right way. So.
Can I build off one point you just made there,
Yeah,
which
of course.
I think is really interesting with agentic AI in particular, which is a lot of times the financial services ecosystem gets compared to the healthcare space, right? Because they're very similar. It's all about long-term outcomes. We're looking for health. We're looking to try to be as inclusive into the system as we possibly can be. One of the differences, though, is for the most part, at least at the moment, in personal health, you have to go to the gym, right? You have to go lift heavy weights. You have to run. You have to do something, right? And one of the things I'm really fascinated by, AI agents can't make me fit. That's just great. It can tell me what to do, but I still have to get up and go to the gym. I know. We're working on it. Financial services, by contrast, though, really similar to the healthcare space, but the difference is agents can go to the gym on my behalf and lift weights. Yeah. That is fascinating to me because on the one hand, I think there's a tremendous amount of stuff that we make consumers wade through that inhibits their access to certain products, their use of certain products, and it's literally just a paperwork challenge. It's I remember when rates went down during the pandemic, I dragged my wife to the title office 3 times to refinance our mortgage 3 times, and the 3rd time she said, I will divorce you if you make me do this again. So that's why we didn't do it a 4th time. My rate could have been even lower. It would have been nice if we would have had an AI agent that could have just done all of that for us. But I think the flip side, and this is the thing I'm really curious about, is there is a benefit to the discipline you have to develop in terms of behavior and habits, right? This is what we measure with credit scores. This is what new cash flow scores are looking at. It's looking at behavior. Yeah. And I am very curious to see where the line ends up being between agents, AI systems, automated systems doing things on consumers' behalf versus giving them the ability to do things, but still requiring them to put in effort to demonstrate whether it's creditworthiness or how profitable a customer they'll be for a bank. There is an element of personal behavior there that I am very curious to see how that changes in the age of AI.
Sure. I mean, there's also a consumer protection risk. I just want to flag there, and a regulatory issue for the lawyers in the room to sort through, particularly the ones in TCCA, right? Because when EFTA was passed in 1978, they said, hey, for fraudulent transactions, consumers will always be protected. And so the Fed wrote guidance saying you could put your PIN number on your debit card and still be protected up to $50 if you lose your debit card. However, for authorized transactions, because it's on the bank for unauthorized, because the bank can verify whether that's you or me, so the bank should be on the hook. But for authorized transactions, it shouldn't be on the bank because once you've authorized it, they shouldn't have to look into the relationship to figure things out. And so for authorized transactions, you're on the hook. And so that worked really well for 50 years, but then we ran into scam transactions where people were authorizing transactions and I was sending money to Alex in ways that they didn't envision in 1978. And now I'm saying, oh, I meant to send it to Alex, but Alex told me he loved me, or Alex told me he was giving me puppies, or Alex...
all of these are scams I did try on.
That's right. And so now we have huge rates of consumers not only getting like harmed to life savings amounts in those totals, but even like suicide numbers going up because of these issues here, and because they thought they were protected, right? Because we trained them so effectively before we hit a technological change that, you know, we conditioned, like Reg E works so well that consumers don't know it, but they change their behavior because of it from a policy perspective until the world changed, and then they started running aground in this new harm that we didn't anticipate collectively and protect them on. I would note from the agentic perspective, this whole notion of doing things for consumers that they might not be aware of or that we might not be they might not be kind of thinking about is another one of those harms. Like I think it's definition 2M or M2, I get the two confused in Reg E, for unauthorized transactions says, hey, if you authorize someone to make a payment on your behalf and they exceed their authority, you, the consumer, are on the hook, right? And so if I were to say, hey, Alex, here's my credit card, go buy me a sandwich, and Alex is like, dude, like, why are you asking me to buy me sandwiches, Kelvin? And so he buys a Tesla and drives home. The financial institution is no longer on the hook. They're going to say, hey, you got to go chase Alex down. And so when we have an AI agent that's meant to do all these things, to go to the gym on your behalf without you knowing, to do transactions without you knowing, there's a question as to whether or not you run into a situation where you've got an agent that exceeds their authority and who should be on the hook for that. It's an issue that we're actually trying to track down on our side, but we're going to need regulatory help and participation on. And so I would just note, like, that's a great example of, as we think about the future and unleashing the future, the kinds of issues that we're going to have to collectively work on to make sure that consumers don't get harmed on the way.
Okay. We're going to get to a couple other topics here, more near term. The longer term, maybe I'll let you interject, Kelly, but I want you all to think about your last question. In the longer term, we're going to go shorter term. The last question might be, what are the 2 to 3 things that you think we absolutely need to start doing now to get to a better outcome in the longer term? In longer term, let's just say 5 years. That's close enough, right? But Kelly, you wanted to interject something, and then we'll come back.
Yeah, I was just going to say, I totally agree with the issues that you guys both raised on agentic AI, and I think there's really tremendous questions here about how we make sure that these kinds of systems are able to define and execute against consumers' best interest, and how do we manage consent and understanding. And I think it's challenging because consumer disclosure and consent has been a mainstay of everything, financial services and otherwise, and in some ways it's getting less effective as it goes along, and yet it becomes even more important in a case where you're talking about a system that can really take multiple steps on the consumer's behalf as opposed to being more narrow. But there is also tremendous opportunity if we look at past generations of personal financial management tools. A lot of what they're trying to do is motivate the consumer to get to the gym, right? Gamification or whatever.
And those tools have never really worked, right?
And it's hard. It's really hard. So, and there's ways in which these kinds of systems can be used internally by financial services providers to do things like AML compliance that are tremendously exciting, could be a huge efficiency and effectiveness gain, reduce false positives, make the system more agile in the face of the attacks that, Joanne was talking about. So I think there's a tremendous amount there. And we have a symposium coming up in the fall where we're talking about AI issues. And I think they're just expanding so much that we are seeing so many different kinds of use cases and really needing to, there are lots of banks that are still trying to get their arms around supervised machine learning and large language models, but the system keeps moving. The next wave is already approaching, and we've got payments providers and e-commerce sites that are going down some of these steps, that are going to raise some of the questions that you're talking about as well. So I think that actually kind of bleeds into my answer, which is acceleration. Like, we've really got to engage and think not just about risk managing in the moment, but what are our tools, because the system is going to keep going and it's going to keep expanding and accelerating even further. And I think we have to balance between how do we do risk management up front, how do we do risk management along the way. We've got more complex systems. There may be times where we can't always understand the way the system works in the same way that we understood the prior generation. And we have to grapple with what that means and what are our tools over the entire spectrum of time, not just before deployment, but monitoring actively. If we're talking about this kind of agentic system, ongoing monitoring is going to be absolutely critical to this. So, I think that's the place where I start, is really thinking through, and how do we help the whole ecosystem along, to come back to the thing that we were talking about at the beginning. I think those two things are the most critical. The third thing I would say is data infrastructure. A lot of the tools that we're talking about here depend on how well we can use the data, how we fill the gaps, how we, make sure that we're balancing privacy and security and all of those considerations. And it, as I said, it's not even just about traditional financial services data. It's potentially about things like government benefits and workforce benefits too. If we want the whole picture of consumers' financial lives and really to maximize financial health, we're going to have to think broadly about those questions. And I think there's a lot to do in that space, as we have different institutions with different data in-house wanting to access data from other sources, and how do we manage all of those questions and all of those intermediaries. We have some legacy laws that are in place for decades, but they have not necessarily been interpreted as applying to kind of all sorts of new intermediaries and new situations, and I think we really are going to have to take a hard look at some of those questions.
Okay. Alex, you want to go next?
Sure.
Top three things that you think we should do differently and or need to address.
3 things?
I'll give you up to 3.
Okay. I don't know if I have 3. I definitely have 2.
Okay.
One really quickly is it would be nice if banks didn't charge excessive fees for access to their data. So that would be a good one to not have. Because I do actually think that we have a certain infrastructure that has developed in the US, both somewhat intentionally and somewhat unintentionally, that allows for innovation and facilitates more competition. And I think that competition is actually very beneficial for inclusion and better outcomes for consumers. And I think we need to be very, very thoughtful about how we regulate that innovation infrastructure so that it's viable, it's accessible, it maintains safety and soundness. It's a really hard balance to strike. I'm being a little glib about it. It is really, really hard. But I think that's incredibly important. And then the second one, to be a little bit more specific, is digital identity. And I think one of the things that I am thinking about a lot as it relates to inclusion is, you take financial services online in its sort of version 1.0 fashion, and it's not that bad that we don't have digital identity. And then you go from desktop to mobile, and actually we did a little bit better, because now we can take, videos of ourselves, and we can take a picture of our driver's license, and that's kind of a good solve. But the further and further we go into digitizing financial services, version 3, version 4, version 5, there's stable coins, there's agentic commerce, the further we go, the more glaring it is that identity is not following along with the rest of that infrastructure. And I think identity is both a sort of obvious problem for inclusion. If you don't have a form of identity, you can't participate in our financial system. If you lose your driver's license or lose your passport or lose your birth certificate, it's actually really hard to replace. So the infrastructure for people to just get access is one, but also just the friction and the sort of sand that it rubs in the gears of our financial services system when we have to ask for another form of ID, or you have to come into the branch to prove your identity. All of that just grinds things down. And you mentioned before about people not going to the doctor when necessarily they should. There's an equivalent of that in financial services when we make these things too hard. And I think that identity is a key component of that. And so we need to advance the ball on that. And the sooner we do, I think the better off we'll be.
Okay.
And Alex wrote something that kind of blew my mind on identity too. I think you wrote this last month, where we're also moving to a world and we have to think about digital identity with respect to the AI agentic bots that we're putting out there. And we have an IT infrastructure, because I don't know if SORP is still called SORP, but the operational resilience people will have to think about is that we've been for decades building systems that were meant to zap bots, right? You were meant to identify bots that were trying to access your systems and prevent them from doing so. Yeah. Right. Now, how do we say, oh, that's actually that's a good bot. Yeah. That's my friend bot, right? Please let that friend in, but not those 5 bots. I don't know how to think about that. Right. So Art, to your question, what should we be doing in the short term? I would say, actually, I wouldn't, not quite to slow down, but I think that there's a temptation, particularly amongst regulators, because you have these kind of short windows, to go in and like kick a lot of tails, right, and like make a lot of change. But I think the key is take a second and like look first at the silos that you're operating in, and think about how the changes, and I'm not trying to say don't do stuff, you should do stuff. Like aggressively look at the silos, aggressively look outside the silos, aggressively think about how you would collaborate outside the silos, and aggressively think about how the consumers experience the market. Because I think if when you go in well-intentioned and just kick the mess out of just one thing in one corner of it, it often has unintended consequences. Like I'm surprised, actually, Alex, in prep, we talked about having like a Durbin fight, right? About kind of like financial inclusion. How can we have this financial inclusion fight without talking about chime? So I will not take the bait on 1033, but I will talk about, I'll open the door to get beat up on Durbin. But what I would note, right, is that here we are, 15 years after Dodd-Frank. One of the things that came in with Dodd-Frank was the passage of the Durbin Amendment. That led to a world in which you have these neobanks that are now kind of taking the mantle of a lot of the financial inclusion because they're able to avail themselves of Durbin economics that banks generally weren't, big banks generally weren't able to do so. But the thing I would note is that when we look back at the kind of the passage of the Durbin Amendment and kind of that timeline, the thing we can't like overlook in that timeline of the important events is that the year before that, Apple opened the App Store up for third-party developers. Right, and so the year before, so you're talking about being able to have kind of branchless bank accounts, and kind of which led to kind of lower cost economics. You were able to have, to business models that gave you kind of more fraud threats, but also anti-fraud technologies that give you sort of free checking accounts. But like, you got to look when you're in the financial services space, when you're writing financial regulations, at things like, oh, this tech company out in California made it so that people can develop things on their phones. Like that's going to impact the consumers that you all serve, because the consumers that we're all have a duty to, whether you're in the private sector or on the public sector side, they don't see these silos, right? They're just trying to navigate their day, right? They're going to download a bank app the same way they download a crypto app or an investing app. They're not thinking about whether it's a non-bank that's nested on a tiny bank, or it's a big bank that's well regulated, or a bank that's well supervised. And so, we really have to kind of put ourselves in the consumer's shoes and aggressively collaborate, aggressively learn, aggressively de-silo so that we can kind of meet them where they're at and let kind of the market work to serve their needs.
Was that one? And
That's a bunch.
2 and 3?
It was like six. I feel like
Don't give him two more. That would
I feel like I'm talking too much.
I did a couple things, and all of a sudden he stopped talking. Okay.
Well, de-silo and share. That'll be my, de-silo, share, and
All right.
think about consumers.
All right. It's been a great panel discussion. I did want to save some time for our audience to participate. It's always a joy for me to ask these guys these questions, but you've got a lot of things that are swirling around in your mind. So we do have a bit of time set aside to do that. So why don't we open it up to the audience, see if anything that was raised resonates with you. Again, thinking about the tools we'll need to navigate the financial ecosystem and what we need to do now in order to get to a better place. And we said longer term, use 5 years for a better outcome there. Okay, questions?
We'll chime in with some questions and updates from the chat. So thank you very much, panelists. Alicia Loro notes that a couple of speakers referenced the FDIC survey of unbanked and underbanked households and how the overall unbanked rate is very low at about 4%. But it's somewhat misleading to look at the overall share. Large gaps remain by race and ethnicity, income, and disability status. For example, 11% of Black households and 12% of American Indian and Alaska Native households are unbanked. If the financial system were truly inclusive, I wouldn't expect to see these differences. She also notes there's an analogous argument for credit access. Gaps are even larger, and we have arguably made less progress over the years. And on a separate note, Bob Hunt has referenced how Blueprint, a set of money management features that Chase developed and that was available with their credit cards, was an example of a credit card lender anticipating BNPL products and short-term installment loans. And he's also pointed to the Philadelphia Fed's consumer finance research on how Americans are using social media for financial advice.
Oh,
Thank
cool.
you.
All right.
Good reading advice. Yeah, I mean, I think it's such a great point about differences between different groups, right? That's like incredibly important context. I think it also speaks to market structure questions, right? One of the things that I see a lot in fintech is the internet allows you to access any consumers, but it doesn't put a spotlight on any particular consumer segment the way that different geographies do. So when we talk about banking deserts, we talk about consolidation in the market. Yes, theoretically, I think the rate of households that have access to the internet is also pretty high, although again, not perfect and probably different between different groups. But the internet sort of allows anyone to find anything, but it doesn't allow you to intentionally seek out and serve specific groups. So I do think we are going to lose something as we continue to make that transition. It's important to be thoughtful about that.
And I think meeting people where they are. You know, we know there's differences in surveys about how people prefer to access financial services, whether it's branches or electronic or whatever else. And of course, there's huge age gradations on some of that. Yeah. But we're at a time of transition, and if we want to push inclusion where we want it to be, we have to kind of manage for the fact that there are people in different places, and if we can meet them where they are and give them options and let them understand what the other channels are too, that's really important if we're going to kind of go that last mile and keep making the progress we want to make.
Yeah, agreed. I mean, I don't want to be glib by kind of citing those numbers at the top. I mean, I think the big question is, right, like how do we serve individualized needs? I mean, the things that I really struggle with is in the FDI survey of the unbanked, a lot of the folks that are unbanked are often unbanked by choice. They'll cite that there's like a lack of trust, or some of them were formerly banked and then now they're unbanked, and so there's like a real head scratcher there. And then on the more positive side, it's always really interesting to me to see how non-banks really just thrive in certain communities, right? So if you look at kind of these P2P apps, like Cash App is killing it in the African American community, and I would read like books on that to figure out what they're doing, because it's just such an interesting kind of niche market that they've really found success in and are serving their customers with a lot of trust.
Okay, we got several hands going up in the room, so we'll...
Oh, I think.
I'm sorry, here we go. Sorry.
Hi, my name is Montrese. I'm the Associate Director. I lead the Community Affairs Program at the FDIC, and I wanted to build on the comments and the remarks. I'm interested if you have a perspective on the type of firms, institutions that seem to be getting it right in terms of addressing those trust issues, because the point is right. We are seeing in the unbanked survey a lot of, at least a contributing factor, is people who just have a lack of trust in financial institutions. So you mentioned Cash App.
Well, I'm not endorsing Cash App. Just like I'm really curious as to what they're doing.
I recognize that, but I'm interested if there's a perspective on what are some of the practices that you're seeing where institutions are winning that trust battle. And then if I could sneak in a really closely related question, I'm interested also in terms of managing the ecosystem. Are you seeing institutions make progress in bringing someone in, let's say a low and moderate income individual, bringing them in with a certified bank on account, a low cost account, but then helping them identify other ways to deepen their relationship with financial services, whether that's a small dollar loan, a credit card, helping them kind of navigate across the financial services needs to hopefully derive better financial outcomes.
You can name banks, but don't be careful on the endorsement.
Fair, yeah, that's fair. I can endorse anyone. No, I'm just kidding. I think on the trust question, one of the things that I see there is I think there's a big difference between building for affinity and building for utility, right? And so a lot of, I think, really successful companies, both banks, credit unions, but also fintech companies that are reaching into some of these underserved or badly served populations and are doing a good job building trust, they're identifying functional needs, utility needs that those consumers have that products that exist today aren't addressing, right? I'll shout out one specific one, no endorsements, but Citizens Bank of Edmond launched Roger, which is a digital bank for new military service members. And that was based on the CEO, Jill Castilla's knowledge of the military, which her and her family have served in. and wanting to build a product for that segment that was just slightly more tailored to serving that segment. And I think a lot of times when we talk about product and brand and stuff in financial services, we don't appreciate that a lot of times it's that last 5% where that trust is built. And so I think it's in small areas of utility or product functionality that are just exceptionally well tuned. Another example are fintech apps or banking products that are designed for new immigrants, where just the friction point of, okay, provide a form of ID, and the form of ID you have is not the form of ID that's being asked about. Like, that's just a little point of friction that scares people away, that doesn't make them want to participate or trust that app. And if you can just tweak that just a little bit, it's not a huge change, that creates trust. So I think trust tends to come out of a lot of those micro examples rather than being some big silver bullet.
You know, Montrese, and one of the things I like about kind of Alex's notion of micro examples is I think different people build trust differently, right? And this kind of goes to why I keep puzzling over the Cash App, like what it is that they're doing. You know, one of the things that I like watching, and I don't have a dog in this fight, in the banking space, is that some banks think that you got to have branches everywhere, right? I live in Clarendon, and like you can't like walk 3 feet without having to walk through a bank branch, whereas other banks have gone fully digital. And, you know, I love in kind of this diverse competitive environment, people are finding different ways of building that trust and that touch point. I mean, it totally makes sense, right? Because you have some folks that you call on the phone because they want to talk on the phone to sort things out, and other folks that you just cannot nail down for an in real life conversation because they want to handle things over text or they want to be able to time shift. And so I think, you know, we're now in a world, particularly as we try to get to those tail segments of folks, that we're trying to figure out like how do they think of trust on an individualized basis. To your point about products that deepen the relationship, you know, again, just credit cards. The thing I will note is like Hugh's son at CNBC wrote this thing beating up on retail credit cards, right? Because he's like, they have higher APRs. And I was like, this is why you got to look at things at like from a holistic perspective. They have higher APRs because they're reaching consumers that aren't typically reached, right? It's oftentimes their first time like experiencing credit. There is an ATP requirement, an ability to pay requirement. It's highly tailored because you're kind of meeting the consumer where they're at, right? And like they do it in a safe manner, like setting aside the ATP, the credit limits, like how much damage can you do to yourself with like $300 worth of cargo pants, right? Like, and you're like buying like a particular item, but then that helps get you into the credit system, and not only helps that bank develop the relationship with you, but it helps set you off with this broader life in the well-regulated credit system that then gets you things like auto loans and mortgages that other people can compete with you for. So, you know, I'll stop. Well, I can't promise to stop saying credit cards.
You can.
I'll end it there.
I know your excitement can't be contained, so I'm not going to try to do that. Okay, let's hit a couple other questions over here. And these have been good questions, so thank you for that.
So it's been alluded to, but I don't think it was explicit. So I'm going to expose myself for a bit. I am Gen Z, and how I received my financial education literacy is through Financial Feminist. I don't know if anyone has heard of that.
Yeah.
Financial
but
what?
it is Financial Feminist.
You heard of this?
No?
Go with you. Come on.
Yeah, but it is unfortunate that there was like really no way that I can receive this like education literacy. My mom is like an immigrant, so she wasn't someone I could really like ask questions to. And I don't think banks or other financial institutions provide really accessible ways to teach them like, okay, what is debt and how can you use debt in a healthy manner to like build your credit and to build wealth. So what do you think are more innovative and holistic ways that banks and other financial institutions can help like bridge the gap in this like financial education literacy?
So my first job, I created a credit education program and taught it to 5,000 high school students, which was probably not a good idea because I was like 18 at the time and I didn't know anything. So I was like the one-eyed leading the blind. But what that experience left me with was a profound sort of caution around financial education. It's really hard. It's really hard. Until you've stood in front of bored 15-year-olds and tried to like get them to care about something, like don't talk about financial education, right? It's extremely difficult. But to your point, and building on what Kelvin said before, I think there's kind of two ends to the spectrum, right? One is financial education is storytelling, right? So this is some of the different like social media influencers and different podcasts and different content, if you can make it a story that is relevant to whatever group you're trying to reach, I think that's one end of the continuum. The other end of the continuum is deeply functional experiences, right? And this kind of goes back to my point about on-ramps. What products can you build that let people practice these things? And I was mean to Chase before, but a thing I liked that Chase did was partnering with Greenlight to launch debit cards for kids, right? Like, you need to have mechanisms to get hands-on experience and practice. And a lot of times for certain people, the best way to learn is to actually do and to run into the walls and see how these products work. And so to me, those two ends of the spectrum both work. I think where you end up really failing is when you try something in the middle. And probably a lot of folks here have seen like, you know, kind of your average bank financial literacy program. Most of them have them on their websites or other places. They're very bad. They're very, very bad. They're a waste of digital space. And because they live in that middle ground where they try to be somewhat functional and try to be really informative, but they also try in kind of a cringy way to be entertaining, and they don't really succeed at anything. You need to live on either end of the continuum. You can't be in the middle, is my opinion.
Wow. Digital, all right. Interesting one. Hopefully you got a little bit out of that you needed. We'll kind of have to come back in our approach there, but thanks for the feedback there, Alex. Okay, I saw another hand up, so you're in the back. Go ahead, please.
Yeah, hi. I wanted to kind of go back to something you all were speaking about earlier, and kind of what I was hearing as a connecting thread. You had mentioned that there's a lot of competition in this space, and one thing I always wonder with that is how much of that competition is meaningful in the sense, you know, how much of it is players that are sitting on top of a more, potentially more concentrated infrastructure. And do you all think that, you know, some of the ways that that infrastructure has been designed by some of the past incumbents, you know, is that kind of causing difficulties for consumer access? Things such as costs that banks pay, you know, that are passed on to consumers, like how, and kind of how much of financial services has been designed around what has been profitable for some larger players that is kind of, that might hurt meaningful competition from penetrating into financial services, if that makes sense.
So roughly, the idea is that component parts may actually, the sum of the parts may not actually result in something that's beneficial to the whole. So, you know, do you break them up or do you just leverage that in some way? Are costs that prohibitive based on that?
Yeah, I mean, Kelly, I'd be curious for your perspective on the credit ecosystem side since you spend a lot of time there. One example that occurs to me is early warning services, right? Infrastructure owned by banks, designed to solve a set of cooperative problems. It actually started with like closed for cause account data and sort of stopping fraud within the deposit space. Obviously they do Zelle and a bunch of other stuff now. They don't let fintechs participate, which is interesting. I understand why, but the result of them not allowing fintech companies to participate until they get a bank charter is that it does create two different ecosystems, one in which fraud is very rampant and one in which fraud is very sort of locked down. The right answer is probably for the fraud to sort of be shared across that entire risk pool in a more even way, if we're just thinking in terms of like access and kind of creating a level playing field. So I do agree. I think there are systems that either for specific sort of anti-competitive reasons or just because of legacy infrastructure reasons are not well tuned to allow for access and even competition. And, you know, like to put out another plug, I hope someday we revise the Fair Credit Reporting Act because like it was written in a completely different time and doesn't address some of these same type of structural concerns. So I do see that in certain places. I don't know if you guys, yeah.
I know we're at time, but happy to talk afterwards about your question.
Yeah, I'd just say real quickly, I think the data ecosystem that we've already been talking about is a place where we have different pools in different places under different regimes, and that is becoming more complicated as now we're seeing things kind of converge. I think payments channels are the other place where we've got a lot of different systems going with different
Yeah.
rules underneath. It's really hard for consumers to understand the differences between those channels, and how do we manage for both providers' interests and consumers' interests across those areas, especially as we're seeing fraud and scams increase, is another place where the old infrastructure may not really be working super well for anybody, I think. So.
That's a good segue. We're going to talk about payments this afternoon, but at the moment we are out of time for this panel. I'd just like to say thank you for a great job. Thank you for being flexible on this. And to all of you out there, if there are other questions that you have for the panelists, they'll be around for a bit, so feel free to contact them. So please join me in thanking our panel, and we will wrap this meeting. Okay, now we'll have our lunch break, so we will...
Okay, we're gonna get restarted. So I'll give you all a second. Well, welcome everybody. I'll add my welcome. I'm Eric Belsky. I'm the Director of Division of Consumer and Community Affairs here at the Board of Governors of the Federal Reserve, and we're really delighted and pleased that we have such a strong turnout both in the room and online for this event. And I think the program really is its own reward. I have a small part on the program, but an important part because I get to introduce two wonderful people from whom you'll hear who are part of that really powerful agenda. I'll have some words at the end of the day to thank people who made all of this possible, but it's really just an outstanding event. It's our second one, and it's living up to the standard of the first one, which was a high standard. As I said, my role right now is a simple one. I'll start by introducing Governor Michael Barr. Governor Barr oversees the work of the Federal Reserve on consumer protection and community development, and in that capacity, he also oversees the Division of Consumer and Community Affairs. I think you all know this, but I'll say these things. Not only is he a wonderful human being, but he also has a very long experience in both of those areas, both consumer protection and community development. He's really devoted his career to the study and the practice of financial laws and regulations and studying the markets that are being regulated. He has really a unique blend of research, experience, capacity, and interest in how the markets operate and also how they're regulated. And that's a really, I think, helpful combination. Has landed the country, frankly, in a good place because of it. He's done all of this and always with the aim of making markets safe and fair and supporting access to credit and investment for low and moderate income people. I'm fond of saying he literally wrote the book on living with no slack because that was the title of the book. But he did that research and he did that work because of his deep caring about what it's like when you're trying to manage your finances, and it's really challenging to do so. As a result of his central role in the work on the Dodd-Frank Act, he's often referred to as a principal architect of the modern consumer financial regulatory and legal framework, and I think that's fitting and true. On top of those, he really has a deep understanding of policy and practice. So if you add to his knowledge of laws and regulations and markets, he's not only been very interested in the policies that govern these things, but really in how people make it happen. And that's a lot of what we've been talking about here today. So over a remarkable career, he's held a number of distinguished government positions. He was a law clerk to David Souter, and I had the benefit of hearing some of the lessons he learned from that unique experience. He was the Deputy Assistant Secretary of Community Development Policy at the Treasury, and during that time, he played a fundamental role in the creation of the CDFI fund, some of the things that we're talking about today that have been really foundational infrastructure for work in this field. He was also the Assistant Secretary for Financial Institutions. That's the period of time where he worked on the Dodd-Frank Act, and as if that weren't enough, he advised both the Treasury Secretary and the President of the United States on this range of issues. Prior to joining the board in 2022, he was the Dean of the Gerald R. Ford School of Public Policy at University of Michigan, a fact which he likes to point to. He has a deep and abiding love for that university. And before that, he was founder and faculty director there of the Center on Finance, Law, and Policy. So we're really very, very fortunate to have Governor Barr in this role. And we're going to hear today from him some of his thoughts on this topic of financial inclusion. So it's my pleasure to, and I hope you'll join me in welcoming Michael Barr to the podium.
Thanks very much, Eric. I've had the pleasure of working with Eric in various roles over the last nearly 30 years. So it's just a great honor to be here with you today. And let me join Eric in thanking the conference organizers and all of you for being here today. I have long believed that financial inclusion is a crucial component of a safe and fair financial system. Working to improve financial inclusion has been an important part of my career, starting in 1995 when I joined the Treasury Department and worked with colleagues to build the Community Development Financial Institutions Fund, strengthen the Community Reinvestment Act, and launch the New Markets Initiative. At the University of Michigan, financial inclusion was key to programs I worked on to support minority entrepreneurship. With the support of both the public and private sectors, there have been many improvements and advancements in financial inclusion over the last 3 decades, evidenced by the decline in the rate of people who are unbanked and the increasing reach and success of programs such as the Bank On initiative that better meet the needs of low-income customers. I welcome this progress, but there's so much more to do to deepen and widen financial inclusion to many millions of people in America who could benefit from it. Better access to affordable financial services geared to the needs of underserved families and entrepreneurs can help them to build more secure lives, stronger communities, and a stronger American economy. Financial inclusion contributes to the Federal Reserve mission of promoting a healthy and growing economy and a safe and stable financial system. Consumers are 2/3 of economic activity, so access to credit for low and moderate income households and small businesses helps the economy to grow. In addition, the Fed has an important role in implementing a series of laws passed by Congress related to access to credit, such as the Community Reinvestment Act. As we learned during the global financial crisis, household finances are crucial to a strong and stable financial system. In my remarks today, I would like to go through several ways that the public and private sectors are helping to increase financial inclusion. Those efforts include greater access to bank accounts and financial services, faster payment services, responsible small dollar lending methods, and the use of alternative data to promote credit access. These efforts have shown promise in expanding financial inclusion. Financial inclusion begins with access to basic bank account services. While financial services are evolving rapidly, with new forms of financial intermediation, payment services, and even deposit-like money claims, it is still the case that access to a bank account is the foundation for helping families and businesses get the financial services they need. Bank accounts provide access to direct deposit of paychecks, benefit payments, and tax refunds. Bank accounts provide connections to peer-to-peer payment systems and for the vast majority of retail and wholesale payments. Bank accounts are also often the entry point for access to credit for households and businesses. According to the FDIC's 2023 National Survey of Unbanked and Underbanked Households, the number of Americans without bank accounts is at the lowest it has been since the survey began in 2009. Yet, there remain groups that struggle with low account access, including those who are disabled, those without a high school diploma, and minority groups, among others. Households that include someone of working age with a disability are 3 times as likely to be unbanked as working-age households without a disability. Meanwhile, Hispanic and African American households and American Indian and Alaska Native households are 5 and 6 times as likely, respectively, to be unbanked as white households. The unbanked cite account opening costs, unpredictable or high fees, and high minimum balance requirements as among the top reasons for not obtaining bank accounts. One private sector program that has helped to address barriers to account access is the Bank On program, supported by the Cities for Financial Empowerment Fund. Bank On is led by a coalition of regional financial institutions, community groups, and local governments working together to bring households into the financial system. CFEF certifies that Bank On accounts meet standards, including low minimum deposits for account opening, low maintenance overdraft or other unexpected fees, and free branch ATM, online, and mobile banking. Over 46,000 bank branches nationwide offer a certified Bank On account. An important way that the program has spread and taken root in communities is through the coalition model, which involves establishing relationships with local and state governments, public officials, and community organizations. These partners, engaged with and trusted by their communities, have helped overcome apprehension about bank accounts and helped drive the outreach needed for any businesses to find new customers. The Federal Reserve System has long been a partner of the Bank On initiative. In 2006, the Federal Reserve Bank of San Francisco was a partner in creating the first coalition. At the St. Louis Fed, the publicly available Bank on National Data Hub, or BOND, was created in 2017 to help identify the availability of certified accounts. Bank on coalitions across the country continue to partner on engagement, outreach, and data collection with their regional reserve banks to offer safe and affordable bank accounts. Financial inclusion also requires timely access to funds. People living paycheck to paycheck incur the greatest costs of waiting for these funds. One of the primary benefits of a bank account over time is facilitating payments. Technological advances have driven improvement in the area, sometimes only incrementally. But the more recent advent of real-time payments, especially new services for instant or immediate payments, has the potential to make a big leap forward in service to households and businesses. Cash-strapped households and businesses need access to their funds right away, and they need reliable ways to pay expenses when they are due and when they have the funds to pay them. Low-income households may need quick access to make just-in-time transactions, such as same-day utility bill payment through their bank, or to quickly receive funds from a family member to cover an emergency expense, like an unanticipated car repair. While the benefits of getting instantaneous access to paychecks are obvious, the value of controlling precisely when and in what order payments settle may be less appreciated. With real-time payments, households and businesses can have better control over payment flows, helping them, for example, to avoid unexpected and unwelcome overdraft and non-sufficient funds fees. Many other countries are seeking methods to improve the speed of payments. In India, for example, the implementation of the Unified Payments Interface, which is the country's digital instant transfer system, has allowed consumers to see some of these benefits in action. UPI is available for free on a customer's mobile device and can be used for merchant payments, bill payments, and money transfers, among many other things. Since its implementation, the Reserve Bank of India has noted an increase in financial inclusion, particularly in rural areas where bank branch access is difficult. We have seen the benefits of technological advancement and innovation here in the U.S. as well. Today, technologies to improve the speed of payments are being implemented across platforms and products, providing consumers various ways to move money quickly and easily. The Federal Reserve, as a part of its mission to foster a safe, efficient, and widely accessible payments infrastructure, is playing a role as well. As we have in the past and in collaboration with the private sector, we have worked to innovate the payment system using the latest technology to better meet the needs of businesses and households. In 2023, we launched FedNow, an interbank payment system for banks and credit unions of all sizes to instantly and securely transfer money for their customers any time of the day on any day of the year. We are encouraged by innovative private sector engagement with the new platform and instant payment services generally. We are already seeing early adopters rolling out new services that can benefit their customers. One example is the ability for gig economy workers to gain instant access to earned wages, which can make a big difference in household cash flow management. We expect these types of innovations will continue to expand in the coming years and be delivered in new contexts, ultimately bringing broad benefits to liquidity-constrained households and small businesses that need to tightly manage payment inflows and outflows. Access to small dollar loans from banks can help consumers smooth through the ups and downs of income and expense. I think many people would be surprised how widely this help is needed. According to the Fed's 2024 survey of household economics and decision-making, or SHED, when asked how they would respond if confronted with an unexpected $400 expense, nearly 20% of adults said they would have paid at least in part by selling something, using a payday loan, deposit advance, or overdraft, or would not be able to pay for the expense. When looking at households with incomes of under $25,000 a year, this number increases to 46%. Access to reasonably priced credit to cover these sorts of expenses is therefore a common need, especially among those with lower incomes. These households have no financial slack. In contrast to the more costly and riskier sources of credit that I mentioned, we are seeing bank-offered products that are helping to increase access to safer, lower-cost forms of small-dollar lending. The Fed and other bank regulators took a helpful step in this regard in 2020 by issuing guidance. According to that guidance, responsible small dollar loan programs must treat customers fairly, have effectively managed risks, and be underwritten based on prudent policies. That means, first, that products are offered in a way that most customers successfully repay their small dollar loans in accordance with the original loan terms, which is a key indicator of affordability, eligibility, and appropriate underwriting. Second, it means repayment terms, pricing, and safeguards minimize adverse customer outcomes, including cycles of debt due to rollovers or reborrowing. And finally, it means repayment outcomes and program structures enhance a borrower's financial capabilities by contributing positively to their record of servicing their debts. Most banks that have offered smaller dollar loan programs since 2020 follow these principles, and it has had a positive impact on the loan terms they offer. Loan terms have better matched customer needs, and rates have come down. Small dollar loans that have the potential to disrupt the market for more costly alternative financial services are bank products that provide a straightforward application process, clear loan terms, certainty about approval, strong likelihood of repayment, and quick disbursement of funds. Another channel for improving financial inclusion is the use of alternative financial data to supplement the traditional measures that banks have relied on to judge the creditworthiness of borrowers with limited or no traditional borrowing history. For example, lenders can evaluate cash flow, steady income, and bill payments as a measure of the likelihood of loan repayment. Alternative data can help lenders to take a second look for consumers who would otherwise not qualify based on the more traditional credit score-based underwriting models. In addition to making less expensive and more suitable loans available, alternative data often allows faster loan decisions. This is an important consideration for low and moderate income borrowers who tend to have little savings and struggle with meeting an unexpected expense. Technological advances such as application programming interfaces, or APIs, a set of specifications that can allow software to communicate with each other, can also help lenders access permissioned consumer financial data that can be used for underwriting. APIs also facilitate automated application, decision-making, and fund delivery. Let me conclude by returning to where I started, which is the crucial role of access to safe, transparent, and low-cost bank accounts as the gateway to financial inclusion. We have made great progress, but am certain that there are still many people whose finances and lives could improve with a bank account suited to their needs and economic circumstances. I applaud the work of financial inclusion leaders in doing what they can to make bank accounts available and better tailored to the needs of low and moderate income households. In thinking about how to better design financial products and services, we can build on many years of behavioral financial research and practice. Thank you very much.
Thanks, Governor Barr, for offering your thoughts on the themes of financial inclusion, and of course, central to this year's conference. As Governor Barr mentioned, how financial products are designed is a key part of their usage and the extent to which they are fair and transparent. Using insights from behavioral economics can help institutions better understand their customers and tailor financial products that more effectively respond to consumer needs and behaviors. To explore this topic more, I'd like to introduce Evelyn Stark. I guess you guys can take your positions in those comfortable-looking chairs there, of Ideas 42. Evelyn, thank you for joining us, who will discuss this topic with Governor Barr. Ms. Stark is a managing director at Ideas 42, a nonprofit that uses insights from behavioral science to improve ideas and build better systems and policies. She leads the financial health work at Ideas 42, in which she focuses on reducing financial distress and enabling people with low to moderate incomes to leverage opportunities better in the financial system, very consistent, again, with the themes that Governor Barr stressed in his remarks. Ms. Stark has worked internationally and domestically as a practitioner and funder to support and funds sustainable for-profit and nonprofit financial service providers that deliver well-designed, affordable products and services. She began her career in banking around the time of the savings and loan crisis, and she spent the early part of her career foreclosing on shopping malls and office buildings on the East Coast. And she had a life change, moved to Uganda, and there worked more on micro credit and really on the affirmative side of financial services. And that's where she's concentrated her time, energy, and effort to those affirmative outcomes. And again, ones that Governor Barr mentioned, which is really setting people up for success when they take on credit and other kinds of products so that it ultimately is to their benefit and improves their financial health rather than undermining their financial health. So I'm among many here who are looking forward to hearing what the two of these individuals have to say. They really are very well qualified to have this conversation. Governor Barr himself has done a lot of work on behavioral economics and is the one who introduced me to this probably around 2001 and 2002 is something I should be spending a lot of attention on. So with that, I'm going to turn it over to you. I'm not sure which of you gets started. It's going to be a little bit of a dueling banjo kind of thing, but all right.
I think I won that round. So thank you very much to everyone for inviting Ideas 42 to join. Governor Barr knows Ideas 42 very well from 15 or 16 years ago when it was created. You have lack of slack, we have scarcity, but in both cases, we're talking about working with folks who are dealing with a lack of slack. Our work is on behavioral science, behavioral design. We are trying to create or improve, innovate on products that are designed to serve low to moderate income folks. But there are a lot of these products, but they're not getting taken up. Or people use them, don't use them successfully, drop out of them. So a lot of the work that we do is with practitioners who want to address a specific problem that their good product isn't working for the people that they want it to work for. A lot of this could be due to scarcity. You're dealing with so many things. You have bandwidth issues, and then somebody wants you to read the terms, the conditions. They want you to get your Social Security card and scan it and upload it before you can apply. And that's going to stop somebody from doing what they wanted to do in the first place. So we call this the intention action gap, and it's something that we're trying to bridge. I'm going to talk about repayment reminders in a few minutes because it's one of those nudgy things that people think about with behavioral science, and yet it's not always out there in the marketplace. So I think all of us know what these nudges and reminders look like. I really don't think I've actually remembered a doctor's appointment in the last 5 years that I didn't get a reminder for. But we don't always do it in financial services. And you know, as you mentioned, for a product to be successful, particularly a loan, you have to repay it on time. So I know that I want to talk about small dollar loans, but I'm going to ask you to talk about why you're so interested in this space and where you think it can take us.
Well, thank you, Evelyn. It's a really pleasure to be in conversation with you on this topic. I got started working in behavioral finance about 20 years ago, working with two of the founders of Ideas 42, Sendhil Mullainathan and Eldar Shafir, an economist and psychologist. And the three of us got together during the subprime crisis, before the global financial crisis. The sort of canary in the coal mine was the subprime crisis. And we tried to think about ways in which we could use insights from economics and from psychology and from the law to come together on a framework for understanding how we could improve not only products and services, which is the area that you were just focused on, but also regulation and law itself, to make sure that we were, in thinking about our legal frameworks, setting up a framework that made sense for human beings and human decision-making, and not just assume that humans would act according to traditional economic principles, but based on years of behavioral research, how humans actually make decisions. And you've talked about some of the gaps here, that gap between forming an understanding of something and actually acting on that understanding is one of those. But there are many biases that we all have that's important for us to take into account in thinking about shaping regulation. But we also wanted to point out in the work that we did together that it's not just about human beings, it's about the market environment that human beings interact with each other in. And there are sometimes moments in time in which market forces are well aligned with helping human beings overcome their behavioral biases, and that can lead to good outcomes. And there are other contexts in which market participants may have incentives to exacerbate or take advantage of human biases. And in those instances, we need regulators, supervisors, the law to step in and move the market back to a place that provides for safe and fair products and services. So that work is really what, and that collaboration with these, I think, wonderful and talented academics is really what brought me into the space that again led to this book, No Slack, but also before that, a bunch of papers that the three of us wrote together in this area that advanced my own thinking and I hope helped the field a bit.
So your team asked me to talk about specifically in small dollar lending, how we have seen behavioral science connect. So we've seen quite a lot of growth, as you mentioned, in small dollar lending since 2020. 6 of the top 10 banks are offering them. Bank of America and Wells have mentioned them in their earnings calls. They're reaching millions of people. The credit union space is growing quarter after quarter in the small dollar lending space. So what's interesting there that we hear when we talk to customers is they're breaking mental models. So customers have these mental models of banks that say banks are slow. Apologies to the banks that are here. Banks are slow. Banks don't want to serve somebody like me. Banks start their personal loans at $5,000. I'm going to have to do a lot of paperwork. So when they've been introduced to the small dollar loan, they've actually been amazed. Customers told us these are much easier, faster, and better than payday lenders. Right? They can apply online always. They can apply at 10 o'clock at night or the day before they need it. And the money is very often in their account within 5 minutes. So we love that that is happening. It's often the first yes that people have ever received from their bank for a loan. But inclusive financial products also have to be good. They have to actually help you achieve your outcomes. So I'm going to talk about 2 of the things that we've seen help people make good choices, which is what Joanne talked about this morning. So one is positive friction in the application process. So behavioral science has taught a lot of us to do defaults and to pre-fill applications. The problem with that is if a customer is in need, they're lacking slack, they need to solve a problem, they're not going to go in necessarily and check, wait, is that the payment, if that comes out on the second Friday, is that also the day that I'm paying my car loan, right? They can change the date, but if we pre-fill it, are we actually setting them up to have the payment clash with their other cash flow needs? Another thing is putting the total amount that you can borrow. So if I have a $1,000 need, but I have a $2,000 offer, present bias is going to tell me, oh, I should take the $2,000. You know what? There's all these other things that I can use that other $1,000 for. But this is where an application can say right away to your future self, you are going to have to pay me back $600 a month if you choose $2,000. So you can use the sliders and all those other things that you've seen on sites where you can actually say, oh, wait a minute, I'm comfortable with $300 and I want it on the second Friday. So in the application process, we can start making it easier for people to be successful. And then the other part is reminders. So everyone thinks about these reminders, but they don't often happen. So we worked with a bank, a credit union outside Richmond, People's Advantage, Federal Credit Union, to put reminders in. They didn't want their customers getting late fees, having their debit cards turned off, or getting reported to the credit bureau. So we designed reminders that weren't, too judgy, too mean, but they were timely. And after our test, we saw that 11% fewer people had any late fee consequence, any late consequence. So this really worked. Did it work for the bank, though? Well, the bank saw the proportion of past dues drop 19%, 20% on multi-months. And then they thought it was such a great idea that they applied it to their entire portfolio, not just their small dollar loan portfolio. And the following month, they had 1.3 million less in delinquent payments. So the idea that, we think of reminders sometimes as just little nudges, but the ultimate impact can actually be really, really quite good.
I was just going to say a couple of interesting observations about the story you just told that I think are really important to highlight and maybe bring out. One is, people often talk about financial education as being really important, but one of the things behavioral research has shown is it really has to be right when the consumer needs it, not some abstract class. And the thing you're demonstrating really is if you educate people in the particular form that you do, by showing them choices in the moment in which they need to make a decision, you can have a very big effect. The second, I think, really interesting thing from your remarks is that giving people control over their financial lives is really the goal. And if you give people that kind of control, just little things like the dial you can slide to pick the right amount of payment, that makes a big difference in people's lives. So they're pretty simple lessons, and they can have a very, very large impact.
And of course, it could only be powered by cash flow data in this case. So I know that alternative data is something really that you've been diving into, and we talk to customers. They're very aware of their credit scores. They are not often that clear on what alternative data might be or what cash flow data might be. So I'd be interested in how you see that fitting into the larger space of consumer decision making.
Yeah, I do think that alternative data can play an important role in expanding access to credit services and to improving the credit scores of individuals depending on the program they participate in. Cash flow underwriting is the most prominent example of using alternative data. There are others. But the basic idea with cash flow underwriting is consumers are engaged in all kinds of transactions all the time that are missed by traditional credit scores. So if you are regularly receiving income, that's a really important piece of information. If you are regularly paying your bills on time, if you're paying your rent on time, if you're making utility payments on time, that's evidence of your creditworthiness that's not captured by traditional credit scores. So there are lots of initiatives now to move that into the mainstream system. We're very supportive of that here at the Fed. Think it's the right thing to do. We've issued guidance back in 2020 on small dollar lending for the same reason. These kinds of approaches are safe for the financial institution to offer and fair for them to offer, and we want to be supportive of that kind of activity. So I do think cash flow underwriting, alternative data, if managed appropriately, can expand access to credit for quite a number of people, and we've seen evidence of that already.
One of the interesting things that we saw when we talked to customers, like I said, they really recommended this product. They really appreciated that their banks had offered them. They were not sure why the bank offered them the loan. They knew that they had been depositing there for years or months, but they were not always clear. When we asked them, did they pull your credit score? They said, probably. I don't know. So I do think that the ambiguity is something that can be improved upon, especially if you don't have a mental model that your bank actually wants to lend you money. Not understanding the criteria that they're using to approve you, can lead to the choice, which is no choice. I choose not to even apply because I'm pretty sure it's not going to happen. So this is one area that we thought was going to be useful to increase eligibility and increase more people joining into small dollar loans. If you know that you can't have any overdrafts for 3-6 months, if you know that you have to do direct deposit, these things can actually help you get access to credit. So we're fans of that as well. I'd be interested in hearing your thoughts on BNPL. So it has some of the nice aspects of small dollar loans. It breaks a bigger purchase down into smaller pieces. But obviously there's some concerns. We heard about them quite a bit in the earlier panel. What are your thoughts on this? It's innovative, it's new.
Well, I think buy now, pay later is an important innovation that can help customers get access to the goods and services they need and can help them spread those payments over time. So it has an important financial inclusion aspect to it. And if managed carefully, can be a way of safely and fairly offering a financial product. The concerns are that sometimes people misjudge their own ability or misunderstand their ability to make payments. They may not understand what happens if they make a late payment. They may not understand what happens if they can't pay in full over the 4 payments or 6 payments. And that can lead to the same kinds of problems that we've seen, for example, with payday loans. So you can get caught in a debt trap. You can get caught paying excessively high fees or interest rates, even when you thought the initial set of payments were going to be free. And we've seen a significant growth in buy now, pay later. It's now used by about 15% of retail consumers in our study. And delinquency rates have gone up to 25%, which is really a sign of concern for me that the product is not being offered in a way that consumers fully understand the risk. So it is a growing area of concern, and I think one that we should all be paying attention to.
From the behavioral side, it's completely leaning into present bias, right? I'm at the cash register, I'm online, I can get this right now, even though I can't actually afford it. And then it has very unclear consequences. Am I stacking them?
I think you used the example of BNPLing my burrito.
Yeah.
You don't want to do that.
I can just imagine when you get your payment and you're like, wait, I had $100 worth of burritos last month. I think that those are some of the, making those consequences more salient up front, make them pop. How many of these do I have? How much am I going to owe? And how am I going to make that happen? But there are other interventions that are also pretty seamless and clean that I think you think are going to be much more positive. And I think you just talked about FedNow before.
Yeah, I mean, there are lots of technological innovations that one could cite in this space. I think technology can be an important way of expanding access to credit and access to banking services. But I will just highlight one that we're involved in here at the Fed, which is FedNow. And we don't offer direct services to consumers or to businesses, but we're offering FedNow as a service to banks and to credit unions. And banks and credit unions can sign up for FedNow and then you offer that to their customers, to households and businesses. And the private sector can develop innovative applications to sit on top of FedNow to make sure that FedNow is reaching the broadest number of individuals it can. And having access to this technology enables banks to offer services to their customers that would help particularly low and moderate income customers, small business customers, who need control over their funds. They need to be able to get their funds quickly when they're owed, and they need to be able to pay in the time that makes sense for them in the flow of funds that they have. And instant payments can offer that service. What it really takes, though, is this is not just going to happen in a way that helps low and moderate income consumers on its own. Banks and other parts of the private sector and consumer groups and community groups need to act on this, design the products and services with intentionality at the outset, saying, hey, it would be good for us to develop a product and services that actually meets the needs of low and moderate income consumers. That's why we're going to design it this way, building on the FedNow infrastructure. So I think if we see banks and credit unions doing that, that will significantly advance financial inclusion, potentially for millions of households.
Can I ask you, this is off some of the topics that we've been talking about, but we talked about this at lunch and a little bit earlier. There's lots of reasons that we want to spend money, but there's not as many easy opportunities to save money. There's no savings store in the mall. And
I like that idea.
So do I. But you're making me think that with FedNow, is there a way to use that also to do kind of an instant savings? So when I think about my first products, I was a kid and I had a Christmas club. I don't know if anybody remembers those, but $5 a week, it was huge. And are there ways that we could use this also to innovate in the savings space, not just the credit space?
Yes, again, these are not direct services the Fed provides, but using the FedNow infrastructure, banks and credit unions and other technology providers could use instant payments to increase savings. So instant payments could be divided into a transaction account and a savings account. Or instant payments could come in and be immediately direct deposited into an investment account. So there are definitely ways of using the technology with the private sector innovating on top of it to let people see instantly that they can add to their savings.
Great. I'm gonna remember that one. Thank you. One of the other things that we talked a lot about in the last session was trust. And behavioral science and trust go together quite well, I think. So I would love to hear your thoughts on how we can build greater trust.
Well, trust is absolutely essential. Let me just say, not just as a matter for financial inclusion, but for the whole financial system. The whole financial system at bottom is built on trust. It's a set of relationships that depend on trust. And even our most basic kind of safe assets in the financial system rely on there being trust in those assets and in the central bank of the United States. So trust is foundational for the whole financial system. Trust is also really important for financial inclusion. We do know that a number of households that are unbanked, for example, cite lack of trust in banks as an important reason for them not being involved in the banking system. I mentioned that coalitions around the country can help banks overcome that trust gap by bringing people into the system. Banks can help overcome that trust gap by offering products and services that meet the needs of low and moderate income customers. So if you are offering a product and service that's likely to lead to delinquency or likely to lead to insufficient fund fees or overdrafts on a regular basis, you're not going to incur the trust of households to participate in the financial system. So hidden fees, hidden costs are things that undermine trust, and being transparent and open is a way of increasing trust. I will say I have concerns that given the cuts that are happening to the Consumer Financial Protection Bureau, that customer trust in the banking system will decline because there's likely to be more problems for consumers in the banking system. So all these things matter for financial inclusion. We need customers to have good products and services that meet their needs. We need customers to have financial education that they need in the time that they need it. And we need sound consumer protection to make sure the system is operating in a safe and fair way for everybody.
When we talk to customers, I mean, they just nailed exactly what you're saying. This idea of hidden fees, they may know that there is a fee, insufficient funds fee, an overdraft fee, but it came up at the worst time for them. And they want to know that their bank is actually trying to help them, not trying to get them when they got the insufficient funds fee. So, you know, I think there are a lot of interesting places that we can look at building trust within the current system and also helping customers. So I think I'm going a long way around saying a couple of the things that we've been looking at are things like these small dollar loans, for example. Right now, the default when you overdraft your account is an overdraft. Right? What if a default was a small dollar loan if you were eligible for a small dollar loan? You would have a set repayment. You wouldn't have to pay the whole amount back tomorrow. You would know the interest rate and those kinds of things. And then the other thing that we heard from people who got small dollar loans was how much more they trusted their bank because their bank trusted them. The fact that they said, you know, I've been giving this bank my paycheck every month or every 2 weeks for the last 3 years. This is the first time they gave me, they trusted me on this. And trust is a two-way relationship. It's not one way. So I think sometimes banks or credit unions, you know, they are trustworthy, right? They are not going to lose your paycheck. But that other side of the relationship, building it both ways, I think is something that we've seen builds that sense of trust. And the bankers that we've talked to that are offering small dollar loans, they tell us that they feel more part of their community. And so it's this very nice virtual circle that the trust gets built and then it broadens out. So not that it's all about small dollar loans, although apparently I seem to like them a lot. And so
we have seen, I mean, there has been a significant increase in the offerings of small dollar loans in the last 5 years. So it's really, I think, you know, people were not sure whether it would take off and how it would perform. And what we're seeing in the data is that small dollar lending has increased quite a bit. It's performing quite well. Costs have been coming down. So I do think it's something to be encouraged by.
Absolutely. And the banks that we've talked to were generally surprised that the tech costs were much lower than they had anticipated, and that the past due and delinquencies were much lower than they had early anticipated. So yeah, I think there's some positives all the way around. So if I'm thinking, here we are at the second annual financial inclusion meeting, right? Let's go ahead 5 years, and we're at the 7th annual financial inclusion meeting. What are the issues?
The team here at the Fed are really good planners, so they have already started working on the 7th annual.
Well,
never fear.
Maybe we should ask them what the title of the 7th event is. What do you think, you know, if you could wave your magic wand, what do you think is going to be different in 5 years for inclusion?
Well, one of the things that I've learned doing monetary policy for the last 3 years is it's much easier to predict the past than it is the future. So I'll be, you know, cautious in my approach, but I do think that we are going to see, we have the opportunity to see greater use of technology in serving low and moderate income households, more products and services that meet the financial services needs of low and moderate income households, The role of artificial intelligence in serving households and businesses is certainly going to grow. So we're going to see much more of that in financial services, and that could help bring down costs, which might also expand access. So that's the potential positive vision. But it doesn't have to be that way. There are lots of ways that it could go wrong. And so I think one of our tasks as people working in this field is to also think about the downside risks, think about ways in which consumers might actually be worse off in 5 years, and try and guard against those risks today. So taking advantage of the opportunities and guarding against the downside risks, I think, are also important.
And I have to say, we're probably the only panel where we didn't mention AI until the end. So,
but I've given 5 speeches on it in the last 3 months, so maybe it's a little bit on the brain.
On AI, can you tell me how you think about tech and touch? So AI, we've heard a lot about the agentic AI, and it may be telling us, here's the best account, here's what you should be doing, here's what you should be doing. So do we just lose people, or where is the touch really going to be maybe more important with AI?
Well, I do think that artificial intelligence is likely to drop costs dramatically, and part of the way AI drop costs dramatically is by automating things. And that can, again, expand access to credit, and expand access to banking and to financial services in a positive way. But there's always going to be the need for more personal connections. Some of those have to do with the trust factor that you mentioned, of bringing people into the system. Some of those factors are about truly being able to make judgments about loans to a business in your community. I've talked to lots of community bankers around the country and to small business owners over the course of my career. And so many of those stories are about a banker trusting a businessman and a businessman trusting a banker. Their kids play together on the soccer team, or they know each other from church, or they've seen the hard work that somebody who wants to be a business owner was doing as a janitor for 20 years and then wants to run a janitor company. So that knowledge, that personal knowledge and connection and trust is really critical. We see it in community development financial institutions and in minority depository institutions. Part of what the service they're offering is demonstrating that if you know your community and know its needs, you can serve them profitably and safely and fairly through the work that you do. And once MDIs and CDFIs show the way, mainstream banks often come in behind and like, oh yeah, okay, now I see it. I can do that too. And CDFIs and MDIs can work on the next big problem to address. So I do think that human connection, that institutional knowledge will always matter, but it's possible that technology will expand access and reduce costs in ways that are very productive.
Fantastic. That's I think the tech and touch is so important. And when I talk to our credit unions and CDFIs, they see the connection because they can outsource some of the more mundane work on the tech side so that they have more one-on-one time. So tech, I understand that there are going to be empathetic robots. I'm a little doubtful, but on finance, we do need human empathy. We need to have the opportunity to sit next to somebody and say, is this a good idea? And we want to make sure that those staff are available because they're not doing a mundane task.
I will say, I mean, AIs don't demonstrate what we think of as empathy from the sort of heart inside out, but AIs have become quite good at mimicking empathy in ways that humans like. So it may be that AI is also part of making connections to a broader group of people who might not have access to the human empathy that that they need. So I wouldn't discount the fact that AI can help with empathy too.
All right, I love it. Do we have any closing remarks?
Well, it's just I want to again thank Eric and his team and Art and his team for the amazing work that was done organizing this conference. Really grateful to all the staff who've been working on it, and to all of you who are participating in the room and watching online, because the work that you're doing all around the country is making a huge difference to expanding access to financial services for low-income people and low-income communities. And that's just wonderful work, important work for the whole country.
Thank you, Governor Brock.
Thank you all.
Take about a 15-minute break and reconvene at 2 o'clock. Thank you.
All right, good afternoon, everybody. Thank you for joining us for this next panel. We're going to be focusing on mission-driven organizations. My name's David Newville. I'm with the Division of Consumer and Community Affairs. I'm in our Research, Analytics, and Engagement branch. And this is, we're 1.5% of the way through the Financial Inclusion Conference so far. And I'm particularly excited. I mean, it's been great content all around, but I'm particularly excited for our panel because I believe that in all our coverage so far, we really haven't focused exclusively on financial institutions yet, even though they obviously play a pretty key role. And I think when people think about financial institutions, obviously there's no financial inclusion without financial institutions. People often think, and rightly so, that there's a lot of attention, as we've heard today already, focused on banks, financial institutions versus non-banks outside the system and the relationship there, and all the things that come with that, particularly when it comes to a regulatory approach. But a lot of people don't realize, who folks in the room here, but folks online may not realize that, not all financial institutions come in the same stripes or the same approaches when it comes to financial inclusion. And when it comes to mission-driven organizations, particularly looking at underserved communities, as we heard the shout out coming from Governor Barr earlier, really kind of lean in and focus on underserved communities in particular ways. And people, it's confusing enough with the regulatory structure, but folks may be confused about what's an MDI versus a WDI versus a CDFI. So we're going to get into all that, the alphabet soup of different types of organizations, and we're going to get very concrete about some of the real differences that these institutions are making in their communities. And we have a wonderful panel here to join us, the perfect panel to discuss this. We have practitioners, we have researchers, we have members of our own Fed system to kind of talk about the role that we play in this ecosystem as well. And we're going to dive into all of that. I will do very brief introductions of all of our panelists in no particular order. And then how I'm going to approach this is I will ask everybody kind of an individual question to go for the first round, give them a chance to introduce themselves or their organizations a little bit further if they want. Then we'll do another round for everybody. And the questions everybody gets, we'll start with them, but if others want to chime in, they should jump in as well. We'll do some general questions, and then we'll try to save some time for questions from you all as well. So with that, we'll dive into the bios. So again, starting in no particular order, I'll start with Nicole. Nicole Elam is President and CEO of the National Bankers Association, also known as the NBA, and the youngest person to serve in that role since the organization's founding in 1927. Ms. Elam is an attorney and brings a robust background in industry, having worked in government relations and public policy for more than 17 years, most recently at JP Morgan Chase, where she led efforts to invest in equity and inclusive economic growth. And then we have Gregory Fairchild, who is the Isidore Horween Research Professor of Business Administration and the Associate Dean for Washington, D.C. Area Initiatives and Academic Director of Public Policy and Entrepreneurship Dean and CEO of UVA. Mr. Fairchild's research focuses on community and economic development financing, particularly related to best practices and multidisciplinary approaches, as well as entrepreneurship. He also works as a consultant for corporations, nonprofits, and government agencies in addition to his academic work. And then we have Darren Williams, who is the CEO of Southern Bancorp, which focuses on economic opportunity in communities throughout the Delta region and manages more than $2.8 billion in assets over 56 locations. Mr. Williams, an attorney and former legislator, and Southern Bancorp concentrate on home ownership, entrepreneurship, and savings as a way of building wealth in the communities they serve. Mr. Williams is also part of the Fed family. He sits on the board of the Little Rock branch of the St. Louis Federal Reserve Bank. And last but not least, we have Tessa Lamel, who is the program manager for the Partnership for Progress at the Philadelphia Federal Reserve Bank, where she works with institutions that promote banking access to underserved communities, The program run by Ms. Lamel provides tools to institutions, including one-on-one discussions to determine the needs, goals, online content and resources, training programs to increase examiner awareness, and outreach programs, among other things, with a goal of safe, sound, and accessible banking system for all. So we'll kick off the individual questions with Darren first. And again, feel free to introduce yourself and your organization a little bit more if you'd like to. And then if you could tell us a little bit about CDFIs in particular, community development finance institutions, and help folks, especially those online who may not be familiar with them, understand the basics. What's the difference between CDFI banks, loan funds, and other types of traditional financial institutions? And how have CDFIs evolved in your time in the industry? Yeah.
So thank you, David, and so happy to be here. Thank you for inviting me, and thank you to the organizers of the conference. So Southern Bancorp, we are among the first CDFIs ever certified back in the early 1990s when President Clinton passed the Regal Act, which created the CDFI fund at Treasury. Southern was founded well before that as a mission-focused institution. We were modeled after maybe the first development bank in the country, a bank called South Shore Bank. And at the time, Governor Clinton was governor of Arkansas, trying to find ways to stimulate activity in Arkansas's Delta region, a very historically poor community that suffered from a number of ills. South Shore Bank was a bank that's operated on the south side of Chicago, predominantly minority community that had been redlined, and organizers decided to create an institution that would focus on investing and lending to that community. And over time, you saw housing starts go up. You saw small businesses begin to thrive. And so Governor Clinton came across a report about South Shore Bank and invited folks from Chicago to Arkansas to start Southern Development Bank Corporation. Fast forward, when Governor Clinton becomes President Clinton, he loves the idea so much he takes it to Washington D.C. and creates a CDFI fund, and we're part of the first group of CDFIs ever that were certified. So we are really three CDFIs. So we are on what I call the for-profit side, a bank holding company. I have the pleasure of serving as CEO of the holding company. It wholly owns Southern Bancorp Bank, which is today a $2.9 billion CDFI with 56 locations, with a mortgage company that serves, in addition to Arkansas and Mississippi, serves Tennessee, Alabama, Georgia, and a little bit of Texas. So we're expanding. We just, I guess 3 weeks ago now, announced intention to acquire another CDFI bank based in Springfield, Missouri, that would put us in Oklahoma, Missouri, as well as in Texas fully with operations. That's Legacy Bank and Trust. They're about a $1.9 billion CDFI, so we'll be close to $5 billion when the Federal Reserve approves this acquisition, when it all goes through. So that's on the for-profit side. On the nonprofit side of our organization, Southern Bancorp Community Partners, which is a CDFI nonprofit loan fund. And to David's questions, CDFIs take a number of shapes. They're banks and credit unions, what I would call deposits, that take deposits, and then they're also loan funds and venture funds, and they may be for-profit or nonprofit. So just a little bit more about the industry. As a CDFI, the certification says that 60% of your activity, and they really measure lending, must take place in low and moderate income communities. So we really measure that almost at the census tract level. So these institutions were started and created for the very purpose of financial inclusion, right? To help folks who otherwise were not getting access to capital and credit, help communities that had been disadvantaged, historically overlooked, and denied access to capital and credit. So our very work, more than 6%, or at least 6% of our work has to be in those communities that have been left out, left behind, and often forgotten. I tell folks that we serve places where large institutions have abandoned. And so a little bit about the Arkansas Delta, where Southern works. Again, I said we have 56 locations across Arkansas and Mississippi. In 75% of our branches are located in communities that are rural. In 8 of our markets, we're the only bank in town. In additional 3, there's one other financial institution. Our competition is often predatory providers. So, for example, in the state of Mississippi, there are more storefront payday lenders in Mississippi than are McDonald's, Burger King, and Starbucks combined. So I'm not often competing with another bank. I'm competing with someone who provides high-cost, often predatory forms of capital. So in addition to providing capital, we also provide really high-touch financial education and small business technical assistance to our borrowers. And this is what's really needed. A little overview of the industry. In 2023, the New York Fed did a study and looked at the CDFI space and how it had grown over time. It had reached, at that time, $452 billion in assets total. There were, at that time, 1,487 CDFIs. That's all the different types combined, mostly credit unions, followed by loan funds, banks being the smallest, well, banks, and then venture funds being just a very few venture funds. Today, that number has dwindled a little bit. There are a new policy shift around how do you certify as a CDFI? And many CDFIs are not either choosing to continue their certification or not eligible to maintain their certification. So that number, according to the Richmond Fed, has dropped a report, I think, in March this year to 1,414 CDFIs. Again, credit unions and loan funds make up the vast majority of them. On the what I would call depository space, again, credit unions, loan funds, we take deposits and then we lend those in the markets according to CDFI guidelines. Loan funds and venture funds are, while they don't take deposits, they have to raise capital. So they partner with great public-private partnership, partner with other institutions to raise capital. Southern Bank of Community Partners, it's about a $50 million loan fund, and we receive PRI investments or charitable contributions from a number of philanthropic organizations and people who support the mission, the work that we do. And then they run very high-touch programs to provide capital, credit, and again, financial development services in the markets we serve. And maybe I'll pause there and get further into it.
That sounds great. Thank you so much, Darren. So Nicole, now we'll shift to you. You can tell us a little bit about MDIs as well, minority deposit institutions, and give folks a little background on that as well.
Perfect.
Yeah.
How many people know what an MDI is, a minority depository institution? That's more hands than what it was 5 years ago. A minority depository institution is a bank that is predominantly owned or operated by people of color. And because of that, they predominantly sit in and serve communities of color. So it's no surprise that a lot of their lending is going to communities of color, is going to LMI and underserved communities. Our organization, the National Bankers Association, represents MDIs, and it was actually formed because minority banks at the time could not join the American Bankers Association. So our banks are really born out of necessity to ensure that communities had access to capital and credit in a way that they needed. So today, what makes MDI stand out? What I would say is that minority depository institutions aren't just banks. What they are drivers of wealth creation in communities. They are anchors of economic opportunity. And it's because of who they are and who they're serving. They are banks that are saying yes when other banks are saying no. Maybe because they're not serving them, or because, as Darren pointed out, they're not even there to serve them. And the reason why our banks are able to say yes when other banks are saying no is because they deeply know and understand the people and the places that they are serving. Our banks are serving communities that are 77% minority, that are 2 to 3 times more likely to be unbanked or underbanked. They're serving in communities that have persistent poverty rates at a rate that is 4 times that of other non-minority banks. So they're doing the hard work, but there's great news in them doing the hard work. If you live in a community and a minority bank is present there, you're oftentimes in a community that has higher credit scores, which most times people wouldn't think about that, but you're in a place that you have a higher credit score just because of an MDI is sitting there. And that's based upon, again, the demographics of the communities that they serve. So what's the differentiator? What makes them stand out? I think a couple of things that makes MDI stand out is the alternative lending models, right? You don't get to say yes when other people are saying no because you're doing the same thing as everybody else. Before alternative lending data became a thing and alternative underwriting was a thing, these banks were doing it manually before anybody else. They were looking at cash flow data. They were looking at data that just wasn't on credit reports. That's how they got to yes. They're creating products and services services that are tailor-made for the communities that they serve. Another thing that is a differentiator for MDIs is the culturally competent banking that they're doing. You know, the people who are in the branches serving the communities came from the communities. Multilingual services are a norm. The fact that they are providing products for immigrant households and immigrant businesses is a thing that's a norm. And lastly, what I would say is that they are deeply focused on reinvesting into the community. So the deposits that they get, they are using them to do increased lending in the community. And so they're helping people buy homes, build businesses, and save for the future, ultimately helping people build wealth when other places and other banks aren't. So I'll stop there so we can get to some crazy questions. I heard AI and innovation is coming up, and I'm an AI, no, I'm not an AI expert.
So thank you for that. You know, you and Darren have definitely laid out, as Governor Barr said earlier, you know, MDI, CDFIs, mission-driven organizations are really on the front lines of kind of paving those pathways, really prioritizing underserved communities, creating those models, and, you know, obviously setting up, taking things that are unknown, maybe risky, and showing that they're maybe not as risky or unknown. Gregory, I'll turn to you next to kind of talk about your research, since you've done work on both MDIs and CDFIs, to kind of talk about what are the research findings here. You know, what do we know about the effectiveness, the limitations? You know, there may be some misconceptions about MDIs and CDFIs that research kind of indicates can clear up, given the vast amount of work that you've done in this space. Yeah.
I hope so.
Yeah.
Let's see what I can do. First of all, the University of Virginia, it's an institution started by a guy named Thomas Jefferson. It's a couple hours down the road. I work for the Graduate Business School there. I'm a researcher, which means I am not representing a financial institution. I'm here to critique them. And so my work is generally work that looks at not what we might hope to be happening, but what we know happens or doesn't. I met Darren when the MacArthur Foundation had me studying the business models of CDFIs, all the way back about 17 years ago, Darren. Nicole Elam and I spent a little bit of time on the phone because she had heard about the work that I've done. I did this work, some of what I'm going to show you, and I assume I'm showing now. Yeah.
I think you just have to hit the,
Okay,
just
sure.
hit the slide right there. Yeah.
So what I'll do is I'll let you know that this work builds on the work I did for the MacArthur Foundation. Then I was asked by the Treasury to come back and do the 20th anniversary review of the CDFI fund. I also do sit on the board of LISC with a guy named Bob Rubin, who I think was there when the Regal Community Act was started. Virginia Community Capital is an organization in the state of Virginia. I sat on that board too. But I am primarily a researcher, so what I tend to do is look at the data, what the data tells us. I have few stories about families or individuals. I just look at numbers. So if you're okay with that, I'd like to press on and do that. The work I'm going to show you is about two questions. First, whether CDFIs or MDIs are riskier in two ways. One of them being, are they more likely to fail, that is, institutionally fail? And secondly, are they inefficient? These questions are ones that you find a lot in the field. When the 2008 crash happened, a lot of banking institutions went under, and there was a lot of debate in the public sphere about CDFIs in particular and whether they had caused the problems of the financial crisis of 2008. Later turned out not to be true. At that point, I began examining questions like whether, A, was it true and could we compare? And then secondly, some questions around whether in some ways the dollars that were subsidies that went into CDFIs or MDIs would just be better spent elsewhere. There really are, these questions come out of four things. Nicole spent a lot of time and Darren spent a lot of time telling you about how low income and how minority all their clients were. There are those who look at those things and say, well, that must mean they take on undue risk. They also told you about the size of the institutions, the market they operate in. There are the people who think that that means they're less capitalized than other types of banking institutions and that they happen to have less technological capability. The fourth question, remember I work in a graduate business school, a place where we talk about finance and usually no one talks about CDFIs or MDIs. The other thing people wonder about is whether there's market contagion, particularly as it relates to mortgages. So when Nicole tells you that they are the lender in these communities and Darren does, one of the questions is if they have lent in a market where someone else has lent, and the housing in that market, one or more houses go under, it affects the loan-to-value ratios of the loans that Darren and Nicole have done, even if they've been prudent in their lending. So these questions then are ones that fall out of, again, what they've told you are the markets that they operate in. Let's take a next look. Risk of institutional failure. Now, some of you may know what a CAMEL model is. And if you do, you know that bank regulators use CAMEL models. CAMEL models are actually logistic regressions. They're logistic regressions that predict the likelihood of failure over a period of time. In this case, in most CAMEL models, that's over the 8 successive quarters. So in other words, if I started today, I could be able to look at the financial measures in a financial institution, and I could tell you with some degree of accuracy whether 8 quarters from now, 2 years from now, it has a likelihood of failing and what that likelihood could be. That's what I did. And in this work, what I also did, if you see the bottom portion of that slide, is something called data envelope analysis. If any of you are trained in operations management, you will know there's something called the efficient frontier, inputs and output models. And inputs and output models take any system. There are a set of things that come in the front door. There are a set of things that come out the back door. You measure what comes in the front door. You measure what happens in the middle. You see what comes out the back door. And you determine who is more efficient at taking inputs and outputs and having them match on. And that could be any type of thing. In this case, it's applied to banking and finance, but you'll find it in other types of research. I've typically done it in banking and finance research. How the work that I did includes all quarterly reports from 2002 to 2018 for every depository institution in the United States. And by the way, it includes the recession. So you can determine whether vulnerability was greater or lesser coming in and out of a recession. You should see at the bottom the size of the data set. It was quite robust, giving great statistical power for those of you who like that sort of thing. You also can see that Nicole mentioned that MDIs are organizations and institutions that serve minorities. Many times if you're a person that's black and you say that, everybody thinks you're talking about black institutions. But guess what? There are other types of MDIs, and in fact, they are in the data set as well. Why don't we press on to what the data tell us? Oh, by the way, there are 122,837 observations of non-MDIs because they are part of the comparison set. What you next should know is that the model itself, so you build this thing called the CAMEL model, and then you try to see how good it is at predicting outcomes. And so you look at past data, and you see how well it could predict what happened over the successive 8 quarters. This here is the results of our model that we use. It just shows you how robust it is in terms of its accuracy. What you see there is the safe and failed institutions over that period are in the left-hand column, and our predictions are there in the right-hand column. As you can see, we did have type 1 and type 2 errors. That is, errors where we predicted that there would be failure and there wasn't, or errors that we predicted that it would be safe and it wasn't. But I think you'll find that overall the model predicts at a 98.3% probability of predicting that it would be safe if it was safe, and that it's pretty good at predicting the failure at another 1%. So a total of a 99.3% predictability of the model. And again, I should mention, I think I didn't, I was asked to do the scoring for the CDFI bond fund. It used this exact same model. Let's proceed. First question we wanted to know, and this again is the efficient data. I think I've already shown you these things, but this is a little more detail on how the efficiency model is used, what it does, and again, what it's meant to predict. What you see here, this is a chart literally from the paper that was published in the Journal of Developmental Economics. What you see there in shaded areas, those are places where there was more than a 5% difference between MDIs and non-MDIs in their performance. If you do not see a shaded area, that means there was no statistical difference in performance between MDIs and non-MDIs over that entire 2002 to 2020 cycle. Now, what you'll note is that there are very, very few of those. What you'll also see, and again, registration's not perfectly great from this distance, but what I can tell you is that the dark line are the non-MDI institutions, and that the dotted line are the MDI institutions, and those are efficiency scores. You can see that they're tracking together, and you can see, again, the gray areas are where they're not tracking together. What I want you to note is that in the years where they're not tracking together, there is greater than a 5% difference statistically in their performance. If you were to look, for example, at the quarter between 2004 and 2005, you'll note that the dotted line is above the non-dotted line, which means the MDI's performance was actually more efficient than the non-MDI's performance. Now, again, some of you guys are saying, gee, given what those two said, how could that be? But you want to keep in mind that what a great thing about an efficiency model does is it models the performance against a like institution. So when Darren tells you the size of his assets, he's only compared to an institution with comparable asset sizes. He's only compared to an institution. So he's not compared to an institution that would be an apple when he's an orange. And by doing that, we're able to determine whether his performance efficiently, given what he had going in the door, looks the same going out the door, or does it look less than? You can also see the other periods where there's a 5% difference. So if you looked at 2016, you'll see there's a difference there, and you can see that it's lower. Now, I'm showing you these data as they result to all MDIs. I actually have these data for every type of MDI that was mentioned before. If you really want to read about this and geek out, please check out the Journal of Development Economics. I have the citations for you to look at. Here's what you should know. CDFI banks and credit unions have no greater risk of financial failure than mainstream financial institutions if you control for their size, their structure, and we also looked at whether they have a greater likelihood of having mortgage market contagion. That is, they happen to have lent in places where other failures happened, which drove down loan-to-value ratios and then caused an otherwise prudent investment to have problems. Despite serving predominantly low-income markets, CDFI banks and credit unions had virtually the same level of performance as mainstream financial institutions. Again, the economists will use the word ceteris paribus. That is when we compare them to comparable institutions. So you don't want to compare a highly capitalized bank in the state of Arkansas to Darren's bank because that's not a fair comparison. I did just want to offer a few other things beyond research. And if you ever want to talk deeply about research, I love doing that. The way this came out, I didn't know it was going to orient this way. But just a couple of things. There is some good news for those of us that follow what's been going on. For affordable housing, we know that recent federal decisions included the low housing tax credit increased 12% from 9%. Again, I know we're talking about financial inclusion generally, but many of the institutions that these folks work in actually support affordable housing. Also, private activity bonds were also continued to fund, which is, again, good for this industry. New markets tax credit and opportunity zones were made permanent, which is also a good thing. And then there's some, again, this is the thing, the way the slide was carried over, but the CDFI appropriations is one of the things that we're waiting to see what will happen. I think some of you will be around and have been around long enough to remember where, depending on administration, the CDFI funds appropriations have risen and fallen. And so we're waiting to see what's going to happen with that. I don't have a position on it. I'm just reporting that that's where we are at this moment. Thank you very much for your time.
Thank you, Gregory, for that very succinct and thorough overview of the effectiveness around MDIs and CDFIs. Now we'll pivot a little bit with Tessa. We'll talk a little bit about the Federal Reserve System's relationship with MDIs, in particular through the Partnership for Progress program. Can you tell us a little bit about the program and the history there and the relationship?
Yes, thanks, David. And first, I just want to say it's such an honor to be on this panel with these leaders. And I know, just like all of you, it's so great to get the insights and just hear their experience. So I'm as much soaking it in as being able to share about the Federal Reserve's Partnership for Progress program with you all. So Partnership for Progress was established in 2007, and it's a national outreach effort to support preserving and promoting minority depository institutions. I would also note that in 2021, we added women depository institutions to our program as well. And we really support mission-driven institutions by recognizing that they're unique, as we've heard from others on this panel, and we really want to help them to cultivate safe and sound banking practices. And to share a little bit more around what our program centers, it's really around connection. So at each reserve bank across the country, we have a district coordinator who can be a personal contact to provide tailored support. So we really feel that's important, that the banks have someone that they can reach out to directly with questions or share information as well. And the role of this district coordinator is to really communicate regularly and make sure that they're helping in any way that they can from their reserve bank and share that information. The second component is capacity building. So our program offers direct access to consultative support on a variety of regulatory topics through technical assistance, so including one-on-one guidance. And what we found especially is our smaller institutions and de novo institutions or de novo groups who are thinking about forming an MDI, they reach out to us and we're able to bring together a group to answer their questions and help them with what they're encountering as well. And then I would say finally, it's the coordination. So whether it's within the Fed system, with our interagency partners, or with the industry, we want to make sure that we are bringing the right information that's needed at the time. So we really do try to listen and have some great discussions around what would be most beneficial. And we try to really just be as collaborative as we can and just really understanding that MDIs in particular play an important role in expanding credit access to underserved communities. And really, as we've talked about quite a bit today, the trust. So trust has come up quite a bit, and Nicole touched on that with talking about having the culturally sensitive services available. And that's also something that's important to us. So we really see our role as to listen, to provide support, and to really help share, the impact and stories of these institutions as well.
Thank you, Tessa. So great first round. We've gotten a lot of the overview out about mission-driven organizations. Now we're going to dive a little bit deeper. We'll circle back to you, Darren. You kind of went in this direction a little bit. You touched on it in your overview and kind of talking about what the options are in some of the local communities you serve. Can you tell us a little bit more about the impact? Obviously, when we talk about financial inclusion, we hear a lot about different types of loan products or account access or dollars, total dollar numbers served and those types of things. But can you give us some examples about, the impact that you all have had in the local communities you serve and how it's made a difference for folks, whether it's through access to credit or in other ways? I know you have a ton of stories you can draw from in this area.
Yeah, there are a ton of stories. I would send you to banksouthern.com for a ton of customer stories. Our customers tell their story much better about the impact in their lives. And we've got a customer video section that gives you countless of stories. I was in Memphis last week with the leadership team that we're purchasing, and we took them around to meet some of our customers, and we met Dr. Tanya Lyons, who's a dentist in Memphis, Tennessee, and she has just a fantastic story. It's sad that it became a triumph story, but she had a piece of property that she had financed, really a church. Her ex-husband, who left her during breast cancer, was a minister and left her with a significant amount of debt, huge parcel of property and a building, and went through several years of trying to get this refinanced from a construction loan to a permanent loan. She went through 32 financial institutions. 32, she spent over, she says, over $60,000 in brokers to help her find capital to refinance the construction loan. Went through a court proceeding, and at the end of the day, in about less than a month, we got the loan done, and she's a fantastic asset to the community, doing great work. And the property is not even where her practice located. It's not where her dental practice. It's just her mission in this location, part of the church. She once a week. She feeds over 200, or she provides over fresh fruits and vegetables and groceries for over 200 people. She has a backpack giveaway that brings in over 8,000 people. She does a monthly giveaway that serves over 2,000 people. The city has named the street after her. You want to talk about the impact she's having. But she couldn't get this loan refinanced through any institution. And she has performed well. The interesting thing is there's a building on the property. It's about 50 acres of land. There's a building on the property that she's leased to a national charter school for 99 years that pays the full mortgage. It doesn't make sense that she couldn't get financed. African-American female, had, all the challenges that you often see through discriminatory practices in lending. Just countless examples, and I can go on and on about examples, but at Southern we really focus, and Nicole mentioned the trust factor. Our lenders, our folks in the community, they live in the community that they lend money in. They know these communities. They grew up in these communities. And to shed a little light on what Gregory talked about why the asset quality and why we actually do well is because we know the people, right? This is relationship lending. And so when someone has a decision between who they're going to pay the person. They're going to see a church. They're going to see their schools. Their kids play together. And the town's only got 1,000 people in it, so you can't help but see them, right? So you're going to pay them back. And so we can go on just a number of stories of impact. A couple of things we've done that are unique that doesn't it's not what a typical institution would do. So for 20 plus years, we've done volunteering and tax assistance in our branches during tax season. So why do we do taxes? Not because we like doing taxes, because that's often the largest check that a low wealth person is going to receive. So we marry that with financial education, trying to encourage them to take a piece of that and start saving. So for the 20 plus years we've done this, we've done over 52,000 tax returns, returned over $100 million to the communities we serve. 47 million of that was folks who received the earned income tax credit or may not have received it if they didn't know about it. So this tax season, we did 5,200 tax returns, $7 million in returns, 2.8 million EITC, and we connected 1,104 people with financial education to assist them in the work that we do. So that's just some of the examples, and just a little bit about our lending. Our lending is different. So last year we did 9,270 loans, $938 million in originations. 62% of our loans are $10,000 or less. Now, any banker will tell you it takes about as much time to do $1 million loan as a $10,000 loan, but you don't make nearly as much money. And so there's a little Robin Hood, obviously, what we do. We do larger loans to help subsidize that. But that's what the customer needs. That's what the community needs. They don't need a big loan. And if you go to a large institution, no knock on them, it's not their business model. To get a $10,000 loan, you're going to get a credit card application that's going to come with a 28% interest rate. That's not the model that we use. And so we cater the loan and the underwriting to our customers so they are able to pay us back. And so the impact that we have, is tremendous across not just in education, not just in business, but also empowering people to save and accumulate assets. Because everything we do at Southern, at least, focuses on helping people build wealth. And I often quote a study from Pew Research that says 70% of the people born into poverty never make it out. Your grandmother's poor, your mom's poor, there's a 70% chance you're going to grow up in poverty as well. But Pew looked at the 30% who made it out and said, what was unique about that 30%? They all had some form of net worth. Maybe it was ownership in a small business or ownership of a home. Take equity out of the home, send a kid to college. That breaks the cycle of poverty. So everything we do, we do a lot about measuring outputs. We're really trying to measure the growth of a person's net worth, because that's the really focus on how families are able to thrive financially. So that's just a little bit about impacts.
Thank you, Darren, for sharing that and really kind of showing the mission orientation of mission-driven organizations and the different approaches there. Nicole, sorry, to stay on track with the conference overall, we want to keep the future orientation going and kind of shift to that in this panel as well. Can you talk a little bit about what's top of mind for the MDIs, for your MDIs, for your members, and where you'd like to see the industry go in the future in terms of future growth and impact?
Yeah, that's a great question. So post-2020, MDIs experience historic investments from the public sector, and when I say the public sector, the federal government, and the private sector, and that led to explosive growth across the sector. So the sector, by and large, grew from 2019 to 2024, so just a 5-year period. The sector grew 47% in asset size. That far outpaced any other segment in the financial services sector during that time period. And black banks, right? We talk about there are different types of MDIs. Greg mentioned there's black, Hispanic, Asian, Pacific Islander, Native American, women-owned and operated banks. During that 5-year period, black banks grew the most by 85% in asset size. So explosive growth. So the challenge that we have right now is sustaining that momentum given this current environment that we're operating in, given the political headwinds that we're experiencing. And so I would say the big things that I'm paying attention to is, one, the thing that led to their growth is now the thing that is making them a target. When we talk about lobbying and advocacy on the Hill, I can't talk about MDIs. I cannot say MDIs. I've had to rename and rebrand. I am a mission-driven community lender. Why? Because if I say MDI, that's woke. I'm going to lose one side of the aisle. And so that's a huge thing that we're wrestling with right now. As legislation is getting passed, it does not include MDIs because it's too divisive. Again, that very thing that led to them growing is the thing that is making them a target. We're also seeing federal programs under attack that they benefit from, like the CDFI fund and other programs are under attack. Corporations, which were huge at giving them tier 1 equity and deposits, are now pulling away because they don't want anything to do with anything that has to say DEI. So we're having to shift and move away from DEI or the perception of DEI. So we're seeing corporations pull back, the same corporations that help them grow. And so all of these things are challenges that they're having to rethink about and change the way that we talk about ourselves. And our mission doesn't change, but just how we talk about it changes. I'm not talking about race and people, but instead I'm talking about places and socioeconomic factors. So that's a huge thing. So I would say that's the biggest thing. The thing that led to our growth is now the thing that is making us to target. The second is just regulatory reform. This isn't about being a minority bank. Just if you are a small bank, the regulatory and compliance costs are extremely burdensome. So ensuring that as new regulations come out, that they are right sized for the size of the bank and the type of lending that they do. So regulatory reform is another big thing that is top of mind. And the third is technology. You know, we all know that technology is changing everything about the way that we do, how we work, how we live, how we play, and how we bank. And unfortunately, our banks are not keeping pace with it. And if you're unable to digitally modernize, you're not going to be as competitive. Big banks spend $18 billion a year on technology. My former bank spends $18 billion a year on technology. The median asset size of a MDI is $470 million. There's no way that you can keep pace with that. So those are some of the things that are really top of mind for us. And what is going to enable our growth is really addressing some of those things. So we need public, private, philanthropic partnerships that aren't transactional in nature, because when you've got a buzzword and you got to pull out, that's transactional. They have to be public-private partnerships and philanthropic partnerships that are transformational in nature. And then we also need to right-size regulations. We can't keep adding more and more regulations and not being thoughtful and considerate of the type of institution it is. And so right-sizing regulations is also going to be something that I think is going to enable growth now and in the future.
Great, thank you for that. Gregory, thinking of research and keeping the future orientation, tell us a little bit more about where you see areas for future research when it comes to CDFIs and MDIs. And can you talk a little bit about the limitations that you're encountering in terms of research as well, as far as the questions that we can answer and we can't answer?
I'll take the second part of the question first. Questions you can answer and can't answer. First of all, I should have said in preface that the data that I use overwhelmingly has been with depository CDFIs. I have traditionally not been able to do work looking at loan funds, for example, unless, and there have been 2 occasions where foundations gave me their PRI databases, and I was able to use their PRI databases to look at similar financial measures for loan funds. Now, many of you will say that applying CAMEL models, capital asset management, earnings and liquidity models, to loan funds is not something you should do because there's no demand deposit risk that a loan fund faces, where Darren has to think about that all the time. And so he must care about his depositors. The only thing that a loan fund has to do is make its donors happy. And as long as their donors are happy with the quality of their capital and the quality of their work, they're fine. So I will tell you, more than once I went to the Opportunity Finance Network, more than once I spent time with the folks in the CDFI Fund Research Division. There was a team that was there for many, many years. We spent a lot of time looking at many of the questions around loan funds. Those data have traditionally either not been available because everybody didn't report in to the CDFI fund. If in a given year they didn't receive money, they didn't report, so the data was spotty. Some reported in various ways and in various time periods. The great thing about depository data is that you're able to do it on a quarterly basis because Darren's not able to continue to operate because the FDIC will come see him if he doesn't. That's not the case for loan funds. So the CDFI loan fund industry has complained about the challenges of reporting, but I have always said back to the industry, if you don't report, what you run the risk of is there not being data to show the strength of your industry. If you want to attract capital from outside of your industry, you have to be able to give data to show that your organizations actually perform at very high levels. I've been saying that for about 20 years. So one of the things I would say for research would be if CDFI took seriously the idea of attracting capital from outside their industry, outside of the philanthropic providers that they currently have, if they thought about the larger pitch that they're trying to make, giving data to researchers is maybe a good thing that you should do. That hasn't always been the case. Next, I would tell you that, again, taking the second question, research seriously. So there are two sets of researchers in this field. There are a set of those of us who do what we call impact research, and there are those of us that do what's called performance research. I'm in the second group. The vast majority of the research in this field is in the first group. And so it's research that tells you all about who Darren and who Nicole's groups are serving. It doesn't, again, say as much as could be said about, for example, if Nicole's talking about the use of technology being brought to bear to produce scale in her industry, which would be very important for minority depository institutions, then it would be very important that those institutions find a way to create scale given that each institution is relatively small. Darren's absolutely right that the transaction costs for a $10,000 loan are actually about the same as they are for the $1 million loan, which drives down his overall efficiency. So all in all, it would be better if these institutions put their funds together and created more sharing and pooling of research dollars. When I was on the fund board, I asked a question one time. We were having a conference not unlike this, just a few blocks over, and I said to a few people that were leaders in the industry, would you rather, if we had $5 million, would you rather we gave it to you so that you could put it out in the field, or would you rather we took the $5 million and put an investment together so that all of you could have technology available for better operations of your industry? I'm sure you could guess what the answer was. And I just think that tendency, which I tend to find to be well, I think it's a mindset born of a lack of resources, quite honestly. That when people, either as individuals or families, or yes, as institutions, tend to have fewer resources, if you say to them, should you make a long-term investment which will overall better your performance over time, or should you deal with whatever you think the problem is right in front of you right now, they choose the latter. So I think the industry suffers in part from the very things they've said, but also the reticence to share data and also the reticence to make forward-looking investments that cut across the field. There's more I could say, but let's just stop here.
I would say it's good to see that the challenges with future self and present self transcend consumers, but I guess it's not a positive thing in this example or in the consumer example, but it's nice to know that some things are consistent, I guess, at least. Tessa, tell us about, what aspects of P4P that MDIs report as being most beneficial to their organizations and communities. And then tell us, keeping with the future orientation as well, again, tell us about where you'd like to see P4P go in the future, where you see it going in the future as well as the industry develops.
Okay, great. Well, hopefully, what I emphasized from the first question that I had is that by having that local district coordinator, it really helps us not take a one-size-fits-all approach. You have a local person that has a relationship with the institution, that knows the operating market, and has more information available. So I do think that's really valuable to the institutions, and it's also valuable to us to be able to have that relationship. So there's a local context that happens and a local exchange of information. So I do think that the institutions find that relationship and having that personal contact to be valuable. The second part, really around the technical assistance piece. So I think that's also been a valuable part of our program that institutions take advantage of, and really being able to, from our perspective, bring together the right experts to answer their questions and make it a space where they can ask us questions as well. So I know that similarly, we do get requests on a variety of regulatory topics, and I think it's important that we are able to be responsive in that way, and I do think that has also been a great benefit to those institutions. Having that access helps them, navigate, build capacity, helps them, navigate supervision more confidently and really stay focused on their mission. So we're happy to be able to provide that as well. Other things to take it a level higher is just thinking about, our network of Federal Reserve branches across the country. So Partnership for Progress is one piece of how we can support these institutions. So with that local piece, there's a wealth of information that can be shared, whether it's through convenings like this, whether it's through research. On any topic, we have information that can be shared also at a local level. So I think that's also a strength that we provide from the Federal Reserve. I think looking to the future, we want to continue to meet our statutory requirements to provide technical assistance. We're definitely interested in the promote formation of new MDIs, and then also providing training to supervision staff, on MDIs as well. So I think future looking, that's what we're focused on.
Great, thank you for that. So now we'll go to panel-wide questions. I'll let you all respond. We'll do a couple of these, and then we'll turn to you all in the audience for your questions. Make sure we have time for those as well. To start out, can you all talk a little bit about what community-level challenges are most difficult for CDFIs and MDIs to address, and where you are seeing the greatest need to innovate in your daily work?
So many challenges. I think one of the biggest challenges is just lack of awareness. Oftentimes, people don't know the MDI or the CDFI that is right there and that is serving them. So awareness can be a challenge. Even if, as we try to expand, right? I can't just serve my market. I'm now trying to expand to other markets. There's just a lack of awareness of who we are. And we don't do a great job at storytelling. So everybody's not Southern with an impact report. And so we don't do a great job at storytelling. They are phenomenal at storytelling. And storytelling brings in more customers, more investors. And they don't do a great job at it. I think another thing is customer expectations is a challenge. When you think about community level things that are happening, people want you to be high tech and high touch. And hey, I want all the bells and whistles of a big bank, but I want you to pick up the phone and call me, and I need this individualized support, and I need you to use other data to say yes to me. And I think banks are really struggling with relationship banking and being high tech and high touch. I think other community level challenges is that we're struggling to figure out how we can make financial services more accessible and more affordable, because the landscape is becoming more competitive. You've got non-banks and you've got fintechs doing it quicker, faster, cheaper because they've got scale, and that's a challenge that we're dealing with. Embedded finance, the fact that I don't have to go to a bank to get access to credit is a challenge. These are all challenges that we're trying to work through. And then AI, like how do you really skin that cat? We know that AI, that's probably not a politically correct thing for me to say, but the reality of it is we know that AI is a game changer. But if you're a bank and you're just struggling with technology, Cost, it's expensive. Capacity, you'd be hard-pressed to find a chief technology officer. Integrating it with your core, change management, as Greg talked about. So there are so many challenges. And when I survey my members, while they want to leverage AI, they know they need to leverage AI for data and so many different things, enhancing the customer experience, what they say, 50% of them are saying just the cost and the lack of expertise is impacting their adoption. So that is a huge thing that we're wrestling with and we're struggling with. And so one of the quick things that we've been doing is focusing on bot technology, right? So how can you leverage bots to replace some of the manual processes that you're doing? We're not talking about replacing your staff, because I know they've been there for 20 years. I'm not saying that. I'm saying redeploy them to other things and leverage bots. And even that is a challenge, but that's an entry point. There's so many use cases for bots and other AI. So those are some of the community level challenges that we're seeing as we're trying to best serve the communities that we're sitting in.
Just a few challenges.
Yeah, not many.
Nicole covered a lot of them. I don't know. I accept all those. We have all those. But I think at the heart of it too, we serve underserved communities. We serve communities where there's just not much capital, much credit, or much ability to even use that capital. So by the very nature, we're in communities that are less than, have been forgotten about, and so if that community has a financial challenge, it probably also has an education challenge, has a healthcare challenge. It's got a number of challenges, right? So it's not so. And we are often thought of as the savior for the community. And sometimes Southern has been guilty. I won't say all CDFIs. We've been guilty of doing, moving outside of our lane. Like we need to do good at what we do and not do other things. And that's one of the things that when I got to Southern years ago, it's like, why are we fighting crime? Like we're not police. But I say, if you want to finance a police car, great. But we shouldn't be fighting crime. But because in communities where there's a lack of, and there are a few people trying to help, everything gets dumped on them. So we're not just dealing with debits and credits and checking accounts, saving accounts. We're dealing with all the ills of the communities that we serve, and we want to help. But sometimes that strains us a little far. Nicole mentioned one that I will highlight because we're at the Federal Reserve, and that is regulation. Regulation does not impact everyone the same, and I'm so excited about what I hope will come under the leadership of Governor Bowman. I was with her last week at a roundtable discussion where she brought CDFI banks from my region together in St. Louis and talking about ideas and thoughts about how do you tailor regulation to fit the right size banks. So we are at $2.8 billion in assets. Our CRA regulation is the same as JP Morgan Chase. We're considered a big bank. And if you know how CRA works, it's really a relative to the economics of the community you serve. So if I'm in a community that, 30% of my branches are in communities that are persistent poverty, to be able to make a loan in a community where the community is, a third of us, below the poverty level, that really gets hard to do. And so, fortunately for the last 5 exams, we've had an outstanding CRA rating, but that's hard to do in the markets we serve. So right-sizing regulation will have a huge benefit.
Any other thoughts? Yeah. We can pivot. So solutions to some of these things, obviously. One thing that comes to mind, at least, that doesn't address everything, like the regulatory aspects, but thinking about partnerships. And obviously you can't just look to the local community when there's a dearth of resources otherwise, and already a lot being put on the backs of CDFIs and MDIs. But curious about what you see as some of the ways forward, or at least the initial pathways for potential solutions here. If partnerships is part of that, other things for obviously other challenges.
I don't want to dominate the conversation, but clearly the CDFI fund itself is built on this public-private partnership. It doesn't work without the partnership. And I want to highlight and echo and say thanks to those partners who haven't gone away, who haven't run as the political climate has changed. There are some that have dug in and have actually doubled down, and that's exciting. That makes the work accessible, and it allows us to do the work in ways that we may not be able to do if we don't have the partners. And there are a number of large banks, regional banks, even smaller banks that have invested in Southern, have put equity in it. A lot of philanthropic organizations that are investing in Southern to assist us in our effort. But let me go you talked about AI. Let me talk about technology, because I think that's a real solution. And Greg, I wonder what the answer would be if you asked that question today. That was 5 years ago. You probably have a few more people who'd be willing to pool their resources together to try to help solve this technology challenge, because it faces us every day. And if we don't really as an industry, CDFIs and MDIs don't come together and figure out how we can pool our resources to do things together, it's going to be tough for us to make it. And so that's one of the things that we try to do at Southern. We really try to be aggressive in building partnerships with other CDFIs and MDIs as well. But we have an advantage of having been very innovative and very technology forward from the very beginning. One of the founders of Southern was a gentleman named Walter Smiley, who created a company called Systematics, which is a precursor to FIS. And so he actually hired me. And so we've been really progressive. We actually, 20 plus years ago, the board, well before I got there, the board reached out to Walter and his family and said, hey, you've built a core processor before. Why don't you build one and let us be your first customer? That company is called Smiley Technologies, Inc., or STI. We actually own 10% of our core processor. I've never heard another banker say anything positive about their core processor. I talk positively about my core processor because I can get them on the phone. They're actually in my meeting on a weekly basis, and they've now grown from us to several small community banks from coast to coast. But that's allowed us to be innovative. It's allowed us to change and try things. But about 6 years ago, Walter Smiley's son, Vance Smiley, left the company. He was CEO. His sister took over as CEO. Along with our holding company, we built a cloud-based core processor. Now, every core will tell you they're in the cloud. But if they're all built on IBM mainframes, that's really not true. Now, they may have some pieces that are in the cloud, but the core, the actual guts, is in an IBM mainframe, so it cannot be in the cloud. You get behind it, it's held together by duct tape and twine. You probably don't want to see it. But we've actually built a cloud-based core processor, and we just call it our R&D arm. System 61 is the cloud core processor inside our bank. We've hired young people, not bankers, to build apps, and so we have 3 or 4 apps in the Apple Store and in the Android Store right now, where we're just doing research and development. And I'm really excited about what we're seeing. We have one app called EleVault that's in both the Apple Store and the Android Store. We basically said, what would you build if you were building a banking system without the shackles of the current system? Because if you go to some developing countries, they're so much further ahead than we are, because they're not beholden to a core system or to even plastic, right? And most of the banking's done right here, and it's much more efficient. So this app EleVault, we're experiencing some really interesting, at least getting really interesting information. A couple of the features. So you don't have a checking account or a savings account. You don't have money markets or CDs. You just have a portfolio. So I don't know why we label it that. It's a portfolio of money, and you can actually divide this up into various what we call vaults. Call it your monthly bills, right? How many of you all, this at least happened to me, probably not you all. I remember right after the holidays, I decided I was going to join the gym. I went and joined the gym and gave my debit card. I never went back. And for a year, they kept hitting but to turn it off was like impossible, right? And so, so instead of giving them your main account number, you can spin up what's called a vault key. I can send that to my car note, my mortgage company. I can send it to who finances my car. I can send it to my gym. I control that. I can turn it on and turn it off. That's one feature of it. It also has the feature that's really exciting to people. It has an API that's tied to the Fed funds rate. So right now it's paying 4.5%, but it pays and compounds daily. So my kids are excited because they look every day and see they made $2. You can start downloading it now if you want to. It's pretty good. But you think about the cost of me expanding through brick and mortar and the cost of acquiring customers through here. Month over month, the last 2 months has grown 30% in deposits. Now, still small, and it's still our R&D, but you think about the possibilities of if I can grow my deposits 30% using technology, and that's with a very, very limited spend with Google Ads. What can I do if I actually can invest? If I had $18 billion, what could we do? This is on a shoestring budget, and clearly it's going to take partners to really probably monetize this, but we're really excited about some of the things we're seeing from the technology standpoint.
I'll take a bite at Darren's questions. I'll take them seriously. First, I think that the level, so I work in a public institution, I work in a public university. The expectation is that the field is fundamentally going to change. Yours is too. The amount of money you're going to see coming and where it's going to come from is fundamentally going to be different. That's how I see it. There will be universities that will go out of business. That's just going to happen. There will be, in my industry, people are having psychological distress with the realization that money they had coming from the federal government for research of various types. We can talk about DEI, but it's not just DEI.
Yeah.
It's just not going to be there. Now, my finding about, I wrote this actually when I did the 20th anniversary review of the CDFI fund. CDFIs have authenticity, to use a word, that the people in the industry are very devoted to their communities. Their identities are very interwoven with the types of institutions and the people they serve. That actually sometimes makes it very hard for people to be prepared for change that needs to come. Because, well, my community is my community is my community, and I'm very much a part of my community. And I've worked with my community for so many years, and everybody knows everybody, Darren. So because of that, when we come to those institutions and those people and we say, well, the underlying economics of the industry are fundamentally changing. And in fact, some of you might not be here. In fact, we know that what the FDIC does is it, at certain points, tells institutions to merge. They can say you're going to be forced to close, or they can say you're going to be forced to merge. Wouldn't it be cool if people in some of the CDFIs got together and said, we should probably merge? But again, people's identities. My finding when I was doing research in the field, I came and visited your place too. And
We're a product of 15 acquisitions. We believe in mergers.
Well, you guys were merging long before.
Yeah.
You are in a state, by the way, which affords you some different types of approaches than you'll find in some other places. So we can talk that way too, Darren. But the point is a broader thing than your institution.
I agree.
The point is that people in industries like these feel very committed to their cause and their group, and this prevents them, in my experience, from extrapolating what isn't so unique about their institution or their people or their cause, and to be ready to change. What I hear, I'm not so much in the field anymore as I was years ago, because I have a day job at a university where we do some other things, but I can share that when I was in prior Republican administrations, when CDFI funding was being diminished, it was very hard for people in the industry to not see this as political and to see it as short-term and to see it as something that they had to fight through the political sphere. And at one point I remember being in a meeting, now again, Southern's a little bit different, but I said, you know, if all of y'all are lined up on one side of the aisle, you're going to have a problem when the aisle shifts. And so you should be building not just political coalitions, but you should be building business models that make you relatively resilient to those types of political wins, and don't expect that the money's going to be there.
Yeah. I think to Greg's point, we have to be more thoughtful about how we see partnerships and collaboration. It has to change, because partnerships can't just be about you writing a check or you giving me dollars. It's going to have to be about in kind. What vendors can you bring to the table that you can negotiate cheaper rates? How can you help me work with a fintech and they can develop a product that's affordable for me? And so I think the way that we think about partnership has to change, and the way that we think about collaboration has to change. We have to do more together because we've got to be more competitive and we've got to have scale. So we've got to collaborate with one another. When I think about our future, it's all about partnerships. It's like a four-legged stool. I need public, private, philanthropy, and technology. They like stand alone. But I think you need all four of those at the table in innovative, creative ways that is more than just about writing a check in order to be successful.
I don't want it to be all doom and gloom. Listen, I think, Greg, the industry has done what you said some time ago. There is a CDFI Senate caucus that has 14 Democrats, 14 Republicans that
And you
fight.
can't join unless there's another person
Exactly.
from the other aisle.
They have a Noah's Ark approach where you have to, it's 2 by 2. You got to have someone on the other side to join. And I think that's the reason you've seen so much support for the space because of that. And I as you know, I'm a former elected official, and I told my colleagues I was a Democrat then, but you know, I can count to 51. That's what I needed. I didn't really care where they came from. I just got to get my votes. And so I always believe in working across the aisle. And I'm glad to see that the CDFI fund, or the CDFI space, the mission-driven space, is really being, you know, thought about, thinking about how we approach this in a much broader way. Right now, the head of the Financial Services Committee on the House side is Congressman French Hill, my Republican congressman, who's a good friend of mine, been a friend for years, who's a former banker and a former CDFI Fund Advisory Board member, and he's Republican and who is a big supporter of the work that we do. And you can go down the aisle on both sides where you're seeing that. So I do think that's right. And to Nicole's point, we do have to think differently, and that's one of the things that we really are trying to do. This idea, this cloud-based app, was not just for us. We're trying to get others to join as well. We've also invested. One of my board members has a company called Bank Labs, invested in a product called, or a technology he's created called Participate. If we don't start participating together in our lending, because that's how we make money, through loans. And so I've said this to my colleagues in more urban areas, like, listen, I bet you have no row crop corn on your books. I got tons of it, but I also have very little high-end, you know, office. We probably could build a better, a more sustainable you know, loan portfolio if we participated together, and this platform allows you to do that, you know, in a very efficient way, using an app and using technology and not having to send tons of files back through emails and insecure ways. And so we are really working and trying to bring these types of ideas, not just for Southern, but to the industry as a whole. And not just CDFIs and MDIs, but community banks, because we all suffer from the same kind of thing.
Yep, this is a good discussion. I mean, we're talking adaptation to change is difficult. Partnerships are going to have to be a key to this. More data, but, you know, continuing the evaluation of effectiveness and delivery, you know, I think is going to be really important. I'm going to ask.
You said something that really made me think.
Yes.
Data.
Yes. Yeah.
There is so much data that we just don't appropriately leverage. And I think data is going to change the way that we can serve our customers. So much of it is manual. I was surprised, this is an Excel spreadsheet? I mean, it's just, there's so much data that our banks have that if they knew how to properly unlock it, that in and of itself would be game changing.
Yeah.
I saw this during the years I was out in the field with the MacArthur Foundation. There were so many times I was in institutions and they had very outdated spreadsheets and very outdated technology, and we're doing so many things through manual input. And this was it was 15 years ago, granted.
It's the same.
But it was remarkable to me as I traveled the country.
So one last question, and then we're going to go to audience questions. I'm going to attempt to take us in a happier not a gloss over happier direction, but a positive direction. You all as the experts can push back on me if this is too sunny, but curious about your thoughts here, particularly around technology, because I want to go back to where Joanne Barefoot in her opening remarks kind of talked about. She particularly called out kind of the struggles that could happen for smaller institutions like the ones we're talking about here with technological changes. But I do see some opportunities, whether it's in the data side, obviously, whether it's Gen AI, whether it's other technological changes. You know, Gregory, I'm sure you could talk a lot about this. It will improve our ability to evaluate data, to absorb data, to clean data, all those pieces. We're obviously seeing that at the board here too, and the potential there is on the research side. I hear some other themes that give me a little bit of hope. I'm not ignoring the downsides, but choosing to focus on the positive ones here. We hear about we all know the classic, it costs the same to underwrite the $10,000 loan as the $1 million loan. We've heard about the potential of alternative data. Obviously, we're looking at small dollar loans and maybe not looking at mortgages yet, right? but cost efficiencies there, technological improvements there that could make it cheaper, easier to customize to the unique needs of local communities where it's expensive to do that now, thinking about that piece of it as well. And if you combine some of these technologies, if they're able to be leveraged, if they're done in partnership too, to lower costs, plus the relationship banking and the power that you all have, that seems like, again, I'm painting a very rosy scenario here, so you can tear it apart in 10 seconds, but I see some potential there, or at least a pathway. Again, not to be overly rosy, but I see some potential there that gives you all challenges, but some advantages too, potentially on the other side of this. I'm curious.
David, I'll say, whenever I sit on these panels as the researcher, I always want to say that I do believe in this industry in all the ways that everyone at this table does. Now, my job is to go in and look at it a certain way. And my job is also to say these are the harbingers that don't look great. But please don't misunderstand. I actually believe very much the things that you're saying right now. The problem for researchers is always we only can look at what data we have available, and we can only look at what we've seen in the past. What remains is what could happen. And again, I've already made the pitch. The more you give us data to try to help with that, we can. But please know the types of partnerships, the types of sharing of resources to create scale and capacity. Absolutely, absolutely, absolutely. And this is what I hope for this industry, because I think this industry, I'm not an impact researcher, but I'm aware of the impact. And I'm also aware of what would happen if this industry were to decline significantly. I just want to say that.
It would be a huge competitive advantage if they figured out how to be high tech and high touch, because they already know how to be high touch. It's just how do we become more high tech? And so, is there a path forward? Is there a bright future? Yes, but how do you get started on it when it can be so overwhelming and I don't have somebody who's focused on technology? I think that's a thing that we're wrestling with and struggling with. We just did our strategic planning retreat where we bring all of our member banks together in person, and PwC did a survey of our member banks, and they just looked at call report data, and it was a focus on growth and efficiency. And some of the main drivers of growth and efficiency, now there are a lot of other factors, there were 4 big factors, but it's tech and talent. Mm-hmm. Tech and talent. If they can get tech and talent together, we're golden. Now it's going to look different. It's going to be smaller. You're going to have to figure out your niche. You may not be able to do everything. So there's all these other disclaimer. But if tech and talent, if they can get that, change management is hard. It's going to be an uphill battle. But if they can figure that out, the future is very bright, and what they do does matter.
Yeah, absolutely. All right. Audience questions. We can go to you all now. Yeah.
There's been in the last 5 years. And I think both because of the growth and because of the experiences coming out of the pandemic, I'm curious how you think mission-based organizations are thinking about scale in a way that maybe they weren't 5 years ago. What are the big lessons? I know when we started our paper on small business, we were looking at the high-tech and high-touch combination. And one of the lessons that we kept coming back against was it's not just data and technology. Those are absolutely critical, but it's so much more. It's culture, organization, financing, so many other things. And I'm just curious, what stands out to you as the lessons learned from the last 5 years? So.
They have not had the capital to think about scale. And so I think one of the great things over the last 5 years, whether it's through ESIP or it was big banks making equity investments, they now have the flexibility to think about scale in a way that they never could have thought about it before. And so you are seeing more M&A activity. You are seeing them being more thoughtful of, I could only hire the talent that was missionally focused on this. Now I can think about the best talent for this job and this role, and that's not just mission-minded. So they're able to look at a different talent pool. They're able to get technology that they couldn't get before because they didn't have the capital. So I think one of the biggest lessons over the last 5 years is that it's given them the capital to think about scale in a way that they never had the luxury of thinking about it before. You also did not see doors close, right? If you think about prior times when there was a pandemic or an economic downturn, people closed their doors because they didn't have the capital to withstand it. So now they had the capital to get to the other side. And so I think the biggest thing and the greatest thing is that they can think about scale and they're trying to execute it. Now, some of them have been slower at executing it because there's so much uncertainty. A lot of people were doubling down on climate, and it's like, well, wait a second, I don't know, let me pull. So I think that there were a lot of things that people were thinking about that has slowed down, but they're not stopping and moving forward and thinking about scale in a way that they hadn't before.
Well, Nicole and Darren, you got a good opportunity coming up. I'm warning you in advance. So you talked about regulatory and compliance costs being there and right sizing. If you had an opportunity to speak frankly to us about this at the Federal Reserve, what would be your top 2 or 3 things that you want us to focus on?
Yeah, so I highlighted one. I want to highlight just how I'm examined, just like J.P. Morgan Chase for CRA purposes, and just the cost for us to maintain 5 consecutive exams of CRA. It's really, our work hadn't changed from being satisfactory to being outstanding. We just spent more money on collecting the data and telling the story better. We spent more money on providing information to regulators. The work hadn't changed. We're still doing the same work, but we collect it better now. So that meant we had to hire people, more systems, more processes to do that. So that's one. And since I'm on CRA, and I know this is a hot topic, but there were some things in that CRA reform that we like. And as you think about where that goes from here, please reach out to CDFIs and MDIs. We can tell you a lot of things that were actually good. There are things that we may not like, and there's a big divide between large banks and CDFIs, MDIs, and even community banks in that legislation. There are a lot of things that we like. CDFIs in particular will put on level playing field with MDIs, obviously, and just where investments can be made that qualify for CRA purposes. Because it hadn't been changed in years, banking's changed. My little app that I just talked about, I have a customer in every state in the country. Every state in the country I have a deposit from, and so that's not how banking was done now. So the regulation has to keep up with how banking works today. And then again, I say my competitors is not often another bank. It's often a payday or predatory high-cost provider. There's got to be these non-banks who are doing banking activity. Like, give us some help here, because they don't operate with the same regulation restrictions that we do, but they are in many ways hurting our customers, but also clearly competing against us for customers. So that's just a few ways, and a huge area obviously is in BSA. I don't know how many suspicious activity reports we filed. I don't know how much. I feel like I'm. Sometimes we're law enforcement, and I guess that's kind of the purpose of this. But we have no idea whatever happens once we file these things. And so, just the cost of having it. Every time there's a regulation, there's a cost. There's FTE or part of an FTE to really comply with that. And of course, we want to and have to comply and will comply. But there is a cost, and it obviously clearly impacts our ability to have the earnings in the CAMELS rating that we need to survive and get good scores.
Ditto, ditto, ditto. I would also say just the timing of the exams. You close it and it comes back up. And so I just feel like, can you have a longer time between the examination periods, particularly if your exam was good? Can you have more time? Because again, and exams take up so much of the capacity of the bank. We're now at a time where there are 20 examiners and there aren't even 20 people that work in that bank that are coming into the bank. And so it's a lot, it's excessive. So the examination periods. I would also say, let's narrow the focus. Study after study shows that there are 6 factors that lead to bank failures. why not focus on those 6 factors? Why are there so many other things that we're doing and we're focusing on? And so I think the idea of right-sizing regulations, right-sizing exams, and tiered reporting, I think would be good based upon your asset size. Those are some of the big things that are coming to mind for me.
Interesting discussion today. This might be the first time that some folks online had heard about CDFIs and MDIs, maybe even some people in the room. So I'm thinking consumers, small businesses. What sort of recommendations would you have for those audiences to engage more deeply with CDFIs and MDIs? Thanks.
I would take a phrase from Nike, just do it. There's a CDFI or an MDI in many communities, and there are a ton of websites. You can go and find one. I would encourage you to do it. We provide similar services as larger institutions with often a culturally competent, community-focused touch, where we are, really do care. To Greg's point, that may be a downside, but the folks at our bank, they grew up and work in these communities, and yes, the community's not thriving like it did years ago, but they care deeply about the communities, and so it only works if we have customers and if people work with us. So I just do it. Just reach out to a CDFI. I guarantee you they won't, or an MDI. I guarantee you they won't turn you away.
Yeah, there's a number of lists. What I will say, I remember it may have been like 2015, there was a huge push for people to bank with minority banks. And what happened was people went in there and they opened up a bank account and put $100 in it, and that was it. That's not the kind of relationship that we would want. So when you engage intentionally. And it may not be you engaging as an individual. Maybe it is you engaging, wearing your hat for your business or your hat for your nonprofit and directing greater deposits there. Maybe it's when the company that you work for, the nonprofit that you work for, whoever, maybe it's saying, hey, have we thought about getting the loan from, this particular MDI or CDFI? So it doesn't have to be your individual hat, but we all have huge platforms of influence. If we sit and think about it, how are you leveraging that platform of influence?
Well, related to this issue of platform of influence, first to Darren's thing about knowing, I'll never forget, I went and visited a CDFI in Ithaca, New York, Alternatives Credit Union. It's a pretty long-running CDFI credit union. And I remember going and visiting, and I was in Ithaca for the weekend. I went to a farmer's market, and they had actually started this credit union through interacting with people in the community at the farmer's market. And I remember talking to a few of the folks that worked there, and banked there, and I mentioned that it was a CDFI, and they had no idea what that was, or that it was a CDFI. They said, oh, I thought alternatives was because they bank with the alternative people, which was true, but that was not what was intended with the name of the institution. I find that a lot of times what people will know is what is in their backyard, and they know, again, that is in their backyard, whether it's a CDFI or not.
They don't know.
I think there's a little bit more learning they could do. The other thing that Nicole mentions, working in a graduate business school for the years that I have, I find that most, 60% of the students in top graduate schools are thinking about going into finance. Very few of them know of CDFIs, think of CDFIs. There have been movements that have occurred over the same time periods where people have talked about inclusive finance, and they've talked about ways that we could do value-based investing. And I would say from time to time, there are like 1,500 of these things called CDFIs, and they exist right now. More often than not, highly educated people have no idea that CDFIs exist or that they could be doing finance in those types of institutions, certainly at the consumer basis, but even institutional finance, even commercial finance, they have no idea that these institutions exist. And if talent is one of the things that the institutions have lacked, and I might argue they have, that in the war for the talent that come in, I don't think you all come to the mind of many of the people who would otherwise be interested in working in finance.
I totally agree with that, Greg. I will say that clearly the pandemic and other happenings have allowed us to, not be just completely the best kept secret. But we struggle. But what I have found, at least here lately, is we've been able to attract some really talented people who we allow to work remotely. That's part of the issue because of our mission. So in many ways, our mission, our purpose is our competitive advantage. I say all the time, no margin, no mission. But we got to make money in what we do. But it's been positive. And what I would say is, a couple years back, Harvard Business School did a case study on Southern. I've gone to the class a couple of times, and Duke has picked up the case study. I guess we got to get Darton to pick it up as well. They pick up the case study, and each time I've gone, I do a little plug. In exchange for me joining them by Zoom, I do a plug at the end of the class, like, CDFIs, MDIs exist. We need talented people like people in the room. Please come and join us. And we had a few interns, but I think you're right. If we can get more talent and how we can spread the word would be clearly helpful.
And I know we're at time, but I just want to do a quick plug. If anyone's looking for foundational information, all three agencies do publish an annual report that does have definitional information and also has other stats. So if you are interested in if you're at the beginning of your learning journey of these mission-driven institutions, that's a great place to start.
I think that's a good place to end. We all have our homework. If you don't know your mission-driven organizations in your community, look them up, supporting them in a meaningful way, make partnerships and connections, and spread the word among your friends and family. So please join me in thanking our fabulous panel. Yeah.
Okay, so good afternoon, everyone. My name is Dave Mills, and I'm a Senior Associate Director in the Division of Reserve Bank Operations and Payment Systems here at the Federal Reserve Board. I want to thank everyone for joining us today. We are the last panel of the day. It's been a very fruitful day hearing from various speakers, as well as a lot of very interesting dialogue and good discussion along the panels. Today, we're on our last panel of the day. I'm going to moderate a topic that will explore a lot of an important area of intersection between payments and financial inclusion, in particular in the area of cross-border payments. Cross-border payments are a critical feature of the economic and financial integration of economies around the globe. And a particular part that's related to financial inclusion are remittances. And remittances are particularly important because they involve people in one country sending money, usually to relatives in another country. In 2024, global remittances reached $740 billion, representing the largest source of foreign income for many developing economies, even greater than official development assistance from developed economies. Remittances are also very fundamentally important to Americans as well, given that 20% of remittances are sent globally, originate from the United States. In 2020, the G20, a lot of 20s there, identified cross-border payments as a priority initiative. The Federal Reserve is committed to supporting this important work by engaging with other regulators and private sector actors across the world, both through the Financial Stability Board, or FSB, and the Committee on Payments and Market Infrastructure, or the CPMI. The Financial Stability Board and the Committee on Payments and Market Infrastructure and other global organizations are advancing work programs to address 4 key challenges associated with cross-border payments. They're related to high costs, low speed, limited access, and insufficient transparency. The desire to expand financial inclusion in general and improve cross-border remittances in particular are often cited as key motivators of these programs. The Federal Reserve has actively contributed to and been supportive of this initiative at the G20 level since its inception. Board staff contribute to a number of international working groups exploring the potential opportunities and risks of digital innovations for cross-border payments, including stablecoin arrangements and infrastructure improvements. As part of that, I chair the CPMI Future of Payments Working Group, which includes examining newer technologies and developments that could improve cross-border payments over the longer run. The FSB and CPMI formed 2 industry task forces to engage directly with private sector participants on cross-border payment technology and legal issues. Engagement with the private sector stakeholders through industry task forces has also been an essential part of the process. And these task forces have made progress in helping identify ways that the industry can collaborate to take forward aspects of the various issues. Even with all this work going on to improve cross-border payments and remittances, there's still much to do. One part of remittances that continues to prove challenging is the so-called last mile. The last mile refers to the final stage of a remittance payment, transferring funds to the end beneficiary in their home country. We're going to hone in on this specific part of the transaction to see how innovations in regulation or infrastructure might mitigate some of the remaining issues. With me today to explore this topic are Harish Natarajan, Jess Chang, and Gordon Liao, who have extensive on-the-ground experience with remittance recipients in emerging market economies, legal expertise across the private and public sectors, and research, strategy, and product development experience at the largest U.S. regulated stablecoin issuers, respectively. So to introduce them, first, I have Harish Natarajan. Harish leads a global team working on financial inclusion, payments and market infrastructures, digital finance, and credit infrastructure topics. He represents the World Bank on several international working groups on these topics. He and I have worked quite a bit extensively together over the years. He is a lead contributor to the IMF World Bank Bali FinTech Agenda, co-led the Future of Finance flagship paper, and co-chaired the CPMI World Bank Task Force on payments aspects of financial inclusion. Prior to joining the World Bank, Harish worked in senior-level positions at Visa in business development, operations, and risk management, and he holds an undergraduate degree in electrical and electronics engineering from the Indian Institute of Technology in Madras, India, and a postgraduate diploma from Indian Institute of Management, Calcutta, India, specializing in finance and systems. Next to Harish is Jess Cheng. Jess is a partner at Wilson, Sonsini, Goodrich, and Rosati, where she advises fintech companies on sophisticated regulatory, transactional, and product development projects involving payments innovation. Her most recent projects include advising Circle on the launch of the Circle Payments Network, Chime on its recent IPO, and Stripe on its acquisition of stablecoin infrastructure provider Bridge. Before joining the firm, Jess served as senior counsel at the Federal Reserve Board of Governors, where she contributed to the Federal Reserve's policy analysis on digital assets and stablecoins. So we also have quite a history. Prior to that, Jess was counsel at the International Monetary Fund, where she advised on the strategic direction of the fund's fintech work agenda and provide technical assistance to advance law reform in central bank legislation and modernize financial sector regulation. Previously, as Deputy General Counsel at enterprise crypto company Ripple, Jess advised on a spectrum of legal and regulatory issues that impact innovative cross-border payment products. She also served as counsel and officer at the Federal Reserve Bank of New York and was previously an associate at the New York law firm Wachtell, Lipton, Rosen, and Katz. Jess holds a BA in economics from Yale University and a JD from Columbia Law School. Finally, on the screen, somewhat larger than life, not too large, okay, is Gordon Liao. Gordon is the chief economist and head of research at Circle, a leading financial services firm building payment infrastructure for the internet. He is also a research fellow at the Cornell FinTech Initiative and a co-chair of the National Association of Business Economics Finance Roundtable. Gordon's career has encompassed diverse areas within finance and technology, include fixed income relative value trading at the Harvard Endowment, machine learning and AI at Kensho, policy advising on short-term funding markets at the Federal Reserve Board of Governors, and leading research and development in decentralized finance and tokenization. His research contributions have been published in respected journals such as the Review of Financial Studies and Journal of Financial Economics. His previous work has been featured in Bloomberg, Wall Street Journal, Barron's, Payments, among others. Gordon holds a PhD in economics from Harvard University, and he received his bachelor's degree in applied mathematics from Harvard College. And of course, I couldn't be remiss without saying I also have previous work with Gordon as well. So thank you, all three of you, for being able to join this event. So now what I'm going to do is I'll maybe open up the beginning of the panel with some initial questions. So to start out, I'd like to hear from each of our panelists about what you perceive as the biggest barriers to addressing the issues in cross-border payments that I just noted, namely around high costs, low speed, limited access, and insufficient transparency. And for Harish, I'm going to start with you, given your experience on the ground in many emerging market and developing economies. What do you think seems to be the core problem in the last mile?
Thank you, David, and it's a pleasure to be here. Well, the challenges on the last mile are largely due to the reliance on cash, and it's very clear that end-to-end digital remittances are significantly cheaper than cash-based remittances. To put a figure to that, it's at least around 20% on average cheaper than cash-based remittances. And the reason for predominance of cash-based remittances, on the receiving side at least, it could be originated digitally, but the recipient, if the receipt is in cash, the reason for that is very closely tied to the financial inclusion challenges in the recipient countries. And many of the recipients do not have accounts or even if they have accounts, those accounts are not enabled for receiving international remittances. Because in many countries, because of regulatory reasons, when the mobile money products were introduced, they were, to minimize the risk related to AML/CFT, they were not allowed to receive international remittances because that was seen as a high-risk transaction. So that is one clear reason. And the other is related to the distribution infrastructure, access to being able to easily convert from an account into cash and so on. So the presence of infrastructure is a challenge. And then the other reason is also related to financial literacy, awareness, comfort with using the digital products. So those are the three main reasons I would say. If you unpack that, what are the underlying reasons for all of that? I think it always comes back to regulations, infrastructure, and policy. And regulations here, I'm specifically referring to the account opening related regulations, related to primarily the know your customer requirements. In many other countries, of course, the penetration of official forms of ID is limited. And as I mentioned, if you want to receive international remittances into an account, then that is considered as a high-risk transaction. So it is typically the full-blown KYC requirement, which at the minimum requires an official ID. And then there are also issues related to the new entry of new entrants and new business models. This segment is typically not served by the large banks. So there are specialized providers who enter the market, and many countries, the regulatory structures are restrictive, and many of these new entrants are unable to enter the market. And then even if they enter the market, they do not have access to the national payment systems, which makes it easier for them to remit directly into an account. So they still have to maintain all those bilateral linkages and all of that. So that's the way I would characterize it.
Thanks, Jess.
Yes, and I would agree. I would say one interesting comparison point is looking at cross-border payments versus domestic payments. Now, in cross-border payments, the challenge is today we generally have siloed networks that don't talk well to each other. We usually see payments flow pretty freely when we're looking at domestic rails within a country. And that's even more so when the payor, the payee, the end users in a payment transaction, when those parties happen to have accounts with the same financial institution or within the same network. But the challenges come when we're looking at payments across networks, and that's where we see inefficiencies and frictions. So for cross-border payments especially, they often have to flow through a long chain of banks or payment systems that eventually winds its way down to the recipient, if it reaches the recipient at all. That's the last mile challenge that David had mentioned. The result of this chain is that it's slow, unpredictable, and expensive, and again, limited in reach. And it's this connectivity problem that is one of the biggest barriers to cross-border payments. And by connectivity, and I think this is building on what Harish had just set out, by connectivity, it's both technical and legal. Unlike many domestic environments where we have a central bank that serves as the network hub, a central bank that provides the legal and operational infrastructure that allows payment systems to interoperate safely and efficiently. When we look at the global level, cross-border payments often lack a comparable central coordinating function. So that's why, as a result, we see these transactions typically relying, again, on that chain of correspondent relationships, each with its own legal, operational, and risk frameworks. And it's this fragmentation that creates delays, uncertainty, and cost, especially when payment systems just don't speak the same technical or legal language. And because correspondent banks tend to concentrate in the major corridors, their reach often just stops short of that last mile, which results in those gaps in access, precisely where payments tend to be most needed.
Thanks, Jess. Gordon.
Well, thanks so much, first of all, for inviting me here. Sorry I cannot be in person with you all, halfway around the world. But I think I very much agree with what Jess and Harish laid out. I think I would categorize it under two large buckets in terms of the barriers. And I'll speak from an innovator's perspective. The first barrier is just fragmented regulatory and compliance, right? So every country has its own unique AML, KYC, licensing framework, and that repeats the compliance burden and limit access for especially non-traditional players. I mean, the type of innovations in remittance space has been going on for decades now. Right? People have tried to enter into the space. You have various firms who try to lower the costs and solving that last mile problem. But I think if you dig into it deeper, a lot of it's the cost that's related to compliance, to regulatory barriers. That makes it hard for these innovative firms to serve these underserved populations across the world, because it had to repeat the KYC, repeat the AML, especially in the corresponding banking type of relationships. And that actually end up contribute to possibly de-risking of some of these corridors in terms of relationships. So you actually have a declining in corresponding banking links in certain regions, for instance, sub-Saharan Africa. I think technology could be a response for that, and we'll touch on that a bit later. But the second barrier I want to highlight is just the legacy infrastructure bottleneck. Payment system, especially cross-border payment system, are technologies that's been around for, sometimes 50 years, right? It does depend on very legacy type of financial infrastructure. That is both the manual reconciliation that's involved, but also involving the messaging using SWIFT and Nostro accounts. Part of it is infrastructure that's technology-based. Part of it is infrastructure that's more of a balance sheet constraint, given the liquidity needs that are necessary to fund these cross-border payments. So as an economist, I always think about, if you remove aside all the legal considerations, are there still frictions? I would say absolutely yes. If you streamline the technology component, streamline the legal component, there's still the liquidity component of just how much liquidity each of the correspondent banks have to hold in between. And in the last mile problem, yes, I would say that's much more of the technology infrastructure and legal side, but then you still have to have sufficient amount of liquidity even at those last mile endpoints for everything from conversion of FX to actually have the funds available for end users. And I would say that there's a lot we could do there in terms of solving that last mile problem, not only, as I mentioned earlier, on streamlining and reducing the fragmentation on the regulatory and compliance side, but also removing the barriers in terms of access for both banks and non-bank institutions to the core settlement systems. So enabling well-regulated non-banks institutions to access systems for settlement, such as FedWire or the equivalent around the world, with the appropriate risk framework. I think that could also help with the last mile delivery of funds to the recipients.
All right, thank you, Gordon. So it's interesting, each of you had mentioned in some of your remarks on this first question, infrastructure. So I want to kind of talk a little bit or focus in a bit more on that. And Harish, I'm going to start with you again. Many countries might lack the digital infrastructure needed to benefit from fintech innovation. What foundational investments or partnerships are the most critical for progress? And what role do the public and private sectors play in the development of this infrastructure?
Thank you. Kind of building off what I mentioned in my remarks earlier, I think the foundational digital infrastructures which are required, apart from, of course, the telecom connectivity and those infrastructure, is really related to the digital identification infrastructure and the modernization of the domestic payment systems. And of course, currently, everybody kind of interprets that as fast payment systems, right? So those are the benchmark now for digital payment systems globally. So I think apart from the telecom infrastructure, digital ID and fast payment systems, I would say are the very fundamental infrastructure investments which are required. Digital ID, to some extent, at least the core elements of enrollment and giving the legal basis to that is the role of the government, very clearly. But the digital aspects of that could come from the private sector, and there are some models related to that. But in many countries, in particular the developing economies, the digital ID functionality completely is provided by the public sector. But clearly, as I said, there are models in which the enrollment is done by the public sector, but then the digital overlays on that can be provided by the private sector. And on the fast payments system side, again, the central banks and other financial sector regulators have a clear role in championing for it and leading the initiative. But the implementation and operationalization could be done in the private sector, and there are good models of that across the world, including in the developing economies. But again, here, in some cases, it is still operated by the regulators in the public sector, primarily because of market failures. In particular, trying to bring banks and non-bank players onto a common infrastructure requires quite some effort. And because of that, at least at the beginning, the public sector intervenes and operates that. So these two, I would say, are the key investments required. Now, of course, infrastructure is infrastructure. You need policies to enable use of the infrastructure in an efficient manner. So digital ID without appropriate risk-based and proportionate KYC regulations is not helpful. So those will have to go hand in hand. And similarly, on the fast payment systems, the access of that infrastructure to fintech companies and maybe also to some of the international networks is also critical. So, for example, if you have a cash-based remittances currently, the way the model works is there is some international entity or money transfer operator, like say Western Union or MoneyGram, and they have to appoint agents all through the country for acting as their outlets to disburse the remittances, and that clearly comes with a cost. And if you move digitally, then they will have to tie up with banks individually if they do not have access to the payment system, either directly or through one financial institution who can then be their gateway into the domestic payment system. So either directly or through another financial institution, if they have access to the payment system, then through that one touch point, one interface, they're able to credit any account in the country instantaneously. And that significantly lowers the cost. At the minimum, 1/3 of the cost goes away because of the having to maintain the distribution network. So I would say these two are the key requirements, along with, of course, the policies to go with it.
Thanks. So Jess, designing robust cross-border payment infrastructure can be especially tricky because it requires ensuring compliance with laws that could potentially be in conflict across many jurisdictions. I think we brought up some of this pain point already. So from a legal perspective, what do you see is one, the most challenging difference to overcome, and two, the most urgent difference to overcome?
I would say from a legal perspective, on the first question, a challenging difference. It's to build the legal architecture that would support interoperability. And this point goes to the very heart of trust and enforceability. So here's what I mean. Payments, they're not just technical transactions, they're also legal ones. And in the cross-border context, each link in the payment chain may be governed by different regulatory recognition, different standards for liability. It could be different legal frameworks for how value is transferred or whether and when settlement finality has occurred. So without clarity and predictability in legal treatment, you can have even the most advanced technical infrastructure. You can have those infrastructures still introducing risks of uncertainty and unsafe payment offerings. For example, you might see in a cross-border transaction between jurisdiction A to jurisdiction B, you might see a question if settlement finality in jurisdiction A, if it's recognized there, would it still be recognized as final in jurisdiction B, where we have that cross-border payment offering? It gets even more complex the more links you add to the chain. You might also raise the question, who bears liability for a failed or reversed transaction in a multi-leg chain? So these questions, they might have clear answers in the traditional correspondent banking model. But that legal architecture, it's not necessarily in place Or it may require bolstering or tailoring for emerging cross-border payment infrastructures. You can think of perhaps stablecoin bridging models or DLT underpinning cross-border payment transactions. So this challenge, it's structural, and it's a public-private sector effort. So a robust legal framework that's made up of statutory, regulatory, and commercial contracting rules. So it's this exercise of pulling all of this together where we collectively can create a robust legal foundation. And it's really these legal dimensions that are critical to supporting, I mentioned stablecoin payments as a bridging asset. You need to think about transferability, off-ramps and on-ramps, especially for these emerging technologies. Now, on the other question, the most urgent difference to overcome, I would say from a legal standpoint, one of the most urgent legal differences to address, it's the different or uncertain regulatory treatment of what are really functionally similar activities or instruments across different jurisdictions. And this challenge is exacerbated when we have new technologies, again, like tokenization or stablecoins for cross-border payments. You might take, for example, a tokenized representation of a fiat-denominated digital asset. It could be classified as a deposit in one jurisdiction, a security in another, and possibly an unregulated digital asset in a third. And it's this variation that creates legal uncertainty. It creates compliance complexity. And in some ways, it can introduce a degree of operational risk. This is especially the case for cross-border payment providers who have to navigate multiple different regimes just to manage a single product. And the effect of this is to deter market entry. Instead, it tends to reinforce the dominance of a small number of global incumbents. And of course, that in turn reduces competition, it limits innovation, and it also has the end outcome of raising the costs for the users, the end users who are relying on these cross-border payments, remittances the most.
Thanks, Jess. So then, Gordon, how can new or improved infrastructure help with the reach of financial services across borders? How do you situate stablecoins in the broader cross-border payments innovation landscape?
Thanks so much. I think, first we have to recognize where the infrastructure is today and where we want to go in the future. I do think a blockchain-based or distributed ledger-based solution could make a lot of sense for just global settlement of value. That is more 21st century, that's more internet native. But I think first is just recognizing that blockchain could add a lot of value because of the nature that is operating globally. Instantaneous settlement is by nature the design there. I'll touch on the settlement finality point in a little bit, which is something that we need to improve on. But it's a core infrastructure that's already 24/7. It's already instantaneous and already eliminate quite a bit of the intermediary frictions in between. I think it's also what's needed on top is you need better blockchain solutions. Today, just mentioned the point about settlement finality from a legal standpoint, but I think even on the infrastructure side, from a technical perspective, it's still not entirely clear what is finality. The first generation of blockchain, think of Bitcoin, operated on probabilistic finality with proof of work. Things are never fully final. You can always overturn it with enough energy resources that you can orchestrate a 51% attack on a network. Then later on, you have the evolution towards more proof of stake concept, which is currently what Ethereum are built on. There is a little bit better, but the finality is, there's a concept of economic finality. The finality of these settlements rest on you have enough stake asset. So it really requires you to have quite a bit of value tied up in stake assets. Even then, it's hard to argue, whether that's final in the sense of can you overturn certain transactions because there could be forks down the road. So you really need the stake assets to support trillions of dollars of transactions. Then the stake assets has to be proportionally large, and that just might not be feasible with securing it with, say, the crypto assets that are available today. Later versions of blockchain, today we're looking at blockchains that could offer deterministic finality. That is truly finality that you can count on as soon as transactions are confirmed on a block. That is hard to overturn from both of a forking perspective as well as reorg of blockchain. So the technology is evolving really fast and is getting to a place where you can call it deterministic finality from a technology angle. Perhaps you could attach a legal language of that deterministic finality comes with also legal guarantee if it is coupled with the appropriate issuance mechanism and appropriate asset on those chains. There's also an element of what are the applications on these blockchains that matter. Just because you have a fast settlement rail that everyone aligns on doesn't necessarily mean that you could have the frictions of cross-border payments resolved if you don't have, for instance, the appropriate conversion of foreign exchange or the appropriate off-ramping. So I do think these distributed ledgers or blockchain and tokenization solutions need to be coupled with applications on top that truly utilize the programmability of these blockchains. What do I mean by programmability? It means that you could actually program the if-then logic, the typically that you see directly embedded into money, into these blockchains. That could facilitate conversion of foreign exchange that do not necessarily involve intermediaries, or at least traditional market-making type of firms. That could involve services such as temporarily escrowing funds for release until certain things are satisfied, such as identity checks and verifications. That could involve better identity solutions that connect more seamlessly with existing identity from traditional identity solutions, involving using technologies such as zero-knowledge proof of having someone to attest that they have gone through a KYC check, but without necessarily disclosing all the KYC information to a third party. So that's more on the blockchain side, but you also asked about the stablecoin landscape. Well, I think the stablecoin space is very exciting because it is more of a value that you can tie to fiat value now, and that is still native to the blockchain. Now the question is, can you ensure the one-to-one convertibility? So the Bank of International Settlement always have this concept of singleness of money that they point to as a criticism of stablecoin. Well, I think absolutely you could have that singleness of money as long as you have efficient access to the fiat conversion, the conversion with traditional bank money. So that goes back to the point about having that settlement system access. So in Europe, there is, I think the ECB have opened up Target 2 settlement system to non-banks. And I think in other jurisdictions, there are similar type of setups already as well. And it is when you have that connectivity of, say, fintechs and non-banks directly with central bank money or central bank settlement system, then you could achieve this one-to-one conversion without additional intermediaries in between. Today, you also have that one-to-one conversion in the primary market, but that comes with certain amount of intermediation in between. And then, of course, you need to have better complementarity between the public and private sector innovations. I think we're past the CBDC discussion, at least on the US side, but I think there's also fruitful areas to partner on tokenizing traditional assets, tokenizing, say, sovereign bonds on chain, such that it could be used effectively as the reserve for possibly stablecoin, possibly other type of settlement instruments. Those are all emerging areas. I think it offers quite a bit of promise. And a point on interoperability is, today, USDC, the stablecoin that is the most regulated and then Circle issues, is already on, I think, 19 or 20 different blockchains. We do offer cross-chain solutions that is effectively transferring value from one blockchain to another almost instantaneously, settling within from seconds to minutes. But I think those technology will continue to build. The important thing is having these blockchain adoptions in place in the first place allows you to build on this greater ecosystem that's already in existence, in which you have multiple ledgers, you have interoperability to some extent already, instead of building siloed DLT type of structures that cannot communicate with each other, that are only meant for a certain set of institutions and very exclusive in terms of access. That doesn't mean you have complete permissionlessness. You could still impose permission requirements at the validator level, or perhaps even at the some of the application level, just like the internet today has these controls in place, but yet it has a permissionless nature to it. But I think that is the type of internet-based system of value exchange in which you could reap the benefits of interoperability, connectivity, at the same time have sufficient amount of control for satisfying compliance and regulatory needs.
Thanks. So, it seems like as we kind of think about some of the tensions here, there's some technological tensions, but ultimately a lot in the last mile construct here involves the legal, regulatory, and the technical infrastructure within the home country, the jurisdiction. That, I bring this up because part of a conversation we have internationally about new payments rails to sort of help facilitate remittance channels. A lot of that is like from the host to the home country, and those rails could be built, but we could build these sort of things, or firms like Circle or others that are contemplating sort of infrastructure improvements could build these things, but the fundamental problems will still remain. Is that a fair assessment?
Yes, indeed. And I really hope Gordon solves the problem. Gordon and all the other colleagues working in the space really help solve the problem. But I think there are other sets of issues which need to be addressed for solutions like those to be more effective to address these problems. So let me illustrate a few points here. I think if you have stable coins used as the mechanism for transmitting remittances, firstly, on the host country side, whether the senders are actually going to hold stable coins or are they going to convert into stable coins. So there's going to be a cost and access to that infrastructure. And then on the receiving side, due to various regulatory reasons and then also implications for financial stability, on the receiving side, they're not going to allow circulation of foreign currency denominated stable coins in the local economy. So there will be strong pressure to convert it immediately into the local currency, either at the individual level or at the financial institution level, which is coming in. And if it is a financial institution, then whether they are able to hold on to that is also based on the exchange control policies in the country, because they would want to recognize the foreign currency in the reserves of the country, and they will not allow stable coins reserves to build up. So there will be a pressure to convert that. So a lot of the cost savings which can come will actually be eaten away because of all of this kind of ramping in and ramping out costs. And then the other issue is for the consumers themselves, for them to be able to interact digitally, all the other issues which we talked about will need to be addressed. And then there is a big issue related to access to correspondent banking services. So there is going to be, at least for the next 10 years or so, I presume the correspondent banking model is going to have some relevance, while maybe diminishing relevance, but it's going to have some relevance. And the question is whether the financial institutions which are going to participate in the cryptocurrency exchanges and hold stable coins, what happens to the AML safety profile? No? Is it going to be seen as more risk and hence more risk of losing the correspondent banking access? So I think there are those issues which need to be addressed as well.
Thanks. Any thoughts on that, Jess?
I would say from a technological perspective, there are interesting developments where we see technological innovations helping. It's by opening up the types of connections between financial institutions around the world. So think of DLT, stablecoins, used in the context of cross-border payments. It can allow a larger number of parties to transact with each other in real time, or to offer specialized cross-border payment services without necessarily having to rely on traditional intermediaries like correspondent banks. So in essence, you can think one area where these technological innovations could fit in the payments value chain in a way that supports financial inclusion. These technologies could serve as a way for more financial institutions in more jurisdictions around the world to establish trust and coordinate their actions vis-a-vis each other to effect a cross-border payment as an alternative to relying on central intermediaries like correspondent banks for clearing and settlement. And the effect of this is to bring that last mile closer and connect with the first legs of the cross-border payment. What you could have is a global payment system where value flows more freely with more paths, more options to connect a payor and a payee. And we see other innovations like real-time settlement linkages, standardized messaging formats, and other different ways to transact on a distributed ledger. That can help bridge a lot of gaps. But to go back to your question, David, I think technology alone, we have these infrastructures, we have these emerging technologies, but standing alone, they're not a silver bullet. They need to rest on a clear and predictable, among other things, legal foundation. You need to have a shared understanding of what constitutes a valid payment instruction, final settlement, and ownership of funds. These are fundamentals, the foundation that a payment system needs to be built on. And without this clarity and trust, we see cross-border payments not only facing technical barriers, it's going to be legal uncertainty, chaos around settlement finality, liability allocation, and the enforceability of obligations, roles and responsibilities, who does what. There would be a lack of clarity and predictability there. So in a sense, thinking through challenges to cross-border payments and the necessary layers beyond the technical infrastructure, if we want to expand safe and efficient access to cross-border payments, it isn't only just about building better or newer rails. The technological innovations that can help, those are the ones that also come with aligning, or sometimes it's creating that legal architecture to govern them.
I would add that, despite some challenges that remains, we're already seeing quite a bit of progress with the technology solutions. For instance, USDC's circulation, it's already reaching many countries. It's already processing billions of dollars in volume monthly. You can access it in over 100 countries. And we are partnered with local regional fintechs and regional virtual asset service providers that would follow local requirements for holding of stablecoin or cashing out to local currency or converting into local currency stablecoin, which I think is an interesting development. I think there are going to be a flourishing of activities in local versions that's not dollar-denominated stablecoin, and we offer the EURC product for euro-based stablecoin that's been growing quite a bit as well. And in terms of working with existing frameworks of last-mile solution providers, the Circle Payment Network, which I know, Jess, you mentioned that you also worked on that. It's something that already is orchestrating it's bringing quite a bit of, I would say, competition in the last mile payment provider space. Because what it is a marketplace, it's an orchestration service that connects the senders and the receivers, most importantly in the middle piece, the originating institution and the benefiting institution, receiving institution. But it's a marketplace for doing so. So today, one could also already send USDC, from the U.S., for instance, to Philippines, but also do the last mile conversion through these remittance companies, through these virtual asset service off-ramps. And the network structure that at least Circle Payment Network and others are bringing are allowing that to be a flourishing place in which competition does exist. You're not, instead of bilateral relationships in which you had to, this set of payment service providers are matched up with the other set of payment service providers, or everyone's under the common umbrella of a single payment service provider that serves global customers. You have more of this matching service that's going on, matching and competitive bidding service for, how much could you off-ramp this, say, stablecoin into local currency with the proper KYC and proper controls in place. That already brings quite a bit of competition into the last mile space that previously was harder to achieve because you didn't have a marketplace or the technology-driven market in place. But I think there are more work to be done on the policy, on the regulatory side. But I think the technology, as just mentioned, technology could be truly the driver there in terms of spurring additional regulatory and policy changes.
Thanks. I want to come back to Jess here. So we talk a lot about making things more accessible, and some of the constraints that are in place are very important constraints for a reason from regulatory policy. So I want to think about how do you balance innovation and inclusion in the remittance space with concerns around BSA and AML, consumer protection, and broader financial stability issues that may accompany cross-border payments infrastructure?
And I think a principle to keep in mind here about striking the right balance, it's being clear-eyed about what we're trying to optimize for. Innovation and inclusion, they don't necessarily have to be at odds in tension with BSA, AML, consumer protection, and financial stability. In a lot of ways, they depend on each other. When we see innovation that undermines trust in the system, that's not sustainable. And on the other hand, when we see regulation that stifles innovation or cuts off access, that also fails the public interest. The challenge is ensuring, and I think the previous panel used the phrase right-sized, risk-based, proportionate frameworks that are applied in ways that support safe and inclusive payments innovation. And I think this is especially necessary in cross-border payments where we can see gaps or overlaps in coverage emerging. And I also think what we've seen play out over the years is that what innovation needs is guardrails and not carve-outs. So tokenized money, programmable payments, these new settlement models, they could improve transparency and efficiency, but they still have to sit within a regulatory perimeter to make sure that the obligations are clear, that rights are enforceable, and there's regulatory oversight. So the goal shouldn't be to exempt these tools from regulatory compliance. It's really to retool what regulatory compliance means so that it functions effectively in these newer contexts. And I think along those lines, the pending Genius Act is, to me, promising because it reflects a recognition in Congress of that. Advancing payments, including cross-border payments, it requires not just technological innovation, it also requires legal and regulatory frameworks that support interoperability, inclusion, and innovation in a way that doesn't also compromise these core safeguards that we've developed over the years around AML and consumer protection.
Harish, yeah.
No, I think Can I agree with Jess that these are not necessarily at odds, and a creative thinking can really bring about how to square all of these together. The point is about technology provides new ways of meeting the same regulatory obligations in a different way, and I think those should be really harnessed. And also, new providers will bring in new approaches to do things. But I think if you really look in a very careful way, at the end of the day, it might not necessarily be bringing new risks. It is just a different way of doing things. And I think if you can ensure that the regulations allow you to kind of adhere to the spirit of the law, but not necessarily at the letter of the law, then I think the law needs perhaps to be changed, no? To kind of focus on the spirit rather than the letter. No? So I think that's the way to look at it. Yeah.
Thanks. Gordon, do you have any thoughts on this?
Yeah, I think I'm just echoing what everyone said here. Like, certainly you do want proper regulatory framework. I think the current regulatory framework for BSA and KYC needs to also evolve, needs to leverage the technology that's available, right? In some ways, there's a lot more transparency, and you could actually introduce quite a bit of deterrence effect with blockchain. I just released a paper not too long ago on just looking at the blockchain transactions. Vast majority of transactions are effectively sits within wallets are very easily identifiable because they're directly linked to exchanges, to centralized crypto exchanges. With the proper requirement for KYC for these exchanges and proper requirements for monitoring, you could easily identify these wallets if necessary. So I think it's out of question to think about how the technology only introduce risk. Rather, I think it's a very fruitful area to explore of how do you actually leverage the programmability and the transparency and the forever nature of blockchain transactions to introduce both effective ways of curtailing bad activities through active mechanism, but also just through deterrence alone, because the data, it sits there and it could be queried up on later on.
Thanks. So now I want to turn a little bit to some solutions and how do we think a little bit about, making the last mile a half mile or something a little bit shorter. So Harish, through your work with the central banks and the payment system providers and on the ground in emerging market economies, what models have shown the most promise for delivering these low-cost, inclusive cross-border payments in low and middle-income countries?
Before I respond to that question, David, kind of since there's been a lot of focus on the last mile, I wanted to also note that there are problems in the first mile and the middle mile as well. And in particular, for remittances, in some of the sending countries, the originators of the remittances are not able to necessarily participate in the financial system, or at least in that part of the financial system which allows them to use efficient payment services. So I think we need to acknowledge that there is a first mile problem. And the middle mile, I would say, broadly speaking, is the infrastructure which is connecting both sides. And within that, there is a big part of the foreign exchange conversion fees which come in. If you look at the trend of the price of remittances, if you use that as an indicator for efficiency, in which we monitored at the World Bank kind of over the last decade or so, we noticed that the foreign exchange part of the remittances prices has been very sticky. It has not really budged for the last 10 years. Whatever reduction has been there is for the fees. Fees have come down, but not the foreign exchange cost. So I think we need to not lose focus on the first and middle mile as well. Now, in terms of what solutions have helped, we have seen, in addition to the points I made earlier related to digital ID and fast payment systems and giving access, we have also seen that there's a big element of transparency which is also required here. So sometimes you have competition, but competition without adequate transparency is perhaps not effective, because the recipients of remittances and the senders are not able to distinguish between the different service providers, and they're not able to understand the benefit of switching to a new provider. So I think transparency is the additional point I wanted to make to what I said earlier. And then there is also the broader point related to the financial stability and macroeconomic policy of the country. In some receiving countries, the exchange rate management policies are not sound, and you have different rates coming in between the official rate and the street rate, and that automatically pushes the remittances to go towards informal networks rather than come through the official channel. So whatever improvements you make in the official delivery of remittances, there's a tendency to use the informal because of the sheer macroeconomic management policies. But I think the most impactful reform we have seen, subject to all the points I made, is really about connecting the remittance service providers, whatever form, be it stablecoin operators or the traditional money transfer networks or the new age providers like Wise, to the domestic payment systems and giving them access to that, either directly or indirectly. And we have seen that really having a direct impact on the cost of remittances.
Thanks. Gordon, how can stablecoins promote financial inclusion while still offering the safeguards and insurances that accompany the traditional regulated financial system?
Yeah, thanks for that. I think, certainly stablecoin is the foundation layer, right? If you think about how RTGS systems are built, right? You don't necessarily ask the RTGS provider or even the even operators what's going on in the network, but there needs to be layers on top that provides the guarantee for both ensuring the transfers are safe and secure, but also ensure that they are compliant. And I think that's largely rests on the regulatory side to have the more compliance framework to set a global standard. So some coordination is needed. The technology solutions are there. The technology solutions are not too difficult to build, but adoption, I think, requires a bit of regulatory guidance on what is appropriate. And then there's also an element of financial stability, which is a bigger question. And Harris, you mentioned earlier about, perhaps in certain geographies, you wouldn't necessarily want $1 stablecoin to overtake your local currency, local economy. And that's absolutely a fair point. And there, I think it's about complying to local capital control rules, local rules regarding holding a foreign currency. But it's also about providing solutions, competing solutions both from a technology standpoint of perhaps local stablecoin or local tokenized money of some sort that could operate just as effectively, and also offer foreign investors to be able to access that local tokenized asset through the local money, tokenized money. But it's also about leveling the playing field so that you could actually have the competition with perhaps some of the incumbent players that have been slower at moving, that have been relying on regulatory capture and relying on quite a bit of the fees. Let's not forget that for every dollar of friction that exists in remittance and the slowness and ineffectiveness of cross-border movements of value, it's also a dollar of profit for someone in the value chain. So it is a difficult re-architecturing that ultimately would benefit the end users, but it would disrupt some part of the value chain. But I don't think that's necessarily bad for intermediation risk. In some ways, relying less on centralized intermediation is a way of delevering balance sheet. Right? If you think about what stablecoins do, right, and what tokenization does overall for finance, I think it is about, if I can summarize in one word, it's about deleveraging centralized intermediaries' balance sheet, or one phrase, not one word. And that has a side benefit of actually strengthening financial stability because you're actually going to be able to reduce concentrated risk on some of the balance sheets. So that goes for other correspondent banks in between. That goes for large institutions that are perhaps today are less regulated because they're in the euro-dollar space, providing dollar loans in local economies already, but they don't have as much transparency. So in some ways, you could actually bring a lot more transparency through tokenization, because today the global payment space is very dollar heavy, and a lot of the activities are not in the open because it's already in this euro-dollar banking space. And having adoption of technology could actually bring out into clarity what those type of not only payment activities, but also lending activities are for dollar-denominated loans that's not within the U.S.
Thanks. And then, Jess, is it possible at all to reduce the costs associated with BSA AML compliance without compromising on compliance? And if so, what would it take?
And I think that's a great follow-on to Gordon's intervention just now. And I think the goal here should be to modernize and streamline compliance in ways that keep its effectiveness, but still reduce unnecessary duplication, manual reviews, and jurisdictional uncertainties, especially in the cross-border context. And you can think, for example, regulatory frameworks, they should reinforce, again, that risk-based approach with clear guidance so that institutions can devote resources where the risks are actually highest. And when you think about cross-border payments, you would compare remittances, which are high-frequency, small dollar value transactions, often between individuals, to perhaps the riskier wholesale flows, which are multi-million dollar transactions. And I think too often firms tend to default to a one-size-fits-all compliance model out of fear of inconsistent enforcement. I think another example could be continuing to enable responsible innovation in compliance technologies. So this could be AI-driven transaction monitoring, for example, or privacy-preserving technologies. They can help reduce manual costs, operational burden, while still reinforcing effectiveness. And it's really, I think, from legal clarity and also regulatory adoption, acceptance that this can take off. And ultimately, I think reducing compliance costs without at the same time weakening safeguards, that's possible, but it requires coordinated legal, technological, and policy modernization with a focus on making compliance smarter and not softer.
All right, thanks, Jess. Now, we're almost at the time we'll open it up for questions from the audience. But before we do that, I have a couple of maybe more abstract kinds of questions for the panelists. So the first one is, when you imagine the cross-border payments landscape 10 years from now, what is the biggest difference maker for financial inclusion? What could have happened to stop this future, and what more will need to be done? So I'll start with Harish.
I'll respond in the abstract here without being very specific. But of course, I'll be specific on some numbers. But I would expect that the share of digital in remittances would be substantially higher. So currently, it is estimated to be about 50% by value, both on the sending and the receiving side. I would expect it to go towards 90, if not 100%. And by volume, it is currently around 20%. I would expect that also to rise to very high levels. And I alluded to the foreign exchange costs earlier, the foreign exchange margins. I would expect that to come down significantly from current levels of between 2 and 3% to perhaps 1%. And what could constrain really is, I think the technological developments are making what I'm mentioning possible. I think it is if the policies do not keep pace with those developments, I think that will be the real constraint. And the other point is really about the foreign exchange markets did not materially change. And I think it is possible that all the technological developments take root, but the foreign exchange markets, in particular on the retail side, if that does not change, I think the reduction of the cost is not going to happen, not going to be easy to bring about.
Thanks. Jess?
Yeah, and I think along those lines, thinking through costs, bigger picture, I think thinking through the biggest difference maker, maybe from a financial inclusion standpoint, is thinking through whether we're aligned on economic incentives and we have a supportive legal framework to underpin that. I think on the topic of costs and FX, too many providers are often just priced out of low margin corridors or FX spreads. And it's not because the technology doesn't exist. It's because legal and compliance burdens, they can undercut the business case to serve those corridors. And if we want to extend meaningful access, and especially if we're focused on underserved populations, jurisdictions, I think what we need to do is think of ways to reduce legal fragmentation and give providers greater regulatory clarity so that participation it's both legally viable and also economically feasible.
And Gordon?
Yeah, I think the single biggest difference maker in the next 10 years will be the adoption of blockchain and programmable ledgers that could really solve fundamentally at least the technology challenges. I think including FX. FX is an area in which you do require the market makers to be there, but institution level FX is much better than retail. But if anything, if you look at the decentralized finance space, it has demonstrated that it's actually not that difficult to provide liquidity to thinly traded, thinly liquid type of assets. So it should be without question that we should be able to, at least from a technology standpoint and from a financial balance sheet standpoint, to solve that liquidity problem in some of the emerging market currency pairs if you actually adopt the technology from the programmability of ledgers. The single biggest factor in the barriers to achieve that, of course, I think rightly highlighted, is just the policy cannot keep up and you don't end up adopting this. From a supportive policy angle, from recognizing and treating tokenized money in some sense as good as the treatment of the cash today, the cash equivalence nature of cash of today's digital money.
Now, maybe the last abstract question here. Most of the discussion here has been forward-looking. So let's imagine instead that we could scrap the current infrastructure and start from scratch with financial inclusion in mind. What principal, feature, or infrastructure would you base your system on? I'll start with Jess.
Thank you, David. I would say the foundational principle that I would focus on is interoperability. To me, the biggest structural challenges in payments, it's that success depends on ubiquity. If a system isn't widely adopted, so if payors can't use a system to reach a payee, that system just doesn't create value. It's not a payment system for users. So what happens, what we see is that network effects become this barrier. It reinforces concentration, and as a result, this fragmentation that we've seen, that we've talked about in cross-border payments. So if we were to start completely from scratch with financial inclusion in mind, I think I would be more deliberate in building open, neutral infrastructures that are really designed to connect across borders, institutions, and technologies. I'm optimistic because I think we're starting to see that today with blockchain and stablecoins, as Gordon had mentioned with Circle. I'm very optimistic about that. And I think bigger picture, if we could turn back time, start again, making that a priority so that that's what we see in traditional payments today, rather than these isolated systems that scale individually but may not necessarily reach that last mile. And I think with keeping interoperability in mind, again, looking backwards, but perhaps as a principle looking ahead, it's really how we fight this gravitational pull of network effects. And we can create a system where inclusion is really a deliberate outcome of how the system works.
Thanks. Gordon?
Yeah, I absolutely agree with that point. Interoperability is key to actually solving the cross-border issue. I think also just open access to systems, right? Having neutral systems that's not just captured by one single party. And certainly, I think if you look at the development in the blockchain space, there seems to be a trend for decentralization. That's why a lot of these is actually a quite competitive industry at every single level, whether it is at a stablecoin issuance level or a blockchain level. That's why it's a flourishing of activities. So not only you can swap in and out these different players to ensure that there is a sufficient amount of competition, not rent capturing, but also that there's escape valves in place, that you don't get trapped into one single technology. You don't end up getting trapped into one single system of value capture, that people could freely migrate to another platform, which is very similar to how we've seen the development and the issues in the traditional large tech space, right? You don't want to have single platforms that capture all the value, that's vertically integrated, that's hard to migrate out of, and that requires quite a bit of antitrust type of lawsuit to resolve. Right? You want systems that are resilient, that people could build on, people could migrate out of if the value capture is too large, and that could be interoperable as well. And I think it's also a question of not just designing, if we think about redesign of even just large or current tech infrastructure, I would probably offer the same type of answer of having certain amount of decentralization portability.
Thanks. And Harish.
So David, you framed your question very carefully. So you said specifically infrastructure. You did not open the door to the monetary system and others, so I will stick to the point about infrastructure. And I broadly agree with to what Jess and Gordon were saying, but I will perhaps frame it in terms of features rather than the underlying technology. So I think one of the things would be globally interoperable and digitally verifiable credentials. And I think currently all the digital IDs and ID developments, so they are more interoperable domestically, not globally. I think if you have globally interoperable, digitally verifiable credentials, then that can reduce the friction significantly. And then also system-enforced rules and policies, both the global policies related to AML safety, but also domestic policies related to, say, the capital controls and so on, all of them enforced through system-based controls. And then also globally addressable and reachable payment credential. So I think those are the features which could be achieved through different technologies. But I think that could fundamentally re-architect the way we look at cross-border payments. Thank you.
All right, thank you. So now we can open up for questions.
Thank you. My question is about interoperability, but also diving into the robust legal authority or framework that might sit over that. Thinking about how NACHA was formed in the United States and how regional ACH rules rolled into a national set, and whereby those rules are open source based, where if you are going to opt into the ACH network, they automatically apply to you as a financial institution. But then yet there's the operating circulars that the Federal Reserve has and other layers to the governance structure. And of course, federal and state laws and consumer protections. So my question is, thinking about how that might work in an interoperable type of way, who would be the ideal authority to oversee global interoperability and standards, even if that's someone or an authority that doesn't exist today?
I think that's a great question, big picture and looking ahead. And I think the reference to NACHA and ACH is a great one, because I think a part of this exercise is looking ahead, looking to these new infrastructures, possibly new forms of money. I would not want to reinvent the wheel. I think there are time-tested principles and approaches. I think the challenge, though, is looking at the global level, where it's different jurisdictions at play and not a clear single governmental authority that there might otherwise be in a domestic environment. And for that, I think there are still tools, there are still frameworks so that we're not reinventing the wheel or starting from scratch. For me, I would look to international organizations that have published principles. The CPMI, the Committee on Payments and Market Infrastructures at the BIS, has publications decades ago that I think still hold true today, looking at payment system efficiency and safety and governance as well. I think it's a principle, actually, if not two, in the PFMI, the Principles for Financial Market Infrastructures. So looking ahead, I think in a digital environment where in some ways it's clean snow, I would look back to the fundamentals, leverage the principles around payment systems, and to your question, governance, that we've built already as a global community, and build from there.
Maybe just to add, I think if you look at the infrastructures like NACHA, globally, there are a lot of things which are common, but of course there are some specificities. And there is some emerging experience coming from the BI's Innovation Hub, where they're looking at how to integrate fast payment systems. And they came up with an approach which is called Nexus. And that is about looking at creating templates of what are the rules in both jurisdictions, and have a mechanism to actually verify a particular transaction against both the templates in real time, and making it available to both sides at a transaction level to ensure that it is complying with both sides. So I think that could be one way to approach it. Of course, some degree of harmonization, and then allowing for specificities which can then be addressed through this real-time discovery of the rules on both sides. And then there are existing examples of global infrastructures like SWIFT and CLS Bank, and there's an approach of having a college of supervisors to collectively oversee such institutions. So I think trying to create a global body or a supranational authority to oversee global payments perhaps is not the way to go. It's more to leverage the domestic institutions, but create a collaborative structure around it. That might be the way to go. Thank you.
Gordon, do you have any thoughts?
Yeah, I think there's also a bit of whoever is leading in regulatory space gets to set kind of the global standard, right? In some sense, the Europeans came out first with their MiCA framework for at least the crypto digital asset space. US is, I think it's getting closer, hopefully, soon to have a set of rules related to stablecoin. But I think it is a matter of you do need not just the coordination bodies such as CPMI that set the standards, but actually have the detailed implementation in place. And that depends on major jurisdictions to come up with rules. And at least in the stablecoin space, I know that the various jurisdictions, large jurisdictions, either have rules in place or are drafting rules. And I think there is a lead effect if you are able to first lead with major rules and others could follow.
Yes.
The Dodd-Frank Act added consumer protections for foreign remittance transfers, but that law was enacted in 2010 before the adoption of DLT and stablecoin. If those digital currencies were used for foreign remittance transfers, as we heard from the panel today, would that require a whole new legal framework to address these technologies?
I'm personally not too sure about that. And I think the Dodd-Frank Act and the remittance transfer rule, the principles underpinning that would still benefit, I think, users, recipients of remittances, even where we're talking about new technologies. And actually, I think new technologies, including stable coins, DLT, as an example, that we've been discussing today, could actually help with compliance with the remittance transfer rule. Part of that rule requires disclosures up front with respect to fees and FX rates. That can be challenging where you have a long chain of correspondence and lack of visibility for the payor's financial institution into what are downstream institutions, the fees that they charge and the FX rates that might apply. We can see technologies that enhance transparency. We can see technologies that also might bring that last leg closer, again, that bridging aspect that we talked about. And that can help actually with conveying information, making sure that critical information reaches the payor in a way that's very much, I think, in the spirit of the remittance transfer rule.
Nothing specific to add. I think the lawyer gave a very good answer. So. Yeah.
Same here. I believe Jess, you have the best answer there.
Okay, maybe I had a question. You all spoke about sort of the issues about regulatory and legal fragmentation across jurisdictions, about being a kind of a key problem to cross-border payments. Gordon, you alluded to stablecoin legislation and rules that are being put in place across the world. Are you concerned, the panel's concerned, that there could be differences in regulatory regimes internationally for digital assets, for stablecoins, for things like redemption requirements or reserve requirements that could kind of reduce some of the global nature that they have had now and potentially inhibit their capabilities to improve cross-border payments?
I can start. I mean, absolutely, that's a concern. I think there is kind of common sense type of regulation that says stablecoin obviously should have full reserve backing, should have high quality liquid asset as backing, not too much maturity or liquidity mismatch or credit exposure. They should have on par redemption for users in a short amount of time. I think those are common sense things that would make sense to implement across the board, but there are regional differences when it comes down to the details, and sometimes it could be conflicting. For instance, the European MiCA rules have a certain amount of credit institution exposure, which would kind of go directly contrary to what currently is in the Genius Act related to perhaps not having as much exposure to certain type of risks. So I think that requires harmonization. I think it also requires understanding of passportability of rules so that you can recognize that if the home jurisdiction of the potential issuer has a strong set of regulations, you could recognize and take that set of rules and allow the operations of those instruments across the world with a common understanding that is regulated in the home jurisdiction. Once you break down those sort of fragmentation, I think it could have global acceptance. But I don't think we want to end up in a place where you have local liquidity ring fencing rules and every single country have local reserve requirements, because that does defeat the point of having these blockchain native or internet native type of money. But also it replaces some of the issues that we've seen in the past with liquidity ring fencing in banking space, in which it caused a lot of issues in past financial crisis because there are local rules regarding liquidity. And if you have a very strong set of common standards regarding the backing of stablecoin, regarding redemption rights, then I don't think it's necessary to have all the local nuances to be emphasized. Rather, I think you could have rules that are passportable.
And I would agree that I think uniformity across jurisdictions is unlikely that's not the goal or a realistic outcome. The problem actually, the problem situation is where we have laws that just directly conflict with each other or don't work. And I tend to see that more in the data usage, privacy space with data localization than on the payments side. I think there will be different regulatory approaches across different jurisdictions. And what you might see is just for global companies, just defaulting to the most strict and applying that broadly, as we do in privacy with GDPR, for example. I do think one interesting area to keep an eye on is the work that's being done at the Hague Convention on Private International Law. I'm in touch with folks there, and they're looking at interesting questions around conflict of laws, choice of law in this new digital money, digital payments context. So that's where I think some of the questions around home jurisdiction, contractual provisions, how that gets resolved, the waterfall of choices might be relevant.
Just to add one quick point, I noticed that we need to wind up. In addition to the points made by Jess and Gordon, I think there are some second-order issues related to what about how are the treatment of the institutions holding stablecoin assets. What is the potential treatment of that? And there could be significant variations of that across the world, and that could also have an implication.
Great. Well, I think we are just about out of time here for the panel. So I'd just like to thank our panelists for a very thoughtful discussion on this topic. Thank you.
Thank you, David. I'm going to make just some closing remarks, and then you'll get some directions about what happens after my closing remarks are done from someone else. So let me just start by thanking everyone for taking time to spend with us. I'm fond of saying how you spend your time says a lot about what you think is important and a priority. And it's wonderful to see so many people here for the day who are interested in financial inclusion, a topic which I think we all know is really very important to so many people in the country. So I want to thank you. It was certainly a full day and one that I hoped helped to inform your thinking and understanding about financial inclusion and how best to foster it. Perhaps it sparked an idea for you, or even better, a conversation with somebody else in the room that's something that you may choose to work on moving forward as you think of ways yourselves to help build better access to financial services and safe, fair, affordable financial services. We had a lot of aims, obviously, in convening the conference, but the main aim was to bring speakers to you who could provide insight into several aspects of building better access. And as I said, I hope it illuminated for you some of the key innovations in financial services and products serving the needs of low and moderate income families and communities. For example, it was a lengthy discussion and obviously a timely discussion of generative AI, agentic AI, which when I first read, I wasn't sure how to pronounce the first word, but now I know, and digital identity. And it's also important to think holistically about the needs of low and moderate income communities, and obviously a lot of the non-technological challenges that people face, and the primary one is stretching their incomes to cover their costs. And there was, I thought, a very interesting discussion about the importance, like so many things, of your first introduction to the financial system and whether that puts you on a path towards a sustainable interaction with the financial system, and one that is likely to enhance your financial health and your overall well-being, and one that doesn't quite turn out that way for you, which is one of the reasons there was such a focus on bank accounts and the nature and types of products that people interact with through the bank accounts. We also hope that it illuminated the challenges, but also the opportunities associated with mission-driven organizations and the importance of these organizations and the way they work with other financial institutions and in their communities to get things done. There was, I think, a particularly interesting discussion there of the challenge in balancing the need to be high touch and very personal, with the need to be high tech and scaling that tech. It brought to light emerging initiatives and technologies intended to ease some of the frictions in accessibility and affordability and cross-border remittances. We underscored the importance of bank accounts, as I said, as a cornerstone of access to financial services and of faster payments to give those struggling to make ends meet, which is really what a lot of this has been about, more control over the timing of their payments and quicker access to their income and transfers, that when you're living at the margins, those things take on an outsized kind of importance that a lot of people who are fortunate enough not to live in those situations really just don't think much about or have to worry much about, but many, many people do. We tried to make space, and I think we succeeded, to discuss the potential for insights gleaned from behavioral economics and experiments to better serve consumers. And we know that many businesses are already putting these into action, and many of them have been developed with businesses who are out to do their best to serve their customers. We also highlighted the potential for the proliferation of alternative data and more advanced machine learning models to better tailor products to customer needs, as well as to identify credit-worthy applicants that previously would have been assessed as having higher risk than they actually pose or did not have enough of a record to qualify for credit at all. So while the use of alternative data like cash flow data isn't new in some industries, the speed at which it's become available and is being used in this area is very significant. And we heard about the importance of ensuring these innovations are offered in compliance with consumer laws and regulations and conform to essential model risk management practices so that we get to this goal of responsible, safe, and fair innovation. I think it's fair to say we covered a lot in the course of a day. And I know when I go to conferences like this and take that time away from my other activities, it just is enormously energizing and beneficial. And we're going to continue, I think, through a reception to give you opportunities to speak with one another. These are no doubt topics we're going to be in conversation about over the years ahead. We also welcome any contributions you have in this continuing conversation with us. So please send feedback to, and I will read this out and spell it out, CCA hyphen, that's like in the middle, not at the bottom, context@frb.gov. So CCA-context@frb.gov. It's a mailbox that we monitor. And, you know, another thing you learn in life, particularly in the kind of position that I have with lots of people I work with, the value of crowdsourcing ideas can absolutely not be overstated. So help us crowdsource ideas. All of this has left me excited for the future and the prospects of what's ahead and about the level of energy behind the work that we saw on display and that you bring to this all the time, every day. We heard it from think tanks, from industry, from regulators, a really wide range of stakeholders. It's also made me grateful for all the good work of the people who went into making this conference a success. So before I close, I'd like to thank a few of those people. There literally are too many to mention, but I'll mention some of the key folks. Kirsten Noland, Jennifer Fernandez, and Emma Cronowith, Evan LaFleur, Ria Sanawane, to get that right, I hope I did, and Tommy Hadid. And then these were people who really developed the program and the thoughts and the ideas and helped facilitate the panels and really had the intellectual architecture of this thing built. And it was really an impressive set of speakers and a great architecture. And then to the people who really helped put this on, if you see Shalise Fryer, who you almost certainly will at the reception, and you kept seeing her sitting at that desk as a stalwart, we have Tricia here also. They really helped put on the conference for us. Shalise is our main events organizer, our lead organizer. Emily Hirschman, who was primarily responsible for marketing and communications around this event, which I thought were outstanding, and then our entire IT team, because you know, we had to have the AV right, and this was a virtual conference, although it may not have appeared that way to you, it did to the people who are looking at this online. And you know, the success of an event is how in the background all of this seems. And I'm just in debt of all the people who make that possible and happen for all of us. It will continue in our reception. But with that, I turn it, I think, Jennifer, to you to talk about.